Hello friends. Let's have a discussion on another very important module, that is the module of financial markets. In this particular module, we'll be discussing the concepts such as the structure of the financial market. You must have heard of the terms money market, capital market, etc. We'll discuss that. After that, we'll discuss external commercial borrowings, ECBs, what is the meaning of this, why this is important, etc. Then we'll discuss the concept of deposit insurance. In the last couple of months, or let's say in the last 1.5 years, because of certain issues in the cooperative banking, there is a lot of discussion with respect to deposit insurance. We'll discuss that here. Then we'll discuss the concept of credit rating, mutual funds, the ETF, exchange traded funds. What is the concept? Why it is important? Let's try and understand that. Then we'll discuss concept of P-notes, types of the bonds, financial sector legislative reforms committee, what are the recommendations of it, and then we'll have a discussion on certain questions. Let's begin the discussion here. The concept of the financial market, two different types of financial markets, or the classification of financial market into the money market as well as the capital market. Let's try and understand the basics here. Now, what do you mean by the financial market in the first place? Generally, we say that in the market there are two sides. What are the two sides? One is a surplus side and the other one is a deficit side. For example, let's start. There is RBI. RBI has a money, so I'll keep RBI under the concept of surplus side. And there are banks. The banks would want to borrow from the market. The banks would want to borrow from RBI. So the banks need money. They'll be part of the deficit side. RBI, which has money, which wants to lend in the market to banking sector, is a part of the surplus side. So in this particular market, what will happen is the funds or the money will flow from the surplus side to the deficit side. Is okay? The funds or the money is flowing from the surplus side to deficit side. And these kinds of transactions happen in which market? These happen in the financial market. Let me take another example. Here is a company, startup, or an established company, whatever it is. The company would want funds. These particular funds, the company would borrow from the market. The company would raise money from the market, and both are different. Please do not be confused between both of the statements. What are two statements I've used? In first statement I said company would be borrowing from the market, and in the second statement I said the company would be raising money from the market. What's the basic difference here? The company can use different tools to get the money from the market. For example, there is one tool called as a bond, which we'll discuss in this particular video. Do not worry about it. Okay, so company can issue bonds in the market, collect the money from the market. But essentially, the idea of a bond is nothing but the company has to repay this particular money. So when the company raises money, company collects money, borrows money from the market, it has to repay this particular money. It is basically the idea of a borrowing. And on the other hand, the same company can also issue instruments which are called as shares. Is okay. The company can also issue instruments which are referred as shares. There's a process we'll discuss later. Please do not be worried about it. And raise money from the market. But essentially, the idea here is what? In case of shares, there is no repayment done by the company. What other issues? Don't worry, we'll discuss it later. But essentially, what I'm trying to tell you here is, financial market is nothing but it's a market which facilitates the flow of the funds. There are certain people, investors, government, or companies, etc., who would want money and who would also want to borrow money. And the flow of the funds will take place between these particular people or these institutions which have money and these institutions, or let's say companies, banks, etc., which want money. And that particular side which has money to invest in the market, I'll call this as surplus side of the market. And that side of the market which wants to borrow from the market, which wants to raise money from the market, I'll call this as a deficit side of the market. So it's the financial market which will facilitate the flow of the funds from the surplus side to the deficit side. Now the question is, whether the funds are flowing, whether they are flowing for a longer duration, are they flowing for let's say 1 year, more than 1 year, 5 years, 10 years, 30 years, etc., or are they flowing for a very shorter duration, let's say for 3 months, 6 months, that is less than 1 year. Based on for what duration the funds flow, we basically divide the financial market into two types. I'll repeat the concept here again, understand this very carefully. Based on for what duration the funds are flowing, we divide the financial market into two types. One, there is a capital market, and the second one, there is a money market. And how do we differentiate between the capital market and money market? Whenever you talk about the money market, generally we say that in case of the money market, the funds flow from the surplus to deficit side for a period less than 1 year. Is okay? The funds are flowing for a duration of up to 1 year or less than 1 year. Either you can use that up to 1 year or less than 1 year, both are one and the same. And on the other hand, when you discuss the concept of a capital market, okay, when you discuss the idea of a capital market, generally the funds will flow from the surplus side to the deficit side for a period more than 1 year. That is the basic difference. Apart from this, there are many other differences. We'll discuss that, please don't worry. But the basic differentiation, based on what characteristics we will simply say that it's an instrument in the money market or in the capital market, it depends on what is the maturity period. What is the tenure for which the funds are actually flowing from the surplus to the deficit side. If it is up to 1 year, less than 1 year, that particular market is nothing but a money market. And if it is more than 1 year, it is nothing but an instrument under the capital market. Apart from this, are there any differences between the money market and capital market? Definitely yes. Just have a look at these particular differences. Just now we have discussed deals with short-term instrument, that is money market, and the capital market deals with long-term instruments, that is where the maturity period is more than 1 year in case of capital market and up to 1 year in case of money market. Second, it mainly deals with the financing of the working capital. Now what is the idea here? Let's take a very simple example. Imagine you own a company. Okay, you have started a company. This particular company would want to raise money or borrow money for two different purposes. One, they would want money for working capital purposes, or they would want this particular money for asset creation purposes. What is the basic difference? You are basically running the company, you own the company, you are operating the company. You would spend the money for purchasing raw materials, and this particular concept of expenditure incurred by the companies on day-to-day basis. Is it okay? The expenditure, the money that is spent by the company on day-to-day operations of the company, generally is referred to as working capital. Is it okay? I'll repeat it. The money that is spent by the company by borrowing from the market, by taking loans from the market for taking care of the day-to-day expenditures, generally is referred as working capital finance. And on the other hand, if you want to purchase, let's say another company, you want to purchase a machine, you want to create an asset in the market, that kind of a loan is generally taken for asset creation purposes. And the difference between both of them is, in case of working capital requirements, the company will take a loan for a shorter duration. Is it okay? They will take a loan for let's say 3 months, 6 months, etc. Generally up to 1 year. And in case of the asset creation purposes, the companies will borrow from the market. Companies raise money from the market for a longer duration, for a period more than 1 year. For example, you want to create an asset such as national highways, you want to construct a manufacturing facility, you want to develop airport, etc. All of these are what? Assets, infrastructure, nothing but assets. And if you want to develop this particular infrastructure, or let's say assets, do you want to borrow for a duration of 3 months, or do you want to borrow for a duration of let's say 15 years, 20 years, etc. And some of you simply think, what is the difference if I borrow for 3 or 20 years? If I borrow for 3 months, I will repay after 3 months. If I borrow for 20 years, I have to repay after 20 years. So anyways, I have to repay. Then what is the difference? Difference is, whenever you create an asset, or let's say an infrastructure, you want to borrow for a longer duration because immediately you do not generate revenues. It generates a very longer duration for you to develop this particular infrastructure itself. For example, you want to develop a national highway. Do you think you'll be able to construct let's say 1,000-kilometer stretch of a national highway overnight? Or is it possible even within a month, or let's say within 3 months? And if you're unable to develop this particular infrastructure within let's say 3 months, 6 months, 9 months, etc., how will you borrow the money and repay the money after 3 months? The logic here is, or the idea here is, I develop the infrastructure, I borrow for this, I will run the infrastructure, I'll operate the infrastructure, generate revenues, use the revenues to make profits, and also repay the loan that I've taken from the market. And if you're basically taking a loan for a very short duration, if you borrow for a very short duration, then even before the completion of the infrastructure project, you're supposed to repay the loan. Don't think that's a problem for the company or for a developer for that matter. So that is the business reason. Whenever you want to develop an asset, you want to create an asset, you take loan for a longer duration. You want to take, or you want to basically operate, take care of the day-to-day operations. You will take a loan for a shorter duration. And these are basically referred as asset-related loans as well as the working capital loans, etc. Okay. So in case of the money market, generally deals with the working capital financing, and on the other hand, capital market, it deals with investments and promotes capital formation. And some of you who have not seen the earlier videos very carefully, you'll get confused with the term capital formation here. What do you mean by capital formation? Generally, in any economy, for the growth to take place, for production to happen, there is a requirement of investment. Investment in infrastructure, investment in manufacturing, etc. And this kind of an investment generally creates assets. Is it okay? The investment generally creates assets. There is already an existing pool of the assets. To the existing pool of the assets, you add more assets. For example, imagine here's a manufacturer. He already has 5 machines, and in this year, he has invested money and he has purchased 2 more machines. So to the existing asset base, to the existing assets which are already present in the system, we are adding more assets. This process is called as a capital formation. And for the capital formation to take place, you need to have a huge amount of investment. Okay? So the capital market deals with investment as well as the capital formation. Third one, most important participant is the banking sector. In case of the capital market, financial institutions are there, retail investors are there, corporates are there, etc. In terms of participation, there is a much larger participation, or there are different participants in case of the capital market compared to money market. What about the general public? What are the retail investors? Now, some of you may confuse with the term retail investors. Yes, please don't be worried. Retail investors are those investors who are not professionals, who are not institutions, and these people, just like me and you, make investments in the market. For example, if I go to the market, purchase the shares of a particular company, I'm referred to as a retail investor. You go to the market, purchase bonds of the, let's say, government or corporate sector, you are referred to as a retail investor. So, in case of the participation of the retail investors, it is found to be much higher in case of the capital market compared to the money market. And who's the regulator? In case of the money market, it is mainly regulated by Reserve Bank of India. In case of the capital market, the most important regulator is the Securities Exchange Board of India, or in short, SEBI. And these are the very important differences between the money market as well as the capital market. Let's go back to the earlier discussion. We basically started with the concept of the financial market, and I stated that financial market basically facilitates the flow of the funds from the surplus sector to a deficit sector. There are investors, there are lenders, there are borrowers, and the flow of the funds will take place between both of these sides, and this is facilitated by financial market. And that is the importance of the financial market in any economy. For example, let's say India. Don't you want India to grow at a very faster pace? Don't you want the companies to generate employment, companies to produce more and more goods and services to export to the international market as well as supply goods to the domestic market? Don't you want the banks to provide more and more loans to the borrowers in the domestic market? And who will facilitate the flow of the funds between these two sides, where there is a surplus as well as a deficit side? That is the financial market, and that is the importance of the financial market in any of the market. This particular flow of the funds is facilitated by the financial market, and that's why financial market plays a pivotal role or a very central role in any of the economies. Now, this particular financial market, as we have mentioned earlier or discussed earlier, is divided into money market as well as capital market. Now, within the money market, what are the different instruments? I've listed 5 instruments here. One is a repo, a reverse repo. Second one is a call money market. Third one is a commercial papers. Fourth one is a certificates of deposit, and the fifth one is commercial bills. And on the other hand, in capital market, again there are two divisions. One is a equity market, and the second one is a debt market. Now, first, let's begin with the discussion on the money market. Let's finish it off. Then we'll jump back to the concept of the capital market here. Now, in case of the money market, as already mentioned, the flow of the funds happen for a shorter duration, up to 1 year. Again, please understand, don't be confused with any of these particular concepts. Make the concepts very, very clear. Generally, the idea is whenever a company wants to borrow for a longer duration, it will borrow from the capital market. Whenever they want to borrow for a shorter duration, they might borrow from the money market. Is it okay? And in the same way, let's say a company, if they want to borrow for a longer duration, generally they issue instruments which are referred as bonds, which are not discussed. We'll discuss it, don't worry. And on the other hand, in case of the money market, the companies or the corporates have different instruments which they can use to borrow from this particular money market. Now, let's have discussion on money market instruments. Now, in case of money market instruments, now we have listed 5 instruments. One is a repo, reverse repo. Second one is call money market. Third one is commercial papers. Fourth one is commercial bills, and the fifth one is certificates of deposits. Let's discuss all of these in detail. But with respect to the first one, that is repo and reverse repo, it is not mentioned here for a simple reason. We already discussed repo and reverse repo in the concept of banking. Now, just to basically revise what are the concepts of repo and reverse repo, let me give you a brief idea of the repo and the reverse repo here. The basic idea of repo and the reverse repo is, in layman terms, repo is the rate of interest which is charged by RBI when it gives loans for a shorter duration for, let's say, a bank. And in case of reverse repo, it is the rate of interest which is charged by a bank on the loans that they give for a short duration for RBI. But technically speaking, we have discussed this. Again, I'm just reinstating it. The basic idea of repo is a repurchasing order. Reverse repo is a reverse repurchasing order. That is, in case of a repo, there is an agreement which is signed between the bank, which is a borrowing, or which is a borrower here, as well as RBI, which is a lender. And this particular agreement is basically referred as a repurchasing order. And in case of a repurchasing order, what happens? There are two parties, and there is an agreement or a contract between both of the parties wherein one party sells asset to another party with the promise of repurchasing the asset on certain date at specific price. Is okay? I'll repeat it again. In case of a repo, most of the books will give you layman definition. Please be very, very careful with respect to that also. Repo basically stands for a repurchasing order, which can be entered into by anybody in the market. Now, please do not be under the misunderstanding that the concept of repo and reverse repo in the context of only RBI. No, repo and reverse repo are very, very common contracts in the market where two parties are involved. But in case of the banking sector, whether it is used by RBI, we generally use the concept of lending rate and borrowing rate. That is, in case of a repo, the bank will submit certain securities, assets with RBI, take money from RBI with a contract saying that after a certain time period, let's say 1 day or 7 days, etc., the bank will be paying back the amount and the RBI will be giving back the securities, but withholding or discounting certain amount of securities. That is how repo basically operates in India. And in case of reverse repo, exactly opposite. Exactly opposite of repo. That's the basic idea of repo and the reverse repo. We have already discussed this. Let's continue with other instruments here. Second instrument is called money market. What is the idea of call money market? Generally, in case of call money market, this is a market wherein one bank will give short-term loan to another bank. Is it okay? I'll repeat it again. In case of the call money market, one bank will give loan to another bank, but for a very, very short duration. For example, overnight purposes. Let's have an example here so that you understand. Imagine I'm operating a bank. You are also having one bank. Now, for whatever reason, I would want to borrow from you for overnight purposes. Now, some of you simply say, what reason is there for you to borrow? Let's say RBI has asked me to maintain certain cash with me, and at the end of the day, certain amount of cash has to be there in the bank. For whatever reason, the bank is unable to meet that particular requirement. Let's say they're falling short of 10 crore rupees. They want to borrow for only overnight purposes, only for 1 day purposes, so that they can show it to RBI that we have been able to meet the test amount, or let's say the cash that you asked me to maintain, we have been able to maintain that particular amount. So just to show to RBI, just to meet the RBI guidelines, I would want to borrow for overnight purposes. So in such situation, the first bank would want to borrow from the second bank. I would want to borrow from you. So for overnight purposes, I will borrow money from you, and on this you will charge a certain rate of interest. This rate of interest is called as call money rate. So have a look at this. What is call money market? This is a market where one bank will lend to another bank, where the deposits are moving from one bank to another bank. And it is done for overnight purposes. It is called as a call money. And if it is borrowed for, let's say, much higher duration, let's say 14 days, then it is referred as a notice money. Is it okay? So the banks would want to borrow to meet certain cash requirement, either for overnight purposes, for 14 days purposes, etc. And this kind of a borrowing and lending or movement of funds between the banks will take place in a market which is referred as a call money market. And the rate of interest which is charged by the lender on the borrower, it is referred as a call money rate or CMR. Now, generally, in case of Indian market, this particular call money rate is decided based on another benchmark which is called as a MIBOR. MIBOR basically stands for Mumbai Interbank offered rate. I'll repeat it again. Understand this very carefully. I stated that one bank will borrow from another bank for overnight purposes, or let's say for 14 days purposes, etc. If it is done for overnight, it is called as a call money. If it is done for longer duration than that, it is called as a notice money. And the lender bank will charge certain rate of interest on the borrowing bank, and that particular rate of interest is called as call money rate. Now the question will be, on what basis the call money rate will be decided? On what objective, on what parameters the call money rate is decided? For that, there is another benchmark or an indicator which is referred as MIBOR, Mumbai Interbank offered rate. And the basic idea of MIBOR is that in case of the banking sector, who are the top 5 lenders in the call money market? I'll repeat it. Who are the top 5 lenders in the call money market, and what is the rate of interest charged by them? So the weighted average rate of interest is considered, and that is called as MIBOR, Mumbai Interbank offered rate. Done. So this is the basic idea of call money market. But what is the essential concept here? What are the important points you need to remember? One, in case of call money market, one bank will lend to another bank for a very short duration, 1 day, 14 days, etc. And the lending bank will charge a rate of interest which is called as a call money rate. And if it is for shorter duration, it is called as a call money. If it is for longer duration, more than 1 day or overnight purposes, it is called as a notice money. And this particular rate of interest, that is a call money rate, is decided or is influenced by another benchmark which is referred as MIBOR, Mumbai Interbank offered rate. So first one was repo, reverse repo. Second one was call money market. Third one, commercial papers. That's right. What do you mean by commercial papers? The commercial papers was recommended by a committee which was headed by Mr. Wabul. Hence, the name of the committee will be Wabul Committee, and it was introduced post 1990 in case of India. Now, what do you mean by commercial papers? These are basically unsecured instruments. Now, there are two technical terms here. One is unsecured, second one is instruments. What do you mean by both of them? There are two terms. One is secured and the other one is unsecured. Simple meaning of this is, imagine I will come to you and I'll ask for a loan of 100 rupees. I'll ask you, please give me a loan of 100 rupees. Now you simply say, sir, I will give a loan of 100. No worries, I will give 100 rupees. You can borrow 100 rupees from me and repay, let's say, after 6 months. But what is the guarantee that you will repay the 100 rupees to me? In that case, I'll simply say, let's enter into a contract wherein if I don't repay this particular 100 rupees to you, you can simply take my vehicle, sell it in the market. Is it okay? I'll repeat it again. I've given an undertaking to you. We have entered into an agreement wherein I'm telling you, within 6 months, if I don't repay the 100 along with the interest to you, you have my vehicle, you can take it, you can sell it in the market and get your 100 rupees. So generally, when the borrowing is done in the market and there is an asset attached to the borrowing, I'll repeat it. Whenever a borrowing is done in the market and an asset is given as a guarantee, as a collateral, such type of a borrowing is called a secured borrowing. Is it okay? Such type of credit is also referred as secured credit. And on the other hand, I will borrow 100 rupees from you, but I simply say, don't you know me? I'm your faculty. Can't you give 100 rupees to faculty? Right? I'm your teacher. Give me 100. I'll be there in my use. Where will I go? You can easily come and collect your 100 rupees. I will pay it back. So I'm not giving any collateral. Just based on my credit worthiness, or let's say the idea that you know me, I've borrowed 100 rupees from you. So in such cases where there is no collateral provided, collateral means what? Security provided. Such type of loans are referred to as unsecured loans. Is it okay? So the same concept will be applicable even in case of instrument. Now you simply say, so what do you mean by instruments? You have told us unsecured and secured. What do you mean by the term instrument? Instrument essentially means it is a tool which is used by the borrowers. Is it okay? Let's simplify this. Instrument is nothing but it's a tool which is used by borrowers, by, let's say, scarcity side participants in the market. For example, an instrument could be in the form of commercial papers, an instrument could be in the form of bonds, an instrument could be in the form of shares, etc. So it's just a tool, right? Instrument is just a tool which is used by issuer in the market to collect the money from the market. Whether it is done in the form of shares, debentures, bonds, etc. It will vary. But the basic idea of instrument is this. So I will look at this. What do you mean by commercial papers? Commercial papers are unsecured instruments which are issued by the companies, which are issued by the corporates in the market to borrow for shorter duration. Remember this. Done? So what are the important points? These are the instruments which are generally having a tenure of up to 1 year, and these are unsecured. We have seen this. And any company which wants to issue these particular commercial papers should have a credit rating. Now in the future discussion, or let's say after some of the slides, we have a detailed discussion on the concept of credit rating. But as of now, what do you mean by credit rating? Like I said, I will come to you, ask for a loan of 100 rupees from you. Obviously, you will try to check whether I'm a good borrower or a bad borrower. Now, what do you mean by good borrower or a bad borrower? If you give me 100 rupees, what is the guarantee that I'm going to give back the 100 rupees to you? What is the guarantee that I'm going to pay back 100 within 6 months' time? What if I take 100 rupees? Initially, I will say I will pay back within 6 months, but I will delay it. I will pay back after 2 years to you. So you will have to be worried about what is the consequence of lending to me. So in such situations, generally, the lenders or investors will rely on a tool called as credit rating. Credit rating is nothing but an indication of a credit worthiness of the borrower. I'll repeat it. Credit rating basically represents a credit worthiness of the borrower. For example, again, we'll discuss this in detail. For the discussion, please do not worry about it now. Generally, you will see a credit rating of triple A, triple B, C, D, etc. So the credit rating is represented in alphabeticals. Is okay? It is either represented in alphabets or alphanumeric representation is also used. Please do not worry about this right now. I'm just giving you a basic idea here. So in case of those particular entities which want to issue commercial paper, they must have a credit rating. And who are allowed to invest in the commercial papers? Individuals, me and you, banking companies, non-resident Indians, foreign institutional investors, etc. are allowed to invest in the commercial papers. So the idea of repo reverse repo is over, call money market is over, and now commercial papers is over. Let's go to the fourth one, that is certificates of deposits. Now same concept. Certificates of deposits are issued for short term. And please understand this. These, that is the certificate of deposits, are generally issued by financial institutions, for example, banks. And there are other institutions, but they must be getting the license, or they must be first getting approval from the regulator, and only then they will be allowed to issue these particular certificates of deposits. Let's take an example of a bank. Here is a bank. Okay, this particular bank has issued a certificate of deposit. And let's assume I have purchased this particular certificate of deposit. I'll use the name XYZ here. What's the concept? This particular bank or a financial institution will issue a certificate of deposit. I will purchase it, or I will invest in this. Let's say for a period of 3 months or 6 months like this. And after the tenure is over, I will resubmit the certificate of deposit, and I will be paid the amount. That is the principal amount along with the interest will be given to me. Now understand the concept here. In case of these particular certificate of deposits which are issued by the financial institutions like this, these are tradable in the market. Now, if you want to further understand what is the basic idea of a certificate of deposit, let me simplify it much further. We'll come back to the feature of tradability. Don't worry about it. Let me further simplify this. I'm pretty sure all of you have a fixed deposit. Okay, what do you mean by fixed deposit? If I want to put it in a simple form, fixed deposit are nothing but the instruments are wherein the investor will keep a certain amount of money. I'll call this amount of money as X rupees for a certain time period, Y rupees, and he's going to earn an interest of Z percent or Z percent. Is it okay? Fixed deposit is an instrument wherein you as an investor, you will decide how much money you want to keep, and that money is fixed, and the time period for what duration you want to keep the amount, that is also fixed, and the rate of interest, how much you're going to earn on this, that is also fixed. Hence, these are called as fixed deposits. You must have seen fixed deposits for a duration of 3 years, 5 years, 555 days, etc. Or for that matter, even short duration, 91 days, etc. So idea is, in case of fixed deposit, amount is fixed, duration is fixed, rate of interest, how much you're going to earn is already fixed. And another very important feature of fixed deposit is, if this particular fixed deposit is kept by me, if I keep 1 lakh rupees, let's say for a duration of 1 year, on which I'm going to earn, let's say 6% rate of interest, after the tenure is over, this particular amount will be given to me. I cannot transfer the fixed deposit to you. You cannot transfer the fixed deposit to your friend, etc. You cannot simply sell this particular FDs in the market. If you keep it, the amount will be given to you, and if you want to close the FD, you will have to close the FD. You cannot simply transfer the fixed deposit to someone else. These are not tradable. If these are fixed in the name of, let's say, XYZ, the amount will be given to XYZ only. Now let's apply the same concept to the certificate of deposit. Even in case of certificate of deposit, these are the instruments which are issued by the bank. I will purchase it. These are for shorter duration, and on these particular instruments, that is the certificate of deposit, after the maturity period is over, I will be paid a certain amount. It looks just like a fixed deposit with two very important distinctions. Right? What are two very important distinctions? In case of a fixed deposit, the tenure could be more than 1 year also. But in case of a certificate deposit, these are having a maturity period of up to 1 year. These are short-term duration instruments. And the second and the most important difference is, in case of a fixed deposit, if I've kept the money in my name, the amount will be given to me only. I cannot sell this fixed deposit in the market. Whereas certificates of deposits are tradable in the market. Now you will simply say, sir, what do you mean by tradable? Here. Let's start with an example. Right, here is a bank which has issued the certificate of deposit, and here is me. Yes, I've purchased this particular certificate of deposit. And let's say it has a duration of 6 months, so I've kept a certain amount of money, and after 6 months the tenure is over, I will be given the amount, the original amount, along with, let's say, interest or returns on this. But what happens? Let's say after 2 months, there is an emergency. I immediately require money, and for whatever reasons you don't have to get into it, there is a need for this particular amount. Now I will go to the bank. I will simply tell the bank, please take back your certificate of deposit and give me the amount. The bank simply says, sir, I will give you money, but please understand the duration or the tenure of this particular certificate of deposit is 6 months, and you have come to me after 2 months. How can I simply give the full amount to you now? I will not be able to give you full amount. Right? In that particular scenario, what generally happens is I can sell this particular instrument to you, or I can simply sell it to the bank, but I will not be getting the full amount. I will be given a discounted amount. Is it okay? Again, how the discounting is done, you don't have to be worried about it. The basic idea here is the certificate deposits are tradable. You can simply sell them in the market. You can purchase them from the market. That is the important feature of certificate of deposit. Right? So this is one more money market instrument. Let's go to the last one. Right? That is commercial bills here. The commercial bills are also referred as the trade bills or bills of exchange. Okay, understand the concept here? Commercial bills. The UPC might use this name, or they might use the name trade bills or bills of exchange. What happens in a commercial bill? Generally, in case of the market, let's imagine here is a company XYZ. It has purchased certain raw material. Let's say from ABC. Is okay? So ABC has a sold raw material, and when it has sold raw material, obviously the company XYZ has to pay a certain amount to ABC. But generally, what happens is XYZ will simply tell ABC that you sell the raw material to me today. You sell certain goods to me today. I will make the payment. Let's say after 3 months. Is okay? It could be 3 months. It could be 45 days. In case of micro, small, and medium enterprises, it is 45 days. Okay, so I'm just taking a hypothetical example here. Understand the concept is more important. So here is XYZ. XYZ has purchased certain raw material from ABC. Trade has happened, and the money has to be paid for the purchases done by XYZ. But XYZ says immediately I cannot pay to you. Give me a certain time period. I will pay it back after 3 months. And in such situations, there is an agreement which is signed between both XYZ as well as ABC, which is referred as commercial bills. So I will get this. These are drawn by one business or a company to another in lieu of credit transactions. What do you mean by credit transaction? XYZ has purchased raw material today, but XYZ says I will pay the amount after 3 months. So there is a credit transaction. So instead of simply going by word, there is an agreement or contract which is drawn, and this is technically referred as a commercial bill. And that is one very important point. These are short-term instruments. Right? Remember, anything within the money market has to be a short-term instrument. So generally these are drawn for a duration of 90 days. Now these are also tradable, and banks do provide credit on these, which is referred as a bills discounting. What do I mean by this? Let's take a very simple example here. XYZ has purchased raw material from ABC and tells ABC I will pay the amount, let's say 10 lakh rupees, but after 3 months. So you sell the raw material today, come to me after 3 months, I will pay the amount of 10 lakh rupees. Now what ABC will do is, he will accept the commercial bill, he has to wait for 90 days. After 90 days, submit the commercial bill, receive the payment. But what if this particular company ABC requires money after 40 days? Is okay. Some of you simply say, why do they require after 40 days? What if this particular company ABC is incurring losses? What if this particular company ABC has purchased a lot of raw materials from their vendors, but they don't have money to repay? Whatever could be the reason, right? Reasons are not important here. Ultimately, I'm simply saying that ABC needs money. Now ABC will go to XYZ, says, give me my payment of 10 lakh, but XYZ says, I told you 90 days. It's okay, I told you 90 days. The agreement also says 90 days. How can I make payment after 40 days only? You will have to wait for another 50 days. But ABC needs money. So what they can do is, they can simply take these particular commercial bills, sell them in the market. How does it happen? Let's take a simple example. Continue with this only. ABC will sell it to a financial institution, and this particular financial institution will make certain payment to ABC. I'll come to that, give me a minute. And after 50 days are over, so already 40 days after issuance are over, after 50 more days, the financial institution will approach XYZ, submit this particular commercial bill, and receive the payment from XYZ. Is okay? This is how the basic idea of a commercial bill operates. Now, come to the point here. How much money is paid by this particular financial institution to ABC? Now, please understand this. ABC would have received how much money? 10 lakh rupees. But ABC would have received this particular 10 lakh rupees if ABC would have waited for 90 days. But has he waited for 90 days here? No. He wants the money immediately after 40 days. So in such cases, what the financial institution does, I'm using the financial institution, is also referred as financiers. Okay? What actually happens here is, these particular financiers will not pay 10 lakh rupees, rather they will withhold a certain amount of money because they are providing the services. They will charge a certain amount. So let's say hypothetically, the values are discounted by 5%. So rather than paying 10 lakh rupees, out of this particular 10 lakh rupees, 5% out of this particular 10 lakh is withheld by the financier, and the remaining amount is given to the company ABC. And after 50 more days, this particular financier will receive 10 lakh rupees from the company XYZ. And this is a win-win situation for all the three participants. Now some of you simply say, sir, ABC was supposed to receive 10 lakh, but as per your calculation, he's receiving less than that. Do you think that's a loss for ABC? My counter question will be, ABC requires money. We have established that ABC requires money. In such situation, if ABC wants money, they can borrow from the market, but on the borrowing, they will have to provide collateral, they will have to pay rate of interest on that. Rather than that, ABC is receiving less than 10 lakh rupees. He's supposed to receive 10 lakh after 50 more days, but he's immediately receiving less than 10 lakh rupees. What do you think is more beneficial for ABC? Borrowing from the market, paying rate of interest on that, or waiting for 50 more days to receive 10 lakh, or receiving less than 10 lakh, let's say 9.5 lakh rupees immediately right now, right? So because there's a trade-off involved here, the option that is left for ABC will be to sell off this particular trade receivable, get the money from the market, although it is less than what they're supposed to receive. Done? So this is how the system of commercial bill works. And for this particular purpose, the government of India has introduced something called as a TRADES platform. Remember this. TRADES. Basically, TRADES stands for Trade Receivables E-Discounting System. Is okay? I'll repeat it. Government has introduced a platform called as a TRADES platform, Trade Receivables E-Discounting System. This has been introduced by government of India, and this is expected to basically facilitate the concept of bill discounting or the trading of the receivables by these particular companies. And in case of TRADES, very recently this was in the discussion because government of India wants to promote usage of a TRADES system, especially in the context of MSMEs. Why this is important? Understand the logic here. Government of India has found that first and foremost, MSMEs are in distress. If you ask me, sir, why MSMEs are in distress, I will point my fingers towards pandemic. Okay, so MSMEs are in distress. MSMEs usually, right, or generally work in the scarcity or lower availability of working capital. Is okay? The working capital availability for them generally is low. They find it very difficult to get access to working capital. Now the problem is, if they want to borrow from the market, again they will have to provide certain collateral for that. That's also a problem. Now have a look at this. MSMEs are selling raw material, providing certain goods or services to the buyers in the market, let's say another manufacturer. But because of the pandemic, what has happened? The revenues of the manufacturer have been affected. And when the revenues of the manufacturer are affected, can simply say the repayment of the money to the MSMEs will also get affected. Let's take a situation here. Imagine if earlier these particular companies wanted to purchase raw material and pay the amount, let's say after 90 days. Now because of the pandemic, because of the effect of the pandemic on the revenues, they want for a longer duration. They want to purchase the raw material but pay the money on the raw material after much longer duration. Not 90 days. They might want, let's say, 120 days. They might want 150 days, etc. And when this particular payment on the buying, or let's say when the time duration on the receivables increases for the MSMEs, there's a higher pressure on the working capital requirement of the MSMEs. There's a logic here. MSMEs will sell the goods, collect the money, use it for working capital purposes. But what is happening? Rather than paying the money after 90 days, and now the buyer wants to pay it after 120 days. Means what? MSMEs will receive the money after 120 days, and then they will have to spend it on the working capital requirement. So there's a stress on the working capital needs of the MSMEs also. So to address this, government of India wants to promote the usage of the TRADES platform within the MSMEs. Now please understand, TRADES has been introduced many years ago. Very recently, government of India says, I want to promote MSMEs using the TRADES platform so that they'll be able to discount the bills. They will be able to sell the receivables in the market, get the money for working capital requirement. Now how the TRADES platform will work? In case of the TRADES platform, let's start with an example here. A is a buyer, okay? B is a seller. So B has sold a certain raw material to A. Now on the sales of this, bill has to be generated. Rather than using the bill, I will use a technical term here, invoice. So both A and B are registered on the platform TRADES, and they will generate an invoice on this particular platform. Done? So the invoice has been generated, and as per the invoice, B will be receiving the payment from A, let's say in 90 days. Let's say value is 10 lakh. All these are hypothetical numbers. Do not muck up the numbers. Numbers are not important here. Now A has purchased the raw material, and A has stated after 90 days I will pay the 10 lakh rupees to you. But what if B wants money after 60 days? There's working capital requirement. There are incurring losses. Their revenues are under pressure. So B wants money to spend on working capital after 60 days. So if they want to borrow again, there are so many issues. So rather than that, what B will do is this particular invoice, which has been generated on this particular platform, will be sold or will be traded. There is another party called as a financier. There are different institutions which are already working as a financiers in case of the TRADES platform. For example, there is Invoice Mart, there is M1 Exchange, etc. So this particular financier will purchase the invoice or the receivables from B and make certain discounted payment to B, and he will wait for another 30 days. So B has waited for 60. This particular financier, I'll call him as C, will wait for another 30 days. So 60 plus 30, 90 days are over. The financier will submit the bill or invoice to A and collect the money from A. This is how the TRADES platform will work. Okay. So this particular system has been introduced by government of India to promote more and more usage of the commercial bills or trade bills or bills of exchange. So these are the instruments in the money market. Please be very, very careful. Now the money market instruments are over. Let's have a discussion related to capital market instruments. So in case of capital market, we have two types of markets again. One is called as a debt market. Second one is called as an equity market. What's the basic difference here? Let's start with an example. Imagine here is a company. This particular company wants to collect 100 rupees. Why 100? Why not 1000? You can take 1000 also. No issues with that. In fact, let's take 1000. itself. Now, this particular company wants to collect 1,000 rupees from the market. There are different ways through which this particular company can raise this particular 1,000 rupees. One of the routes, one way to collect this particular 1,000 rupees is by issuing shares, and another way is by issuing debt instruments called as bonds. Okay, now have a look at this. This particular company can go to the market, sell bonds, collect 1,000 rupees. What is the difference? Whenever a company sells shares, it is as good as selling ownership in the market. Is okay? For example, let's assume a company XYZ has sold 1,000 shares in the market. How much money it has collected? Don't worry. It has sold 1,000 shares in the market, and if you purchase, let's say 50 shares out of this, or let's make it a much better number, round number, 100 shares out of the 1,000 shares. These 100 shares will form 10% out of the 1,000. Is okay? So you'll be owning 10% of the company XYZ. You become 10% stakeholder or equity holder of this particular company in the market. Now, I've introduced two terms here. Both are new. I know both are technical. One is a share, another one is equity. What's the basic difference? Some of you simply say, sir, you're using the terms interchangeably here and there. Please understand the difference very carefully. Equity is how much ownership you have in a company. Is okay? You might be owning 50% of the shares. You might be owning 60% of the shares. You might be owning 3% of the shares. So out of 100% of the shares, how much of the percentage ownership is there? It is called as equity. Whereas on the other hand, shares are individual units. Is okay? These are individual units of ownership. Meaning what? If I say a particular company has 1,000 shares, these 1,000 shares represent 100% ownership of a company. Is okay? And assuming all of these are certain types of shares, we'll discuss types of shares later. So assuming these particular 1,000 shares which are issued by the company, right, are these of shares, you'll basically be owning how much? If you purchase all the 1,000, you'll be owning 100% of the ownership. This 100% is equity, and these 1,000 units are there. These are called as shares. Then in the market, you can trade shares. Again, this. You can sell shares, you can purchase shares, provided the company is listed in the market. You will not be selling equity. You cannot trade equity in the market. You can trade shares, and when you trade shares, that is, you sell or purchase, your equity either will increase or equity will decrease. That's the basic idea, right? Done. So you can sell. That is, the company can sell shares, collect money from the market, and it means what? When they sell shares, they're simply selling the ownership in the company. And on the other hand, if you raise the money, 1,000 rupees from the market by selling instruments such as bonds, then basically you are coming under liability. That is, this company is under liability. Because please understand this, whenever you talk about debt instrument, there are two types here. One is called as a bond, and another one is called as a debenture. We'll discuss both of them. Do not worry. Whenever you talk about debt instrument, what do you mean by the term debt? Debt essentially refers to repayment liability. Is it okay? That is, if a person has taken money from the market, he has to repay the money. I understand this. If I come to you, borrow 100 rupees, underline the term borrow. If I come to you, borrow 100 rupees from you, don't expect me to repay this 100 rupees because I borrowed 100 rupees. And so idea is, when I borrow 100 rupees, either in the form of a bond as an instrument or a debenture as an instrument, both are debts only. Both are type of a debt instrument. Essentially meaning, if I borrow 100 rupees from you by issuing a bond, I will have to repay this 100 rupees from you. Now some of you simply say, sir, what is the difference between a bond and a debenture? We'll discuss that. But either by issuing a bond or a debenture, the company can raise money from the market. But importantly, the company is under repayment liability. Is okay? The company has to repay this particular money. So understand this. In case of a company which is issuing shares in the market, it is selling ownership. So if you purchase the shares of this particular company, you become certain equity holder in the company. And because you're the owner, if the company makes a profit, part of the profit is given to the owner of the company. I will repeat it again. If you purchase the shares of a particular company and you become equity holder in a particular company, you are part owner of the company. How much? It depends on the equity. Whether it is 10%, 15%, 50%, etc. But by the virtue of being owner of the company, if the company makes a profit, part of the profits are given to the shareholders or equity holders. If the company incurs a loss, then there is no repayment. And if the company incurs a loss, no profits. When there are no profits, how will the owner, that is the shareholder, get the amount? And the technical term referred to in such cases is called as a dividend. That is, a shareholder is given returns by the company. Is okay? This is a company. The company makes profits. Part of the profits is given to shareholders, and that is called as a dividend. And in case of the bonds or the debt market, what is the idea? The company can collect the money today, but there's a repayment liability on this particular money that has been collected by the company. That is the basic difference between a debt market as well as an equity market. In case of the debt market, the company will be able to raise money, but there is a repayment liability. And on the other hand, in case of equity market, the company can sell shares in the market and raise money. There is no repayment liability here. Is okay? Because when they sell shares, they're basically giving away the ownership. Again, this is a very narrow meaning. There are different types of shares. We'll have a discussion related to types of shares later. That is the basic difference between a debt market and equity market. Now let's enter into debt market. In case of the debt market, I said there are two types of instruments. One is a debenture, and the second one is a bond. Let me start with the bond. Now understand this. Generally, the most important difference between a bond and a debenture is, in case of a bond, these are secured instruments. There is an asset which is generally attached to this particular bond or an instrument, and these are the instruments which are issued. And if the borrower doesn't repay, then the asset or collateral which is attached to this particular bond can be liquidated, can be sold in the market, money can be given. Is okay? Right. So first feature of the bond is that generally these are secured instruments. Second very important feature, bonds can be issued by companies or corporates and can be issued even by the government. I'll repeat, understand this very carefully. Bonds can be issued by the companies or corporates and by the government. In case of the companies, if they want to borrow for a shorter duration, they will go for commercial papers. If they want to borrow for a longer duration, they will go for issuance of bond. In case of the government, there are bonds with a maturity period of 2 years, 3 years, 5 years, 10 years, 14 years, 30 years, 40 years. These are nothing but the bonds which are issued by the government. That is central government. Now, third very important feature. Whenever you talk about bond, the returns that are given on the bonds. Understand this. Whenever you talk about the bonds, the returns which are given on these particular bonds, the technical term they use is a coupon rate. That is the rate of interest which is paid on the bond is called as a coupon rate. For example, imagine a bond is at 100 rupees, and on this 8% is the rate of interest that is guaranteed by a company. Then such rate of interest is referred as a coupon rate. And remember one more point here, coupon rate is fixed. When these are issued, the issuer says this is a coupon rate. Okay. Next very important feature. Generally, when the bonds are issued, the tenure is also fixed. So that is the maturity period. So how many years this is going to mature? The maturity period is also given. But are there exceptions to all of them? Yes. Right. For example, in case of the tenure, there's one special type of a bond called as additional tier 1 bond, which we'll discuss later. Right. In case of additional tier 1 bond, which is issued by the banking sector, there is no maturity period. These are perpetual bonds. There's no maturity period. But essentially, understand the concept here. Whenever I talk about the bonds, these are generally secured instruments. These can be issued by the corporates as well as by the government. There is a coupon rate that is given on this particular bond. Generally, this is also fixed. Right. Have a look at this. Right. The tenure for these particular bonds is also fixed. These are certain very important features of bond. Next very important feature is bonds. Understand this. Bonds, because these are secured, the safety associated with investment in bond is higher. Is okay? I'll repeat it. Bonds, because these are secured instruments, the safety that is associated with the bond is also generally higher. That is, if I compare between, let's say, a bond, a debenture, and a share. Is okay? Right? All these are issued by the companies. The basic difference between a bond and a debenture is, in case of a bond, these are secured. In case of a debenture, these are unsecured. Okay? There is a security given here. There is no security provided here. So when I discuss, let's say, safety related to investing in bond, debenture, and a share, the safety with investment in bond is much higher. It carries a very high amount of safety compared to, let's say, debenture as well as a share. Is okay? Remember this feature also. Next, the features of debentures. First and foremost, debentures are generally unsecured. Okay? Remember this. Debentures are unsecured. That's one very important difference between a bond and a debenture. Second, in case of the debentures, the borrowing is done by the company by issuing the debentures in the market to provide for financing for expansion of the projects. Okay, they want to expand the operations, for that they can borrow, or they want to start a new project. For that particular purpose also, they can borrow from the market. Next very important feature, in case of the debentures, these can be issued by corporates as well as by the government also. Right? So remember, it's a similarity between both the bond as well as the debenture. Next very important feature, debentures are also referred as revenue bonds. Why? In many of these particular basis, when a corporate issues a debenture like this, collects the money, borrows the money from the market, let's say to start a new project or to expand the existing project, the revenue that is generated from this particular project will be earmarked or will be used to pay for the debenture. Is okay, I'll repeat it again. Debentures are also sometimes referred as a revenue bonds for a simple reason. I stated that debentures are issued in order to finance an existing project, that is expand the existing project, or to start a new project. So whether you start a new project or expand the existing project, you are able to generate certain additional revenues. So these additional revenues which are generated are reserved to pay for these particular debenture borrowings. That is the precise reason these are called as revenue bonds. And in case of the debentures, the rate of interest or the coupon rate could be fixed or could be floating. So these are some of the very important differences as well as the similarities between the bonds as well as the debentures. But essentially, bond or debenture is a part of, okay, is a basic concept within the idea of a debt market. Now within this particular bonds itself, bonds which are referred as convertible bonds, non-convertible bonds, zero coupon bonds, and indexed bonds. What is the meaning of them? In addition to these types of bonds, there are other types of bonds also which we will discuss later. First and foremost, convertible and non-convertible. What do you mean by convertible and non-convertible bonds? Let's imagine a situation here. Here is a company XYZ which has issued a bond. Okay, it has issued a bond, and this the company XYZ says purchase a bond, and after 3 years, you'll have an option to convert this particular bond, let's say into debenture. Now some of you simply say, why should I convert a bond into debenture? One very important difference that I just forgot to tell you between a bond and a debenture is that I stated earlier that when you talk about the safety feature, bonds carry higher safety compared to debentures. And another very important difference between a bond and a debenture is in case of a bond, these are secured. In case of a debenture, these are unsecured. Essentially meaning what? When you invest in a bond, you're taking lesser amount of a risk. Is okay? You're taking lesser amount of a risk compared to when you invest in a debenture. Because here there is a security, there is a collateral, and here there is no security. These are unsecured. There is no collateral provided. So you're taking higher risk by investing in a debenture. And one very important market mantra is that if you take a higher risk, you should be earning higher amount. Is the logic clear? If you take a higher risk, your returns should be higher. So as an investor, if I offer two instruments to you, one is a bond and the other one is a debenture, you simply say, so if I want to invest in a debenture, I'm taking a higher risk. So when I'm taking a higher risk, you should have to pay a higher rate of interest. So remember this, because the risk associated with investment in a debenture is higher compared to a bond. It will carry a higher coupon rate. Is it okay? It will carry a higher coupon rate compared to a bond. Then, so have a look at this. A company XYZ has issued a bond and it has given an option to you after 3 years. If you want, you can convert your bond into a debenture, earn higher returns on this. So such type of bonds which can be converted, is okay? Such type of bonds which can be converted from bond into another instrument are called as convertible bonds. Okay? What are non-convertible bonds? Straightforward. The company issues a bond. Tenure is let's say 5 years. You do not have any option to convert this. That is, it has been issued as a bond. It will remain as a bond, and you will get the amount after the maturity period of 5 years is over. Such type of bonds are referred to as non-convertible bonds. First, convertible. Second one, non-convertible. Third one, zero coupon bonds. Now, zero coupon bonds can be issued by the corporates, can be issued even by the government. What is the idea here? Basically, in case of a zero coupon bonds, follow this very carefully. The coupon rate is not there. There is no coupon rate in case of a zero coupon bond. Now, when I say there is no coupon rate, it means what? If a bond is issued to you, on this there is no rate of interest announced. Then you simply say, sir, in such cases, why would I invest in a bond? Why should I invest in a bond when there is no coupon rate? There is a logic. Understand the concept very, very carefully. Generally, in case of bonds, what happens? Right? Follow this. In case of a bond, what happens? If I am the issuer, I will take a piece of paper and I'll print the word bond on that, and I'll simply say this particular bond has a value of 100 rupees. Is it okay? The bond face value. I'll call this as a face value. Okay. So this particular bond has a value of 100 rupees. Again, some of you say, what do you mean the face value? What is the value printed on the instrument? What is the value printed on the instrument? 100 rupees. I'll call this as a face value. Okay. So the face value of the bond is how much? 100. These are issued in the market. On this value of 100, I will guarantee a coupon rate of 10%. Means what? If I'm issuing a bond worth 100 rupees, which is the face value, annually I will pay you 10% rate of interest on this, which translates to 10 rupees. Generally, in case of a bonds, this is how the calculation is done. Understand this very carefully. In case of zero coupon bonds, these particular bonds might have a face value. Let's say I'll take an arbitrary number here, 100 rupees. This particular bond has a face value of 100. I will not issue this particular bond at 100. Rather, I will sell it to you at 90 rupees. Is it okay? Follow this very carefully. The bond has a value of how much? 100. Face value is 100. I will not sell the bond at 100. Rather, I will sell it at a discounted value of 90 rupees. And let's say after 1 year, you will simply come submit this particular bond to me. I will give you 100 rupees, which is nothing but the face value of the bond. Is it okay? So what happens in the case of a zero coupon bond? In case of a zero coupon bond, coupon rate is not announced. These are the types of bonds which can be issued either by the government or by the companies or the corporate sector, wherein these particular bonds are issued at a discount, and after the maturity period, the face value is paid to the investor. Such type of bonds are called as zero coupon bonds. Now, some of you simply say, why this kind of a circus? Right? Why not just issue 100 rupees worth of bond, pay 10% or 100 rupees? Right? Understand the difference here. In case of the zero coupon bonds, what is the advantage in case of a zero coupon bond? There is certainty that is associated with the zero coupon bonds. Okay? There is certainty. That is, if you hold on to these particular bonds until maturity, how much money you are going to receive, it is guaranteed. Is okay? There is certainty that is attached to zero coupon bonds, and that is the precise reason why governments use these particular zero coupon bonds, why investors use these particular zero coupon bonds, why corporate use this zero coupon bonds. And just a piece of information here, the G securities which are issued by the government, which have a maturity up to 1 year, is okay? That is treasury bills. Remember this. The treasury bills are generally issued in the form of a zero coupon bond itself. That is, let's say there is a treasury bill having a face value of 100. These are not sold in the market at 100 rupees. Rather, these are sold at a discounted value, let's say at 95 rupees. And upon maturity, let's say 91 day, 182 days, whatever it is, upon maturity, 100 rupees is paid to the investor holder of this particular bond. Right? So this is the third type of a bond, zero coupon bond. And the fourth type of a bond, indexed bond. What happens in an indexed bond? Earlier, in case of India, we issued bonds which are referred to inflation indexed bonds. Generally, what happens in an indexed bond? Logic is very simple here. The bond value is associated with an index. Is it okay? What is the value of the bond? How much returns you are going to get from this particular bond? It is attached to a particular index. For example, let's say inflation. And in fact, in case of India, we already tried out the concept of inflation indexed bonds. The calculation is complicated. Let me simplify this. Again, this is not how exact calculation is done, but UPSC will not ask you the calculation. If you understand the concept behind this, much more than sufficient. What I said was, in case of indexed bonds, the value of the bonds or the value of the returns that we are going to get are basically indexed to a parameter. For example, let's assume government has issued a bond, right, by the inflation indexed bond, and the principal, okay, whatever amount you are paid to purchase this particular bond is indexed to inflation. How is it going to work out? Let me give you a very crude example of this. This is not how exact calculation is done. You don't have to worry about it. Let's assume a bond worth 100 rupees has been issued. So after 1 year, imagine there is a 10% inflation rate in Indian economy. Is okay? Imagine there is a 10% inflation rate. And what happens because of inflation? If there is inflation rate, the value of money will keep on decreasing. That is how many goods and services you can purchase with the same 100 rupees will keep on declining. So if you have purchased, right, let's say a bond value of 100, you give 100 rupees to government. Your government simply gives back 100 rupees to you without, right, accounting for inflation. Don't you think you have lost a certain amount of value? Last year using the same 100 rupees. Imagine you could purchase this particular pen, but because of inflation, the value of pen has increased to let's say 110 rupees. So today you will receive 100, but can you purchase this particular pen? No, there is inflation in the economy. So what generally happens in case of inflation indexed bonds is the principal is accounted for inflation annually. What will happen in this particular case? Rather than principal being 100 rupees, this particular principal will be adjusted with inflation rate to 110 rupees. So if the maturity is let's say 1 year, right, rather than getting back 100, you will receive the principal amount of 110. And upon this, again you are going to earn certain interest rate. Then this is how the indexed bonds are going to work out, and this is a crude example of how inflation indexed bonds work out. Right? So this is the fourth type of a bond, indexed bond. So what we have discussed so far? We have discussed the concept of financial market. Within the two markets, one is the money market, the five types of instruments, done and dusted. We have moved to the second market within the financial market, that is a capital market. Within capital market, again, there are two types of markets. One is called as a debt market, second one is called as an equity market. And we have discussed just now the issues related to debt market. Now we are supposed to start with the equity market. Now we have seen the money market instruments, capital market, within that we have seen the debt market. Now let's have a discussion related to equity market. As earlier discussed, basically in case of equity market, what happens? The company issues shares in the market, collects the money for various reasons, and when they will sell the shares in the market, basically it is selling the ownership in the market. Now in case of equity market, there are certain important points that you need to understand. There is a concept called as a primary market and secondary market. What is the meaning of a primary market and secondary market? Generally, whenever a company issues shares either for the first time or for the second time, third time, etc., these particular issues of the shares done by the company will take place in the primary market. Is okay? Here is a company issues shares. Let's say hypothetically for the first time in 2020, this is the first ever issue of the shares done by the company. Again in 2030, they have issued shares. 2045, again they have issued shares. 2057, again they issue shares. So understand the logic here. Whenever these particular issues of the shares are done by the company, these take place in a market which is called as a primary market. First point, which essentially means these particular shares earlier were not present in the market. Is okay? The company had not issued these particular shares in the market. The company is now issuing these particular shares in the market. So non-existing shares are issued by the company. This takes place in a market called as a primary market. Now once these particular shares are issued, imagine you have purchased these particular shares. You can take these particular shares, trade them in the market. You can either sell them in the Bombay Stock Exchange, purchase them from the stock exchange. And so idea is whenever the issued shares, understand the difference here. In case of the primary market, these shares were not present earlier in the market. Now they are present in the market. In case of these particular shares, which are issued either for the first time, second time, third time, doesn't matter. These shares are already present in the market. These shares can be traded, can be bought and sold from the market. And that particular market which facilitates trading of these particular shares is called a secondary market. Example for this is Bombay Stock Exchange, National Stock Exchange, etc. Is okay? Now within this particular primary market, whenever the shares are issued by the company for the first time ever, is okay, I'll repeat it. Whenever the shares of the company are issued in the market for the first time ever, this is called as initial public offering. And any subsequent issues of the shares, right? Let's assume there's a company XYZ. Until now, this particular XYZ company was owned amongst a small number of investors. Now this particular company XYZ will go to the market and will issue the shares to the public. Right? Until now, right, was the public able to purchase the ownership of the company? Were they available in the market for trading purposes? No, they were not available. Now this particular company goes to the market, issues the shares to the public in the market. Such type of issue is called as initial public offering. And any company which goes for an initial public offering is also referred to as a listed company. It is also referred to as a public company. Okay, or else they simply say the company is going public. Means what? Until recently or until now, you and me were not able to purchase the shares. We were unable to trade the shares of this particular company in the stock market. Now, once this particular company has undergone an initial public offering, or it has got listed, or it is a public company, it essentially means the equity or the shares of this particular company XYZ are available for trading in the stock market. Right? This is the first point. Now, any subsequent issues, right? In this example, I said the company XYZ issued the shares again in 2030, issued shares again in 2045, again in 2057. So the company which is already listed, the company whose shares are already available in the market for trading purposes, it is issuing the shares again and again. This particular process is called as FPO, follow-on public offering. Is okay? Whenever it is done for the first time, IPO, and when it is done, it is called as a listed company. It is called as a public company or a company which has gone for IPO. And when an IPO is over, the same company issues the shares again and again in the future. That particular issue is called as follow-on public offering, FPO. And now, whenever an IPO is done or an FPO is done, it always takes place in the primary market. That is, the company issues the shares to the investors in the primary market. Now, these particular investors who have purchased the shares of the company can trade these particular shares, can sell, purchase the shares again in another market which is called as a secondary market. This example is Bombay Stock Exchange. Now, whenever we talk about IPO, understand this: the investors in an IPO are divided into three groups. Understand the process very, very carefully. Whenever we talk of an IPO, 2 points. Investors are divided into three groups, and in case of an IPO, there are two processes which can be followed by a company. Let me start with the investors here. The three groups of investors are: one, the institutional investors. Best example for institutional investors are qualified institutional buyers, QIBs. Second, non-institutional buyers or investors, non-institutional. Best example for this is high net worth individuals. And the third one is retail investors. Okay, me and you are referred as retail investors. So this is the first point. Understand the process very carefully. Right? In case of IPO, I'm saying two very important points. One, classification of investors. Three types: institutional investors, non-institutional investors, as well as retail investors. Second very important point: to conduct an IPO, there are two processes which are followed. One is called as a book building process, and the second, fixed price issue. What is the basic idea here? Whenever the shares are issued, whether it is an IPO or an FPO, shares are issued by the company. What is the price of this particular share? I understand this. At what price the shares are issued by the company? Although I'm using the term company here, please understand. Generally, the process is the company is not an expert in issuing the shares. Is okay. For example, there is a company which is in, let's say, software development or service sector company or manufacturing company. These companies are not experts in issuing the shares. So what they do is they basically use the services which is provided by an expert in issuing the shares, which is referred as a merchant banker. It is a financial institution, merchant banker. Okay. So this merchant banker is an expert in providing these services, conducting an IPO or an FPO. This merchant banker is also referred by another name. Remember this. Merchant banker is also referred as underwriter. What is the meaning of this? We'll understand it when we look at the process. So a particular company which wants to go for an IPO or an FPO, the whole process is not conducted by the company. The chairman or the CEO of the company is not right, the person who is going to issue the shares in the market. Rather, the whole process is conducted by merchant banker, and they will charge a hefty amount of fees for conducting this particular process because they are providing their expert services here. Right? And why they are referred as underwriters? Give me a minute, I'll explain that also. Now look at this. It is a merchant banker which will conduct the process for an IPO or an FPO. So in case of an IPO, what I stated was there are two processes which can be followed. At what price the shares are issued, either you will follow a book building process or you will follow a fixed price methodology. And what's the importance of this? In case of a book building process, follow this: price of the share at which it is issued is not decided. I will repeat the statement. Imagine, right, there is a company and the merchant banker who is going to conduct an IPO for this particular company. At what price the shares will be issued finally is not yet decided. What happens is, in case of the book building process, generally the merchant banker says the lowest price and the highest price. Is okay? There is a band, right, within which the price will be decided. I'll repeat it. The merchant banker in a book building process will decide what will be the lowest price at which the shares can be issued, or what will be the highest price at which the shares will be issued. This is a band within which the shares will be issued. Right? For example, let's say hypothetically, the lowest price decided is 150 and the highest price for the share issue is 160 rupees. Right? So this is a price band, and within this particular price band, that is the lowest 150, highest 160, the subscribers or the investors will have to subscribe for the shares. And always remember this: whenever the shares are issued, these are not issued in individual units. For example, imagine 1,000 shares of this particular company are supposed to be issued. Individually, 1,000 shares are not issued. Rather, these are put in groups. Let's assume, right, 10 shares each. It's one lot. So if I consider 10 shares as one lot, how many lots can be made out of 1,000 shares? 100 lots can be prepared out of these particular 1,000 shares. So the investors will have to bid, will have to subscribe for these particular 100 lots. And what's the importance of that? Give me a minute, I'll explain that also. So have a look at this. These particular investors, whether these are high net worth individuals, that is non-institutional investors, institutional investors, or retail investors, they'll have to subscribe for these particular 100 lots. And there are 10 shares in each one of the lot. At what price the investor is willing to purchase this particular one share in this particular lot? Let's say one share, right? I want to subscribe for this, right? The price band is 150 to 160. I simply say 155 rupees per share. But can I simply purchase only one share? No, I will have to purchase at least one lot. So in one lot, how many shares are there? 10 shares. So I will have to pay up. If I purchase this particular one lot, I will subscribe for one lot by paying 1,550 rupees. This is how the subscription is done. Is okay? So the investors will have to subscribe for these particular lots, and they will have to say at what price they are willing to purchase in this particular band of the price. This is basically a book building process. Done. Whereas in case of a fixed price methodology, fixed issue price, what happens? The merchant banker will basically come out with a prospectus, which is document, and the document the merchant banker says, I will be selling each of the shares. That is 1,000 shares. I will be selling them at, let's say, 158 rupees per share. Is okay? In case of the fixed price methodology, at what price the shares are sold will be defined. Whereas in case of a book building process, a price band is given, and the subscribers or the investors will have to subscribe right within this particular price band. At what price they want to purchase these particular lots of shares. And what is the difference beyond this between a book building process and a fixed price issue methodology? Understand this very carefully. If a particular company wants to issue 1,000 shares, understand this very carefully. Already we have discussed there are three groups of investors. Right? One is a qualified institutional buyer, which is basically institutional buyers. Okay, this is one classification. Non-institutional investors, that is another classification, and retail investors is another classification. So if a particular company wants to issue 1,000 shares under a book building process, how many shares should be allocated to each one of them? Each one class will be different. And if they want to issue these particular 1,000 shares, let's say in a fixed price methodology, how much of the shares should go to each one of the classes will be different. Right? Follow this very carefully. In case of a book building process, again there are two classifications. What if the company has made profits in the last 3 years? That is, in the last 3 consecutive years, if the company has made profit, the classification will be different. Or how much shares should be issued to each one of the classes or the investors will be different. And if it has not made profits in the last 3 consecutive years, how much should go to each one of the groups of investors will be different. Let me start with the first one. That is, if a particular company has made profits in the last 3 consecutive years. In such cases, the SEBI mandates that 50% of the shares will have to be allocated to institutional investors, 50% of the shares will have to be allocated to non-institutional investors, remaining 35% should be allocated to retail investors. Is okay? That will translate to out of 1,000 shares, 500 shares right, will go to institutional investors, 150 shares will go to non-institutional investors, and the retail investors will be allocated a total of 350 shares. And what if this particular company has not made profits in the last 3 years? In such cases, the allocation will change, and 75% of the shares will have to be allocated to institutional investors. Non-institutional investors remains the same, 15%, remaining 10% will go to retail investors. Again, that will translate to how much? 750 shares to institutional investors, 150 shares to non-institutional investors, and 100 shares to the retail investors. So this is how the allocation of the shares has to be done, right? In case of a book building process. In case of a fixed price issue, how the allocation will change now? In case of a fixed price issue, for both institutional as well as non-institutional investors, the allocation will be 50% of the total shares, and the remaining 50% will have to be allocated to retail investors. That will translate to 500 shares between non-institutional as well as institutional investors, and 500 shares for the retail investors. That is how the SEBI has mandated. Whenever the shares are allocated, should be allocated to these three classes of investors in the market. That is very, very important. One point. Second very important point. Whenever the book building process is conducted, right, how the price will be determined. That is, if I decide the lowest price will be 150, what could be the maximum of a price? Right, within the band, what can be the lowest level? What can be the highest level? Is there any regulation with respect to this? Definitely yes. Remember this. As per the SEBI guidelines, if right, you have decided 150 is the lowest price within the price band, the difference between the lowest and the highest should not be more than 20% of the lowest price. I'll repeat it. If you have decided 150 is your lowest price within the band, right, within which all the investors will have to subscribe for the shares, the difference between the lowest and the highest should not be more than 20% of the lowest value. Meaning what? 20% of the lowest value, 150 rupees will be 30 rupees. So if a particular company wants to issue the shares under the book building process and the decided 150 will be the lowest price in the band, then the highest price should not be more than 180 rupees. That is, it should not be more than 30 rupees of the lowest price value. This guideline is there. Please remember this. Next very important point. What are the retail investors? Can they invest any amount of money in case of an IPO? Imagine a particular IPO is being conducted. Can I invest 10 lakh rupees and purchase the shares worth 10 lakh rupees? SEBI says no, you are not allowed to do that. A retail investor is limited to invest 2 lakh rupees. A maximum of 2 lakh rupees in an IPO. Remember this. The maximum amount of investment that a retail investor is allowed to do during an IPO is 2 lakh rupees. Beyond that, he is not allowed to invest. Having said so, please do not misunderstand this. Once an IPO is done, if I purchase the shares up to 2 lakh rupees, then I increase my investment in the shares of the same company. Yes, that is allowed, but you have to purchase the shares of this particular company from the secondary market. IPO is done in the primary market. You have invested 2 lakh rupees. That is your limit as per SEBI guidelines. But what if you want to purchase more shares of the same company? Can you do that? Yes, but not in an IPO. Once an IPO is done, shares of the same company are available in the market for trading purposes. You can purchase the shares from the secondary market now. That is another very important point. Next, how the shares are allocated. Follow this very carefully. In case of allocation of the shares, there are two situations. One, what if there is an undersubscription, and what if there is an oversubscription? What's the difference here? Let's take a very simple example. Imagine there's a particular company XYZ. The merchant banker has decided that they will be selling 1,000 shares of this particular company XYZ. Okay, so the IPO is to be conducted. They want to issue 1,000 shares during this particular IPO of the company XYZ. Now, if the selling is let's say 1,000 shares, what if the subscription for the shares? Okay, there are two situations. Understand this. What if the investors have subscribed for the shares? The total subscription is below 1,000. The company wants to sell 1,000 shares, but the total subscription, people or the investors want to purchase only 700 shares. This particular situation where the issuance is 1,000 shares, but the subscription is below the issuance number. They want to issue 1,000 shares, but the investors want to purchase only 700 shares. Such situation is called as undersubscription. And whenever there is undersubscription, in this particular case, there is undersubscription of how much? 300 shares. Whenever there is undersubscription, it is the duty of the underwriter to purchase these particular remaining shares. I repeat, for this very carefully. Whenever the shares are to be allocated, I said there are two situations. One, there could be undersubscription. Second one, there could be oversubscription. In case of undersubscription, where the company wants to issue 1,000 shares, but the total demand for the shares through subscription is only 700 shares. In such cases, the underwriter, the merchant banker, has to subscribe and purchase the remaining 300 shares. Then, what are the oversubscription? Like the same example, company wants to sell 1,000 shares, but what if there is a demand for 2,000 shares? Right, the institutional investors, non-institutional investors, and the retail investors, all of them put together, have a subscription of total how many? 2,000 shares. This is called as oversubscription. And within this oversubscription, again, there are two situations. One, wherein at least one lot can be allocated. What is the meaning of this? Are you example? Please do not worry. And second situation where single lot of shares cannot be allocated. Let's start. Let's take the same number. How many shares? 1,000 shares are there. And earlier I told you, individually the shares are not allocated. These shares are divided into lots, groups of shares. Imagine 10 shares each is equal to one lot. So out of 1,000 shares, how many lots can you prepare? 100 lots of shares can be issued. Now what if the number of investors who have bid, who have subscribed for these particular shares are below 100? Again, here, the number of shares demanded is more than 1,000, but the number of investors are below 100. So in such cases, at least one lot can be allocated to all these particular investors. Imagine the retail investors, the institutional as well as non-institutional investors put together. Let's assume these are 60 investors. Again, understand this concept very carefully here. These investors have demanded and subscribed for more than 1,000 shares. Again, understand the logic here. The total demand of all these 60 investors put together are more than 1,000 shares. But how many investors are there? 60 investors are there. So how many lots are there? 100 lots are there. So at least one lot can be allocated to all the 60. Again, understand this? So in such cases, what they generally do is one lot each is allocated to them, and the remaining is divided proportionally. Again, how the exact division is done, you don't have to be worried. So in such cases, where one lot it will be allocated, it is allocated, remaining 60 lots are divided proportionally amongst these 60 investors. Right? What if there is a situation wherein, right, same thing, 1,000 shares are there, the demand is more than 1,000 shares, lots are there, but the number of investors who are subscribed are more than 100. Let's imagine 150 investors are there. Okay, understand this. Total subscription is obviously more than 1,000 shares. Can you allocate 100 lots amounts to 150 investors? No, that cannot be done. So in such cases where not even a single lot would be allocated, what is generally done is lottery system is used. All the 150 investors, the lottery system is used. A computer-generated program will select 100 investors out of these 150 investors. Each of them would be allocated one lot each. Done. So this is how the allocation of the shares is done whenever IPO is conducted like this. Now, apart from this, what are other points? In the equity market, you have a primary market, right? It is where the company will issue the shares to the public for the first time, right? Whenever it is done, it is called as an IPO, and whenever subsequent issues of the shares is done, this is called as a FPO, follow-on public offering. Okay. Now, once the company has issued the shares for the first time, the company is referred to as a listed company or a public company. In case of a secondary market, the simple idea is the shares are issued by the company, are traded in this particular market. You have the BSE for this, and you also have NSE in case of this. And in case of BSE, we simply use the term BSE Sensex, right? And the basis for the calculation of BSE Sensex is 7879. You don't have to be worried about the methodology that is used for the calculation of the BSE Sensex. You don't worry about it. Essentially, the Sensex stands for sensitivity index, where the market capitalization of 30 companies is chosen, and the variation in the market capitalization is the sensitivity index. In case of NSE, you have a Nifty, and in case of Nifty, the market capitalization of 50 companies is considered. Okay, so this is certain important points with respect to secondary market. The most important secondary markets are BSE as well as NSE. In addition to this, you just need to understand two more concepts here: bulls and bears. In case of the bulls, the basic idea is these are the investors in the market who are betting on the increased market prices of the share. Okay, these people want to, or basically see that the market prices of the shares keep on increasing. And in case of the bears, they will benefit if the market prices of the shares actually decline. Okay, so the technical terms are bulls as well as bears. And in addition to BSE and NSE, you also come across commodity stock exchanges such as MCX. You also have social stock exchanges, which was proposed by the government back in the budget of 2019 and 2020. In case of India, under social stock exchanges, generally you have NGOs, right, social institutions which will issue shares and generate certain money for working purposes. Okay, this is the basic idea of social stock exchanges. So this in detail is the discussion with respect to the structure of the financial market, the money market as well as the capital market. Now that we have taken care of the structure of financial market, let's discuss some other very important concepts within the financial market. Next one will be the concept of external commercial borrowing or ECB. Now, this particular concept of an ECB, as earlier discussed, I basically stated that the companies or the corporates in case of India can borrow from the domestic market, can borrow from international market also. These particular companies which are set up in India, they can borrow from the domestic market by issuing, let's say, loans, by taking loans from the banking sector for short term, there are commercial papers, etc. In the same way, these particular commercial entities which are eligible to attract FDI, that is, understand this, those particular sectors where foreign direct investment is allowed, these particular entities in these sectors are allowed to borrow from the external market also. And such borrowing from the external market is referred to as external commercial borrowing, ECB. Okay, it's important. I'll repeat it. The companies are allowed to borrow from the domestic market, are also allowed to borrow from external market. Now the question is, can all the companies in India borrow from external market? No, only in those particular sectors where foreign direct investment is allowed. And if you're an entity in that particular segment or sector, you're allowed to borrow from external market by issuing, let's say, bonds, by taking loans from banking sector, etc. And these kinds of borrowings, which are done by these domestic entities from the foreign market, is referred to as external commercial borrowings. Next important point: are they allowed to borrow any amount of money from the external market? Can they borrow any amount of money? No. Generally, the concept of ECB comes under the regulation of RBI as well as the government. And in this particular case of ECB, the limit that is fixed as of now is 750 million or equivalent to the value of this annually. And this particular borrowing from the external market can be done in the form of foreign currencies as well as domestic currencies. That is, the borrowing can also be done in the form of rupees. Now, some of you basically say, so how can an Indian company borrow from outside market in terms of rupees? There is a tool which is referred to as masala bonds, which we'll discuss later. Do not worry. In case of masala bonds, the domestic companies, let's say Indian companies, borrow from external market, but in the form of domestic currency, that is rupees. And how that is done, what is the importance, etc. We'll have a look at it later. But as of simply understand this, first point, the Indian companies or the domestic companies are allowed to borrow from external market. Are all the companies allowed? No. Only in those particular sectors where FD is allowed, and any amount of borrowing is allowed? No. Annually, these are allowed to borrow up to 750 million. And fourth very important point, generally when this kind of borrowing is done, the maturity period has to be at least 3 years. Okay. Next, why is this particular borrowing allowed in the first place? Why is that? Despite allowing the companies to borrow in the domestic market, they are also allowed to borrow from the external market. What is the reason? What is the logic there? There's some of the important points as to why these particular companies are allowed to borrow from the external market. One, in addition to the domestic market where they can borrow, now they have one more market from where they can borrow money. Is it okay? I'll repeat it. In addition to the domestic market or domestic sources of borrowing, now we are allowing the companies to borrow from one more market. One more option is available for these particular companies to borrow. These particular borrowings can be done in order to, let's say, invest in a project, repay the loans, etc. And as per RBI guidelines, whenever these particular companies borrow from external market, they are not allowed to take this particular money and invest in real estate. Is it okay? RBI also gives guidelines as to what purposes these are allowed to be used and for what purposes this particular borrowing is not allowed to be used. For example, this can be used for expansion purposes, new project purposes, and on the other hand, the borrowings under ECB cannot be used for investment in market. That is, let's say, equity market or stock market, investment in real estate, etc. So RBI imposes these kinds of guidelines with respect to the concept of an ECB. So why this particular ECB is allowed? We are allowing the companies, or we are giving a choice for the companies either to borrow from the domestic market or borrow from the international market. The additional choice is available. And what is the advantage associated with the additional choice? Imagine a situation wherein if this particular company borrows from the domestic market, they will have to pay, let's say, 6% rate of interest. But what if I say they can borrow the same amount from the international market, from the external market, and pay only 4% rate of interest? In a sense, the rate of interest is lower in the international market compared to the domestic market. Don't you think if you are a borrower, you would want to borrow at a lower rate of interest? That is one of the reasons why the companies prefer to borrow from the international market at lower rate of interest. So the cost of the capital, the cost of the borrowing, the rate of interest is lower, and that will provide an incentive for these companies to borrow from the international market. That is one very important point as to why there is this particular route available for these companies. In addition to this, understand this, these particular companies, imagine they have taken a loan or they have to make certain amount of a repayment in foreign currencies. Now, rather than converting domestic currency into dollars, that is, let's say hypothetically, today the exchange rate is $1 is equal to 60 rupees, which essentially means what? If you have borrowed $1 and you want to pay $1 in the international market, you have rupees, you have to convert these particular rupees into dollars, and you will get $1 for every 60 rupees. So you have to pay 60 rupees, get $1, use it to repay the loan, or use it to pay certain amount in the international market for whatever reason. Now, is it okay if I say that rather than converting your rupees into dollars, what if you borrow? You basically borrow from the international market, let's say $1, use it to repay the existing amount of liability. Now, some of you basically think, so if you are borrowing $1 in the international market, in the future you have to repay this $1. Definitely yes. But what if I give you another situation? Today the exchange rate is $1 is equal to 60. What if I borrow $1 in the international market, use it to make the existing repayment, and in the future, when I'm supposed to repay this $1, what if the exchange rate is $1 is equal to, let's say, 58 rupees? In a sense, in the future, when you're supposed to repay this $1, you can pay 58 rupees and buy the dollar and use it to repay. So it will provide an additional advantage for the domestic companies in case there is an existing liability or existing repayment liability on these particular companies. So these are some of the reasons as to right? There is another route which is tapped, which is used by these particular companies, which is referred as external commercial borrowings. Having said so, is every feature associated with ECB always good? Is it always profitable or beneficial to use this particular route? No, there are certain issues or concerns associated with even the route of external commercial borrowings. What is this issue I'm referring to? Let's start here. In case of the external commercial borrowings, it provides an additional route or additional way for the domestic companies to borrow from the market. Definitely yes. Now, in addition to domestic market, if there is another market available from where you can easily get access to money, don't you think in certain cases this might lead to inefficiency of utilization of the capital? Let's say hypothetically there is a company and this particular company has only one source of borrowing, and if they're paying rate of interest on that, they'll be very careful about utilization of this particular resource. In addition to the domestic market, there is a foreign market from where these particular companies can borrow. This might lead to certain complacency or might lead to certain lethargic approach of these particular companies in terms of utilization of the capital. They will not be very, very careful with respect to utilization or spending this particular money. That is one concern. Second one, volatility in the exchange rate is always a concern. Now, some of you will be thinking, sir, what do you mean by exchange rate here? And how volatility is going to have an impact on the external commercial borrowing? Let me give you a very simple example here. But first, what do you mean by exchange rates? Exchange rate basically refers to how many units of the domestic currency are required to convert that into a foreign currency. Okay, I'll repeat it. The number of units of domestic currency that are required to convert that into foreign currency is called as exchange rate. For example, every now and then in the newspapers we come across this particular article saying that rupee depreciates, rupee value falls against a dollar. $1 is equal to 75 rupees, $1 is equal to 68 rupees. What is the meaning of that? The simple meaning of that is at that particular point of right, if you want to purchase a dollar from the market, you're supposed to pay that much equivalent to value of the domestic currency. That is, if the exchange rate right now is let's say $1 is equal to 60 rupees, it essentially means that to purchase $1, I will have to shell out, I'll have to pay 60 rupees. Or vice versa, you can also think of this like this. If you have $1, you want to convert that into rupees. If you sell $1 in the market, you will be receiving how many rupees? 60 rupees will be paid on behalf of the exchange. And that is the basic idea of exchange rate. Now, what do you mean appreciation, depreciation, etc.? We'll try and understand when I discuss the international trade concept. But essentially the point here is, whenever there is a volatility in the exchange rate, it will definitely have an impact on how much is your liability. That is, if you borrowed the money, you'll have to repay this particular money. So how much is your liability can expand or can contract based on this particular exchange rate itself. Let me give a very simple example. Let's say currently the exchange rate is $1 is equal to 60 rupees. Okay? And I'll take two situations here. Situation 1, situation 2. In case of situation 1, I'll simply say $1 is equal to 65 rupees and vice versa, $1 is equal to 55 rupees. So currently this is the exchange rate. It would shift to the situation 1 or you could also in the situation 2. What are possibilities? Let's take a very simple example here. You have borrowed $1. So obviously, forget about interest now. You're supposed to pay back $1. Okay? And when I say forget about interest, I'm not asking you to not pay interest. You'll have to pay interest. That's a different issue. Just apply the logic here. How the exchange rate will have an impact on how much money you're supposed to repay. Now look at this. If you borrowed $1, obviously you have to repay $1. That's a principal amount. Now when you borrow $1, what if the exchange rate is $1 is equal to 60 rupees? And after 1 year, let's say you're supposed to repay. The maturity is much longer than that. Just take a hypothetical situation here. You have to repay after 1 year. What if the exchange rate is $1 is equal to 65? In essence, you want to repay $1, but to get that particular $1, you have to sell 65 rupees. Get that dollar, use it to repay the person from whom you borrowed from the international market. Now, do you think that is much more costly for the borrower? That is, when you borrowed, you got it converted into rupees, you got 60 rupees. But when you're supposed to repay the same dollar, today the exchange rate is $1 is equal to 65. You have to pay more in that particular situation. Right? The dollar value is not changing. That is, you borrowed $1, you're supposed to repay $1. The amount of dollars that you're repaying is not changing. But because of the exchange rate in the market, how much rupees and now you have to spend to purchase that dollar has changed. It has become much more. So the borrowing will expand for you in terms of rupees. And what about this? Is it a possibility? Yes, that is also a possibility. Right? So in the second situation, you'll be getting in simple terms. The rupees that you're supposed to pay now for purchasing $1 are much lower compared to the earlier situation. In what situation you simply say volatility in the exchange rate is a problem for ECB? I'm writing this for a simple reason. Most of the times in case of India, this kind of a situation exists. That is, technically we use the term as a depreciation. Again, what is the meaning of depreciation? Depreciation essentially refers to a process wherein value of one currency falls against another currency. I'll repeat it again. Value of one currency falls against another currency. Falls means what? You have an exchange rate. Right? I'll write an exchange rate here. $1 is equal to 60 rupees. Today, if you want to purchase $1, you're supposed to pay 60 rupees. Right? For every 60 rupees, you can purchase $1. But what if I say the value has changed to like this? $1 is equal to 65 rupees. What has happened now? To purchase the same dollar now, you'll have to pay more rupees. So what has happened to purchasing power of rupee against the dollar here? The purchasing power of rupee against the dollar has actually come down. Is it okay? Please do not go by the number of rupees here. If you're paying more rupees to purchase the same unit of foreign currency, your purchasing power value of rupee has actually come down. Don't go by volume. Value of rupee has actually come down. So whenever value of one currency falls against another currency, we call this as a depreciation. Now generally it has been seen that against a dollar, Indian rupee overall experiences a depreciation, and this has been happening post 1990s in case of India. So in such a situation, when you borrow from the international market, rupee depreciates against the dollar. What do you think? Your borrowing is much more costlier. That is, in terms of a repayment of the same number of dollars, now you're supposed to pay more rupees to purchase those particular dollars. That is one concern. Volatility in the exchange rate is a very big concern. Availability of capital at cheaper rate of interest may make these particular companies more lenient and dependent on such funds. And when you become more and more dependent, your debt will increase. And not just debt. This is part of the external debt. Is okay? This is part of the external debt. Because if you're borrowing from the domestic market, it is part of the domestic debt. And when you borrow from the international market, it becomes part of external debt. More and more is external debt. Right? That is considered to be a negative feature or worrisome feature for the economy. For a simple reason, if you borrow from the domestic market, is it okay? It is applicable to both the government as well as for the companies. When you borrow from the domestic market, especially let's say the government, whenever there is a question of a repayment, it is in terms of rupees. There is no concern of exchange rate. Whereas when you borrow from the external market and your dependence on that increases, the question of the impact of exchange rate on your borrowing will definitely become a concern. And since we already discussed that, generally against the dollar, Indian rupee depreciates. This particular impact is called as exchange rate risk. So your ECB, right, will always carry an exchange rate risk. That's the second concern. Third one, very high borrowings in the form of debt is usually viewed negatively in the market. As earlier discussed, it is generally taken as a concern. But please understand this. Okay, here's a company. It can collect this 100 rupees either from the domestic market or from the foreign market. Is it okay? They can raise this 100 rupees from the domestic market as well as from the foreign market. Now in the domestic market, they can issue shares, they can issue debentures, they can issue bonds, they can borrow from the foreign market, they can issue bonds, they can borrow from another foreign financial institution, let's say foreign bank, and still get this 100 rupees. But the concern here is whenever you borrow from external market in terms of foreign currency, this will add to debt of the company. And whenever there's a very high amount of debt, that carries a repayment liability. Is the logic okay? Debt always carries repayment liability. That is, if you borrowed, you're supposed to repay it. The debt always carries a repayment liability. So if you borrow from the international market, as usual, the exchange rate risk is a concern. Second, any amount of a debt, understand this, any amount of a debt, when it increases beyond certain point of a limit as such, it creates a concern because the repayment pressure on the company starts to increase. Now the same 100 rupee, what if the company has raised it in the market by selling the shares in the market? The company has sold the shares in the market, collected 100 rupee. Is there a repayment liability on the company? No, because in case of shares, what has happened? In case of shares, you will sell the shares, raise the money, and the shareholders become the owners of the company. There is no repayment liability. If the company makes a profit, part of the profit in the form of a dividend is given to shareholders. Whereas in case of a debt, whether you borrow from the domestic market or international market, there is always a repayment liability, and that's a cause for concern for the market as well as for the borrower. So these are some of the very important points in the context of external commercial borrowings. Next one, the concept of deposit insurance. Now, the side of a deposit insurance, let's try and understand the basics. Imagine you have taken a fixed deposit, right? That is, you have kept money and you have taken a certificate from the bank in the form of a fixed deposit. Now, what if this particular bank fails? What if the bank incurs a huge amount of loss and they announce that we are going to shut down? We are closing, winding up the operations. Do you think that will create a lot of concern for the depositors? What about your money? Right? What about the deposits, different deposits that you have in this case of the failure of the bank? How much of the money will be returned back to you? Whether any money will be returned back to you or not, etc. So to address the issues or the concerns of the depositors, government has set up an authority in the name of DICGC, and the full form of DICGC is Deposit Insurance and Credit Guarantee Corporation. Right now, DICGC functions as a wholly owned subsidiary of Reserve Bank of India. Means what? It comes under the ownership of RBI. And what is the role of DICGC? The role of the DICGC is to collect a certain premium from the banks and provide insurance for the deposits that are kept under the bank. Is okay, repeat it. DICGC, which has been given statutory status with the passage of DICGC Act of 1961. Remember this. Deposit Insurance Credit Guarantee Corporation Act of 1961. That is the act which has been used by the government to set up DICGC. Now, the role of the DICGC is that the banks, such as let's say public sector banks, private sector banks, urban cooperative banks, etc., they will have to pay a certain amount of a premium, and the deposits in these particular banks will be provided with insurance by Deposit Insurance Credit Guarantee Corporation. Now, earlier, understand this, until very recently, that is earlier, a very small amount of deposits were actually insured. That is, until very recently, up to 1 lakh rupees of the depositors were actually insured. Very recently, Government of India has increased this particular deposit insurance from 1 lakh to 5 lakh rupees. Remember this? It has been increased fivefold from 1 lakh rupees to 5 lakh rupees. And there's a particular reason for this. The value of 1 lakh rupees up to 1 lakh rupees of a deposit was fixed back in the year 1993, and post that, this particular amount has not been revised. So, Government very recently has revised this particular, the amount of a deposit insured under DICGC from 1 lakh rupees to 5 lakh rupees. And this has come into force from 4th of February 2020. Now, when I say the bank deposits are insured, what is the amount that the bank has to pay to get the insurance done? Right? Is if you go and apply for a life insurance product or a health insurance product, you're supposed to pay certain charges. That is called as a premium. So even in this particular case of right, the deposit insurance, if the banks are going to be provided with the deposit insurance, what is the charge that the banks are supposed to pay? Remember this, until very recently, it was 10 paise for every 100 rupees. Is it okay? I'll repeat it. Until very recently, the amount of deposit insurance premium that the banks are supposed to pay was 10 paise for every 100 rupees. And recently, this has been increased to 12 paise for every 100 rupees. If the book says 10 paise, please update it. This has been done very recently by the government. That is another very important change. Third very important change that has been announced by the government is that henceforth they are going to introduce the concept of differential premium for getting these deposits insured. What do you mean by this? Let's say there are two banks, A and B. In case of these two banks, both of them will be paying 12 paise to get every 100 rupees of the deposits insured. But the concern here is, what if B is taking more risk in the market? Is okay? What if the bank B is taking more risk? Now some of you say, sir, how do you define risk in case of a bank? Let's take a simple example here. What if a bank A has diversified its loans to different segments? And what if bank B has given majority of the loans to, let's say, few of the companies? Let's imagine real estate companies. Now, do you think between bank A and bank B has taken more of a risk by giving or by concentrating their credit or loans within few of the companies? And why this is a higher risk? What if some of these companies shut it off? What if some of these companies incur loss, will not repay the loan? What do you think the bank will be facing a prospect of huge under recovery or let's say losses in case of the credit segment? Definitely yes. So in such cases, now DICGC can find out and impose differential premiums. Is okay? They can impose differential premiums on these kinds of banks. Done? And this is important for a simple reason. This is the current affairs announced by the government very, very recently. Next very important point with respect to this is, are all the bank deposits of all the banks covered under DICGC? As of now, no. The banks, right, such as the deposits in case of primary cooperative societies are not yet covered. So deposits with all the commercial banks, cooperative banks, public sector banks, private sector banks, etc. are covered under the DICGC. The deposits at primary cooperative societies are not yet covered under DICGC. So these are some of the very, very important points with respect to deposit insurance. Let's go to the next one. That is the concept of credit rating. Now, what do you mean by credit rating? First and foremost, understand this. Every one of us at one or the other point of time, let's say, will apply for a loan. Okay, just like me and you. And if you're not applied, don't worry. I don't say, sir, how can you say that I apply for the loan? Let's assume I have applied for the loan. So obviously, when I go to a bank, apply for a loan, the bank will ask me, sir, do you have any security? That is one question. The bank will also ask me, sir, what is the source of income? Because if I'm giving a loan to you, I should also be able to ensure that there is some source of income using which we're going to repay the loan to you. And one more question, right? Apart from many other questions that they're going to ask me is, sir, in the past, have you taken any loans? And if yes, have you repaid these particular loans on time? And rather than asking these two statements, they'll simply ask me, sir, what is your CIBIL score? What is the CIBIL? CIBIL basically stands for Credit Information Bureau of India Limited. And whenever they're asking you about the CIBIL score, they're trying to ascertain, they're trying to find out what is the credit worthiness of the borrower. That is, if I give a loan to him, what is the guarantee that he's going to repay? And one way to find out, again, there's no guarantee with respect to this. One way to find out is, has this particular person or the applicant or the borrower, has he taken any loans in the past? Have they taken any loans? If yes, have they repaid the loans on time? Have they defaulted on these particular loans as such? That will give a very good indication. Again, I'm saying this is not a guarantee. It is just to get a fair idea about the credit worthiness of the borrower. That will give a very good indication as to whether the borrower has got credit worthiness or not. Now, this is what we are discussing in the context of retail borrowers. That is me and you. What are corporate borrowers? What about the government? Don't you think they're also borrowers? Definitely yes. Government issues bonds in the market, borrows money from the market. The companies issue bonds in the market, issue debentures in the market, issue so many other instruments in the market, borrows from the market. So don't you want to find out whether these particular borrowers, apart from retail borrowers, are they credit worthy or not? Yes. And that is the precise reason there is a process called as a credit rating methodology. And credit rating in simple terms refers to a representation of credit worthiness of the borrower. Is it okay? What is credit rating? It is nothing but a representation. When I say representation, it is either represented in the form of alphabets or alphanumeric representation. I'll show you, don't worry. Alphabets or alphanumeric representation. That is, usually the rating agencies will use either only alphabets or they use a combination of the alphabets as well as the numericals to represent credit worthiness of a borrower in the form of credit rating. We have a credit rating agencies in the domestic market. We have credit rating agencies in the international market. But for the global market, including India, for the global market, the three very important rating agencies are S&P, Standard & Poor's, Moody's, as well as Fitch. These are the three very important global credit rating agencies. Why I'm saying these are three very important agencies? More than 90% of the credit rating market is occupied by these three rating agencies themselves. And that is the precise reason these three are very, very important. Now, these three credit rating agencies will not only provide credit rating for the companies or the instruments issued by the companies, they will also issue credit rating for the economy or for the government instruments also. And understand this, right? What do you mean by the credit rating here? Right? I stated that they'll simply use the alphabetical representation or alphanumeric representation. How this is done? Have a look at the table here. You don't have to mark the full table. Follow the important points here. The first point is, I've given the credit rating of the three rating agencies. One is the S&P, second one is the Moody's, and the third one is Fitch. Second important point, the credit rating is generally divided into two groups. Whatever grades. These are called as grades. Triple A, triple B, double B, A, C, D, etc. These are called as credit rating grades. These particular credit rating grades are divided into two groups. One is called as investment grade rating, and the second one is referred to as junk grade rating. And whenever you move from the top to the bottom like this, okay, from triple A to double A to triple B, B, C, D, whenever you move from the top to bottom like this, remember this: the credit rating will decrease. Meaning what? Imagine there are two bonds issued by, let's say, company ABC and company XYZ. The bond of company ABC is rated at triple A. The bond of a company XYZ is rated at triple B. Of the two, which is more safer? Of the two, which one has a better credit rating? We'll simply come to a conclusion: triple A, that is the bond of a company ABC, has a better credit rating compared to bond of XYZ. So as you keep on moving from the top of the table to the bottom of the table, the credit rating will keep on decreasing. And when the credit rating will decrease like this, the risk associated with investment will increase. I'll repeat it. When credit rating will decrease, the risk associated with investment will keep on increasing. Meaning what? Take the same example. If you are an investor, you want to invest in XYZ bond or the bond issued by the company XYZ as well as of ABC. In which investment will be taking more risk? The idea here is because the credit rating is lower here, by investing in a triple B bond, you'll be taking a higher risk. And because you're taking higher risk here, generally it has been seen that when you keep on moving from the top to bottom, risk increases and the returns also increase. Is it okay? The return also increases. Why? The market mantra is higher the risk they're taking, the return should also be higher. And that is why whenever you have two types of bonds like this, one bond has a higher credit rating, it will have a lower rate of interest, lower coupon rate compared to another bond which will have a lower credit rating. And this is logical for a simple reason. What if you come to me and say, sir, I have a bond, please purchase this from me. I'll look at the credit rating of the bond. Let's say credit rating of the bond is C. That is a very high amount of risk. If I'm going to take a very high amount of risk in return, I would also expect a high amount of returns also. So the coupon rate generally has been seen that those bonds with a very good credit rating offer lower coupon rate compared to those particular bonds with a very lower or very risky credit rating. And that is the precise reason why you have this kind of a classification in the grades of the credit rating into investment as well as junk grade. Whenever you come across the term junk grade bond, it essentially means the risk of investing in these particular bonds is higher. Then in case of the S&P as well as the Fitch, generally they use alphabets right to represent the credit rating, whereas Moody's uses a combination that is alphabets as well as the numerical representation. Right, for example, you can see here AA1, AA2, right, BA1, BA2, etc. So there is a combination of both alphabets as well as the numericals. That next very important point here. In case of the credit rating for the companies, the institution or let's say the company which will provide the credit rating will ask for a certain amount of data. For example, what was the profit of the company in the last couple of years, right? What is the order book of the company, etc. There's a whole list of data which is sought by the credit rating agency to provide the credit rating. Whereas in case of the economy, in case of a particular country, whenever you provide a credit rating for this, we use a term called as a sovereign credit rating. It's okay for corporate credit rating. Whereas in case of the economy or for the government instruments, we use the term sovereign credit rating. And these are the same agencies which are also present in providing sovereign credit rating. But what are the features? What are the parameters that are generally considered? I'm using the term generally for a simple reason. The methodology, the parameters, the weightage, etc. varies from one company to another company. Right? The methodology which they use will vary from one company to another company. So you don't have to be worried about the methodology that is used. All you need to understand is generally what kind of factors are considered by these particular rating agencies in order to provide credit rating. For example, they will consider what is the total debt of the government. Okay, what is the total debt? What is the total liability of the government? Right? What is the current year borrowing? What is the period for the maturity of the debt? What is the prospect of the growth? What is the burden on the government in the form of a debt interest payment? These are some of them. Again, I have to understand the statement here. These are some of the features which are considered by these credit rating agencies to provide credit rating for the economy or which is referred to as a sovereign credit rating. And all of these particular factors are very, very important. Why? Generally, when you borrow, let's say government here, because we're talking about the sovereign here, when government borrows, the borrowing will carry certain repayment liability. Right? What is the duration of the borrowing? What is the interest burden on the government for the borrowings done? How much borrowing is done totally by the government? How much borrowing is done by the government in this year? All of them are very important. For a simple reason, let's take an example here. What if a particular government, simply take an example of a country, let's say XYZ, this government has borrowed from the market and is supposed to repay, let's say, in 1 year. Is okay? That is the maturity of the debt is within 1 year. But don't you think there's a huge repayment pressure on this particular government because they borrow heavily from the market and they're supposed to repay this particular borrowing within a period of 1 year? Can you imagine the pressure that will be there on the government? Some of you simply say, sir, what will happen if they don't pay? Very good question. If the governments don't pay, this is called a sovereign default. Is okay? Anybody who borrows doesn't repay, this is called a default. And because this is defaulted by the government, we'll refer to this as sovereign default, which essentially means the government which has borrowed doesn't have money to repay this particular borrowing. What will happen as a result of this? The investors will lose confidence in the economy. I understand this. Companies who wanted to invest in this particular economy, they will lose their confidence. The same country, if they want to borrow again, do you think people will be willing to lend to this particular country? No. Even if they are able to borrow, the rate of interest that they'll have to pay now will be very, very high. So sovereign default is very, very important. If any country debt increases, it will also increase the risk of a sovereign default. Understand my statement here? I'm not saying that higher debt always leads to sovereign default. I'm simply saying that with very high amount of a borrowing, right, the risk of a default also increases. And whenever there's a high amount of risk, obviously credit rating has to be decreased. There has to be a lower credit rating provided to this particular economy as such. So that is the reason. How much borrowings are done by the government overall? How much is the borrowing done by the government this year? How much is the interest burden on this particular country, etc. All of them are very, very important. And based on many of these particular parameters and a different methodology, these particular rating agencies will provide a rating which is referred to as sovereign credit rating. And in the context of India, understand this. Generally, the sovereign credit rating of India falls in the lowest grade of investment category. I'll repeat the statement here. Right? In case of India, the credit rating or the sovereign credit rating has been in the lowest grade of investment category. That is in this particular the low assets. Then, so these are some of the very important points with respect to sovereign credit rating. Now, in addition to sovereign credit rating, or let's say credit rating, the rating agencies will also provide something called as outlook. Okay, there are two components. One, they will provide a credit rating. Second one is called as an outlook. And generally, in context of outlook, they will use a terminology such as positive, negative, neutral. What is the meaning of this? Whenever they provide a credit rating, in addition to credit rating, they will also announce what is the outlook for this particular economy. For example, whenever the rating agency feels that, again, please understand this outlook is for the future. Right? Credit rating is for the current. So outlook basically represents in the coming, let's say 6 months to 9 months or 12 months. Generally, they say 6 to 12 months like this. So in the next 6 to 12 months, what would happen to the credit rating of this particular country or economy for that matter? And to indicate that, they will use something called as an outlook. So outlook, three terms are used there. One is called as a positive outlook, neutral outlook, and a negative outlook. Meaning what? Positive outlook essentially means in the next 6 to 12 months there could be an upward revision of the sovereign credit rating. I will the statement here. Positive outlook essentially means in the next 6 to 12 months the rating agency might revise the credit rating of this particular economy or let's say company, right, in an upward manner, in a positive manner. For example, if a particular country's sovereign credit rating stands at triple B, this could be upgraded to let's say A. That is the meaning of the term, the positive outlook. Again, it is just an indication. It is not a guarantee. The rating agency is saying because of this, because of these particular factors, in the next 6 to 12 months, there is a possibility that I might revise the credit rating of this particular country or economy in an upward manner or in a positive manner. If it is a neutral, which essentially means there would be no revision probably in the next 6 to 12 months. If it is a negative outlook, it essentially means the country's credit rating or a sovereign credit rating could be downgraded. There's a possibility of upgrading the credit rating. In case of a negative outlook, there's a possibility of downgrading the credit rating. Remember these three terminologies in addition to credit rating. Now, in the context of credit rating, in addition to all of this, what is the advantage? Right? What are the benefits of having a credit rating? Generally, when you have a credit rating, it gives a certain information to investors in the market. For example, I want to invest and purchase let's say bonds of a particular company. Now, I do not have a very good information, or I'm not so much educated in terms of financial market. All I want to do is I have certain savings. I want to invest in bonds. Now, some of you say, sir, why bonds? Because I might be a safe investor. Understand that generally the idea here is the investor's capability to take risk will vary. One investor will take a different amount of risk compared to another investor. My risk appetite, that is the risk that I'm willing to take, could be different compared to your risk appetite. Somebody who wants to make huge amount of returns, higher amount of returns, for him, generally the bond market is not the one to invest. Rather, he would be recommended to invest in the stock market. He would be basically making better returns if everything works out well by investing in the stock market and not in the debt market. Because in case of debt market, comparatively, risk is lower, and when the risk is lower, obviously the returns will also be lower. So if I'm a safe investor, I do not want to take a higher amount of risk. I would want to invest in, let's say, corporate bonds. Right? Again, government bonds are also there, corporate bonds are also there. So in case of corporate bonds, I'm not well versed with the financial information. Let's say I don't have too much knowledge also in terms of financial market. In that particular situation, I might be prompted. I might be given certain information by looking at a credit rating. I will look at the credit rating. I will realize that okay, if the bond has a triple B rating, it carries a certain amount of risk. If bond has a, let's say, A credit rating, comparatively risk is lower. If bond has a double A rating, comparatively much lower risk. And if bond has a triple A rating, which the treasuries of USA government carry, it has a very, very low amount of risk or lowest risk in the market. Now here itself, I just want to make a point. When I discuss the credit rating, I said triple A has the highest credit rating. That doesn't mean that there is absolutely no risk in investing in triple A instruments. Always understand this. Whenever you invest anything in the market, whether you keep deposits in the bank, whether you invest in the share market, whether you invest in the bond market, whether you invest in mutual funds, they always carry a certain amount of risk. Is okay? Right? There is no instrument in the market which will not carry any risk. There is always an element of risk. But the question is, how much is the risk? Right? In case of, let's say, any bond which carries a triple A, that will carry the lowest amount of risk in the market. Please do not say no risk. It carries the lowest amount of risk amongst all the instruments. Right? One instrument which carries, let's say, triple B, another carries a A, another carries a triple A, another carries a C, and the fifth one carries a D. Of all these 20 instruments, which one is very risky? The most risky is the instrument which carries a credit rating D. And the most safest investment would be that particular instrument which carries a triple A. Again, having said so, understand this. It doesn't mean that those particular companies which have issued the bonds carrying triple A are not going to default. It doesn't mean that also. Generally, the argument here is, again, it is just an indication which will provide certain information to the investor. That's the first advantage. Second advantage is that those particular companies who want to issue bonds in the market, if they get a very good credit rating, let's say AA, AAA, etc., it becomes very easy for them to sell the bonds in the market because the investors generally are on the lookout to invest in these particular rated instruments which will carry very good credit rating. It is not just sufficient to have an investment grade. Within the investment grade also, whether you have a AAA, AA, triple B, etc., that also makes a difference. So there are certain institutions such as pension funds, insurance funds, etc., generally they tend to invest in those particular instruments which have a very, very good credit rating. That is a AAA, AA, etc. And here's a company which gets a credit rating, and imagine they get a AAA credit rating or AA credit rating. Don't you think it becomes very easy for them to find buyers in the market? And not just finding the buyers. What about the coupon rate? What about the rate of interest that they're supposed to offer? If the credit rating of the bond is, let's say, double B, they will have to offer a higher rate of interest, higher coupon rate. Why? It is a jungle grade bond. Risk is very high. Compared to that, what if a bond of a particular company is rated AAA, which means very high amount of safety, right? So the company might offer a lower rate of interest, lower coupon rate, and still will be able to find buyers for these particular bonds in the market. That is another very important advantage associated with the concept of credit rating. Having said so, are there concerns with the concept of credit rating? Definitely yes. First very important concern is that the company which gets the credit rating is the same company which pays for it. I'll repeat the statement here. The company which gets the credit rating is the same company which pays for it. Do you think there's already a conflict of interest? What is a conflict of interest here? As a company, when the credit rating should be given to you, the credit rating should be fair. The credit rating should be based on the factual information, the performance of the company. But on the other hand, if you're the same person who's going to pay for a credit rating agency, don't you think if the credit rating agency does its job very well, provides you with a double B credit rating, which is a junk credit rating, next time you would not prefer this rating agency, rather you would be preferring some other rating agency, wherein you expect your investment or you expect your bond credit rating to be in the investment rate. So there is always a conflict of interest. Second one, credit rating generally provides information with respect to past data. I understand this. Past, in the past, how you have done? What is your profit? How much, right? Orders you had in the last 1 year. Based on that data, you are going to be provided with the credit rating. It is not a guarantee of a future performance of the company. That is, there have been instances where those instruments which are rated at the highest, triple A, even in such cases, the companies have defaulted on the payment. Let me give you an example in case of India itself. There was an NBFC, right? When I say there was, right? Recently this has been acquired by another company. Okay, there is an NBFC by IL&FS, by the name IL&FS, Infrastructure Leasing and Financial Services. It was one of the biggest NBFCs many years ago. Now, a couple of years ago, because of various issues, they defaulted on the coupon payment of their bondholders. And understand this, the bonds of this particular company were rated at a triple A. Is okay? The bonds of this particular NBFC were rated at a triple A, meaning highest safety. And despite carrying the highest safety, this particular company defaulted on the payment. So argument here is, it is just an indicator, and most of the times the past data is taken to provide a credit rating, and that is not a guarantee of the performance of the company or performance of the government, performance of the economy in the coming days. Right? There have been instances where those particular instruments which carry very, very high credit rating have defaulted. Back in the 2008, when the global financial crisis emerged, started in the US market, there are many instruments of the companies which carry a very, very high amount of a triple A rating, where the companies defaulted on the payment. So there have been instances. So the idea of credit rating is just an indication. It's not a guarantee about the performance of the company. And the third is, the criticism against the credit rating agencies is these are not proactive, rather these are reactive. What's the meaning of the statement here? They have issued a credit rating for certain instruments, and they are revising either upward or downward the credit rating of these instruments after certain event has taken place. Let me give a very simple example here. In case of IL&FS, what is the credit rating? Highest, triple A. The company defaulted on the repayment. Only after that, the rating agency downgraded the credit rating for IL&FS. What's the concern here? Many of these investors in the market are investing based on what credit rating you have provided. And when there's a risk associated with the performance of the company is not doing very well, you're supposed to be proactive, revise the grade much before the company defaults on the repayment. But many of the times, the company defaults only after that the credit rating is revised. It is like closing the stable gates after all the horses have fled from the stable. Right? So all the events have taken place. Right? Everything that is supposed to be happening wrong with the company has happened. And after that, the credit rating agency is revising, right, this particular rating to the bonds, or let's say to the instruments in a downward manner. Okay? So these are some of the concerns which have been raised with respect to credit rating agencies. Right? This is a discussion related to the concept of credit rating. Let's go to the next one. Concept of mutual funds. Now, I'm pretty sure most of you heard of the term mutual funds. Okay? Now, what is the concept of a mutual fund? Mutual fund, in a simple terms, in a simple definition, can be defined as type of investment vehicle which consists of a portfolio of stocks, bonds, or other securities. I'll read the definition here. Mutual funds are nothing but investment vehicle which consists of a portfolio of stocks, bonds, or other securities. What's the meaning of this? What do you mean by it consists of a portfolio of stocks, bonds, and other securities? Let's take a very simple example here. Imagine here is a mutual fund company. Any mutual fund company. Don't worry about it. Here is a mutual fund company. Rather than using a mutual fund company, some of the books will also use as a term asset management company. Now, what this particular mutual fund company does is they will basically issue units which are called as mutual fund units. To whom? To investors. Imagine there are two investors here, I1 and I2. This particular mutual fund company will have different types of mutual funds. One, there is a debt mutual fund. Okay. Second, there is a equity mutual fund, and third one, it's a hybrid or mixed mutual fund. Okay. Apart from the different types of also, don't worry, just understand the basics here more than sufficient. So this particular mutual fund company basically collects the money, collects the investment from investor one. The investor one wants to invest only in the debt mutual funds. That is, they want to invest in the bonds of companies, bonds of let's say the government, etc. So this particular investor one wants to invest only in the debt market. He doesn't want to take a higher risk by investing in equity market. So what this particular mutual fund company does is it will issue mutual fund units to investor one, investor three, investor four, investor five. Is okay. Mutual fund units, let's say worth 100 rupee each. I can understand this. Worth 100 rupee each are issued to these particular investors I1, I3, I4, I5. All these investors, let's say hypothetically, will purchase one mutual fund unit each. Can they purchase more than that? Yes. But let's imagine hypothetically I1, I3, I4, and I5 have purchased one debt to mutual fund unit each, which essentially essentially means there are 4 investors, 4 mutual funds are issued by the company, and the mutual fund company has collected 400 rupees. Now, what will this particular mutual fund company do? This particular 400 rupees, which it has collected by selling debt to mutual funds, it will use this particular 400 to invest only in the debt market. Now, some of you will be thinking, sir, why these investors are approaching the mutual fund company in the first place? Can't they invest directly in the market? Yes, they can invest directly in the market, but there is a concept called as a portfolio, diversification, etc. What is the meaning of it? Right? I will invest in the bond market, I will purchase certain bonds. But what if the company from which I purchase the bonds undergoes losses, shuts it down? Right? There are certain risks associated with this investment. So rather than this, or else let's take another example. Right? There are two companies, A and B. I decide to purchase right, the bonds of the company A. What if the bonds of company B are getting better returns in terms of selling and buying in the market? You understand this? So there are so many issues associated with this. That is the precise reason. There are certain investment vehicles in the market. For example, mutual funds. I may not have sufficient knowledge. I may not know how to diversify my investment. I may not know when to purchase, when to sell. Right? So because of all of these particular reasons, rather than me directly investing in the market, I would be approaching a specialist like this to invest in the market. Right? So one type of investment vehicle in the market that is available is the concept of a mutual fund. Now in case of this particular mutual fund, what do I say? Right? The mutual fund company has issued 4 mutual fund units to I1, I3, I4, and I5, has collected 400 rupees and will purchase different types of debt instruments in the market. And please understand this. This particular company, mutual fund company, right? Every now and then, on day-to-day basis, minute basis, will be trading in the market. Will be buying and selling these instruments in the market. So I have not directly been involved in the market. Rather, my investments in the form of mutual fund investments are there in the market. But another very important point: these investors do not directly own these debt instruments. I understand this. Right? Imagine this particular 400 rupees is used by the mutual fund company to purchase bonds of the government of India. Right? These particular bonds are not directly owned by these investors. I understand. Right? These investors are given mutual funds, and these particular mutual funds which are issued, money is collected by the company. That money is used by the mutual fund company to invest in the market. Next, I2 is there. Right? Just like I2, there is I6, I7, I8, and I9. And some of you might be thinking, what is I investors? So these are the 5 investors on the other hand. Right? So these particular investors, they want to earn higher returns, but they don't know how to operate in the stock market. They can opt for the mutual funds which are issued by the mutual fund company called equity mutual funds. In case of equity mutual funds, what will happen? The mutual fund company will issue equity mutual funds, collect the money, use the money that has been collected to invest in the equity market. Right? They will purchase the shares of company ABC, XYZ, CPSEs, etc. and continuously, right, they will be trading in the market. So again, these particular I2, I6, I7, I8, I9, they own mutual fund units. They do not directly own the stocks. They simply own the mutual fund units. Based on the money collected, the mutual fund company, or let's say the manager, has invested in different equities, different stocks in the market, which on day-to-day basis, real-time basis, the manager of the asset management company will be changing, will be selling some of them, will be buying others, etc. Now, what is the advantage here? These particular investors are not directly taking an investment in the market. They do not have, let's say, sufficient expertise. They don't have time, etc. On behalf of these investors, the mutual fund company will invest in the market and earn certain amount, withhold a certain amount out of this in the form of expense ratios, and the remaining amount is given to these particular investors. Based on where you have invested, the amount will be given to you. Now, in addition to this, in case of mutual funds, there are two more concepts. That is one, mutual funds can be open mutual funds and closed mutual funds. Okay, mutual funds can be classified into open mutual funds and closed mutual funds. Meaning what? Let's take a very simple example. Here is a mutual fund company. They will issue a mutual fund unit to you. Whether debt, equity, doesn't matter. Just understand the concept. This particular mutual fund company has issued a mutual fund unit to you, and they will simply say, at any point of time, you can simply come to me, submit the mutual fund, collect the money. Is it okay? Right? At any point of time, you can give the mutual fund back, collect the money. This is called as a redemption process. Is it okay? Redemption means what? You submit the mutual funds and collect your investments. Right? So this is the idea for redemption. In case of open mutual funds, redemption can be done at any point of time. And in case of closed mutual funds, redemption will be limited. That is, there are certain constraints which are imposed by the mutual fund company with respect to redemption. For example, the company might simply say, the company which has issued the mutual funds to you might simply say, you will purchase a mutual fund today. You cannot redeem this particular mutual fund, let's say for 1 year, right? Or let's say for 6 months, or let's say for 2 years. These kinds of mutual funds are referred as closed mutual funds. Is it okay? So the redemption is allowed under open mutual funds. Redemption is not allowed for a specific time period or certain time period in case of closed mutual funds. Right? In addition to this, there is one more term, net asset value. NAV. Okay, NAV of the mutual fund. What is the concept of a NAV? Net asset value. Let's imagine a situation here. Imagine I'm running a mutual fund. I've issued the mutual fund units to you, and using the money, I've purchased a certain securities. Let's say equity in the market. Now, this particular 400 rupees that I've collected from you people, I've used it to purchase the shares. Now, can I simply say that the market price of the shares will vary? I'm just giving a hypothetical example here. Imagine using this particular 400 rupees, I purchased 4 shares in the market. Company A is a share, B is a share, C share, as well as a company D is a share. And again, just to make it simple, imagine at that particular date, the market price of each of the shares was 100 rupees. Again, I'm just trying to make the calculation much more simple. It will not be so simple in reality. Let's simplify this. So total 400 rupees, I purchased 4 shares of the 4 company. Now, can I simply say that the market price of the shares will vary? The market price of a share of company A today is 100. Tomorrow could be 103, could be 104, or could be 93 rupees also. So the market prices of the equity, or let's say the shares will vary from one point to another point of time. Now, today, let's assume today at the end of the day, the market price of company A, the share of company A has increased to let's say 110. Company B has fallen down to 95 rupees. Company C has fallen down to 90 rupees, and the company D, let's say the market price of the share has fallen down to 80 rupees. So total investment was how much? 400 rupees. Right? I've collected 400 rupees from all of you by issuing equity mutual fund, and I've invested and purchased shares of 4 companies. At the end of the day, the market price of the shares of all of these particular companies has basically become how much? 375 rupees. Let's get the sum correct. 110 plus 90, that will be how much? 200 rupees, 295, and 375. Correct? Right? So 375. So at the end of the day, basically it has fallen down to 375 rupees. So I will get this. Right? Beginning, how much money was collected? 400. Now using this money, I purchased the shares of a company ABCD market. What is the market price of the shares at the end of the day? Totally 375. This will be referred as a net asset value. Right? So what is the market price of all the instruments held by the mutual fund company at the end of the day? It is called as a net asset value. So you can calculate the net asset value of mutual fund company, and it will vary from one day to the next day because the market prices of the instruments held by the mutual fund company is going to vary. Hence, the net asset value is also going to vary. In addition to the net asset value, there is also net asset value per unit. Is okay? Net asset value per unit. What is the meaning of NAV per unit? How many units of mutual funds are issued? 4 units of mutual fund. I'm talking about this example. 4 units of equity mutual fund. And what is the NAV today? 375 rupees. So the net asset value divided by number of units. That was 4. This will give you NAV per unit. Is okay? NAV per unit will be given to you. So that will come up to how much? 4 ones, 4 nines, and 4 fours. Right? So around 94. I'm just only the number here. Around 94 rupees. So per unit, currently the value is 94 rupees. When you purchase, the value is 100, and currently at the end of today, it is 94 rupees. That is the precise reason. If you have seen the advertisements related to mutual funds, they will mention one statement. They'll say that mutual funds investments are subject to market risk. When you're going to purchase the mutual funds, and the company that is, let's say, the mutual fund company makes an investment in the market, obviously the market prices of the instruments are going to vary. As a result of this, your NAV per unit will also vary. Right? So these are some of the very, very important points with respect to the mutual funds. Next concept, idea of ETF, exchange traded fund. We'll discuss concept of CPSE as well as Bharat 22 ETF. Yeah. Let's have a discussion related to this. First and foremost, what do you mean by ETF? Okay, let's try and understand the concept of ETF first. Then we'll discuss what are the different types of ETFs. So whenever we discuss the concept of an ETF, exchange traded fund, it is basically a basket of securities that trade on an exchange just like a stock. Is okay? This is a simplified definition. We'll discuss. Don't worry. What is an ETF? It is a basket of securities that trade in the stock market just like the stock. What do you mean by this? Let's get the concept here. Let's understand this. ETF basically is a combination of two concepts. One is called as an index fund, and the second a mutual fund. Okay. Now what happens in a mutual fund? Mutual fund is an investment vehicle where investments are pooled. Is it okay? I will remember the definition that we discussed earlier. The mutual funds are nothing but it's an investment vehicle, right? Wherein the investments are pooled and they're invested either the debt market or the equity market or a combination of both. And that is one definition. Remember this. Second, there's a concept of index fund. What do you mean by index fund here? Let's take a very simple example. In the Bombay Stock Exchange, right? Earlier we discussed the concept of Sensex. What is Sensex? Sensex basically stands for sensitivity index. That is, we are going to calculate market capitalization of 30 companies and find out what is the Sensex. Some of you will worry as to what do you mean by market capitalization. Let's simplify this. Market capitalization essentially is the market price into number of outstanding shares. I can go into the nitty-gritties of outstanding shares and there's a formula for that also. Let's simplify this. Imagine there is a particular company which has issued 100 shares and these particular 100 shares are available for trading in the stock market. These are traded in the stock market. So these particular 100 shares today, if the market price is 10 rupees, then what will the market capitalization? 1000 rupees. Tomorrow the market price of the share could increase to 11 rupees. In such case, the market capitalization will change how much? 1100. Day after tomorrow, it would hit 13 rupees. So market capitalization will be how much? 1300 rupees. Right? So this is how market capitalization is calculated. And by how much market capitalization is changing, it is converted into numbers. That is nothing but Sensex. Okay. So compared to BSE, by how much the market capitalization of the stock market has changed, that is converted into numbers, and that is you get in the form of a Sensex. Now have a look at this. In case of BSE, I stated that market capitalization of how many companies are taken? 30 companies is okay. 30 companies market capitalization is taken. Then you basically calculate the Sensex. Now what if I simply say I will purchase one share each of all the 30 companies? Is okay. Understand the concept here? Do not get confused with the index fund here. For the concept. What if I simply say I will purchase one share each of all the 30 companies, and these particular 30 companies are used to calculate what? Market capitalization, right? And this particular market capitalization is used to calculate Sensex. Right? So what I've done, I purchased 30 shares, one share each of all these particular 30 companies. Now can I simply say that because my portfolio is nothing but group of investments. Okay, my portfolio consists of 30 shares. This particular value of portfolio will track Sensex. Is it okay? Right? If you're confused, so how is it going to track? It simply means what? When the market price of the 30 companies, shares of these particular 30 companies increases, Sensex also increases. And what is there in my portfolio? Shares of the same 30 companies. So the portfolio value will also increase. And if the market price of overall 30 companies share prices fall down, Sensex will fall down. So will my value of portfolio. Because in my portfolio, I have one share each of all the 30 companies, which are used to calculate the Sensex. So if the market price of all the 30 companies shares increases, Sensex increases, the value of my investments will also increase. So value of my investment or my portfolio is going to track the Sensex here. And on the other hand, market prices of all the 30 companies shares decreases, Sensex falls down, so will my portfolio value, it will also fall. So index to fund essentially means a fund whose value will be tracked, whose value is connected with an index. Is okay. It is nothing but an investment portfolio, value of which is connected with an external index, with an index like this. For example, let's take another example. If I purchase the shares of the Central Public Sector Enterprises, is okay. If I purchase the shares of CPSEs and the market price of the shares of these CPSEs increases, what will happen to the share price or the value of portfolio that I'm holding? This particular portfolio which consists of shares of CPSEs, the value will start increasing. If the market price of all the CPSEs shares starts decreasing, the value of my portfolio will also start decreasing. So my portfolio is simply tracking, is following the market prices of all the CPSEs. That is the concept of index to fund. So in case of ETF, there is a combination of both of them. The concept of index to fund as well as a mutual fund. How does it happen? Let me take an example and show it to you. Before that, in case of ETF, there is a basket of assets which can be purchased and sold. ETFs are listed in the stock market. Okay, these are listed in the stock market. These can be purchased and sold at any point of time. And when ETFs are traded, the prices of these ETFs either will fall or increase based on the supply and demand in the market. Now, what is this idea of an ETF? How is it going to operate? Let me take two examples of the central government CPSE ETF. There's one ETF run by the central government CPSE ETF. There's another ETF by the name Bharat 22 ETF. Let me take the example of the first one CPSE ETF. What the central government has done is rather than conducting this investment of individually, let's say these particular CPSEs, it has put together an ETF. Now rather than considering 12 stocks, which becomes a cumbersome exercise, let's assume 3 stocks. Okay, understand the logic here? I can show you 12 stocks also, but that is very cumbersome exercise. Let's simplify this. Imagine government of India wants to disinvest 3 public sector enterprises. Okay, there are 3 public sector enterprises. Let's say company A, company B, and company C. Okay, these are the CPSEs, central public sector enterprises, wherein government of India wants to conduct a disinvestment. And we'll be discussing disinvestment in detail. Do not worry, but the basic idea of disinvestment is what? The government's ownership in the CPSEs will be sold. Okay, either government might sell full ownership, small amount of ownership, etc. Essentially, ownership equity is sold, money is collected. That exercise is called as disinvestment. Now have a look at this. Government of India wants to conduct a disinvestment in 3 CPSEs, A, B, and C. And let's say hypothetically, company A, the government wants to sell 100 shares in this. In case of CPSEB, government wants to sell 200 shares of this. And in case of C, government wants to sell 300 shares of this. Can government do all of them individually? Yes. And let's say in the month of August, government will sell 100 shares of company A. In the month of September, 200 shares of company B. In the month of October, 300 shares of companies. Can it be done individually? Definitely yes. Rather than doing it individually, what government might do is it will take the route of exchange traded fund. What will happen in ETF? We will take 100 shares of A, 200 shares of company B, and 300 shares of company C, and club all of them and create 100 ETF units. What is the meaning of this? If I take 1 unit of this particular ETF, follow this. If I take 1 unit of this particular ETF, this particular 1 unit of ETF will consist of 1 share of company A, 2 shares of B, and 3 shares of C. Is it okay? We have taken 100, 200, and 300 shares of A, B, C respectively, and we have created 100 ETF units, and we are selling these particular ETF units individually, which are consisting of 1 share of A, 2 shares of B, and 3 shares of C. Government sells it in the market. Imagine you purchase 2 of these particular ETF units. Is it okay? Imagine you purchase 2 ETF units. What does it essentially mean? It essentially means you purchase 2 shares of A, you purchase 4 shares of B, and you purchase 6 shares of C. Is it okay? So that is the idea of exchange traded fund. Now in case of equity, this is how it is. Right? Can the government do the same thing with respect to bonds also? Definitely yes. Government can do the same thing even in case of bonds. Now in case of the equity ETF, government has introduced as of now, right, currently there are 2 of these particular ETFs which are there in the market, which are issued by the government. CPSE ETF, Bharat 22 ETF. In case of CPSE ETF, this particular ETF consists of shares of 12 companies. Remember this. It consists of shares of 12 of these particular CPSEs, and this particular CPSE ETF is managed by a company, Reliance Asset Management Company, and this was launched by the government in 2014. In addition to this, there's one more equity ETF, Bharat 22 ETF. This basically draws shares of multiple companies but from 6 sectors, and this is managed by ICICI Prudential AMC. This was launched by the government in the year 2017. And how many companies stocks are there in this? Right, 22 companies stocks are there in this particular Bharat 22 ETF. But more importantly, when you talk of CPSE ETF and Bharat 22 ETF, you're talking about equity ETFs. Is okay? You're talking about equity ETFs. So that is, these ETFs will consist of the shares of these particular companies which are part of this particular ETF. In addition to this, government also has rolled out or has introduced or launched something by the name of Bharat Bond ETF. Rather than having the shares of CPSEs, now government of India has combined together bonds, debt instruments, and has issued these particular ETFs in the market. Now, what are the important points like this? The coupons which are received from the bonds will be reinvested in the fund itself. That is, these particular bonds will have different maturities, or these ETFs will have different maturities of 23, 24, 30, and 31. And what has been done by the government? Let's assume 2 companies A and B. Rather than individually issuing bonds, government has basically clubbed the bonds of both A and B into an ETF and has issued a bond ETF in the market. That's the basic idea of an ETF. Okay, so Bharat Bond ETF has been launched by the government, and these particular ETFs will have 4 different maturities: 23, 24, short-term maturity, and long-term 30 and 31. The coupons, because these are consisting of bonds, the coupons that will be given on these particular bonds will not be given to the investors. Rather, they will be reinvested in the fund itself, and the fund will be managed by India mutual fund company. After the maturity period of the ETF is over, returns are given to the investors. The Bharat Bond ETF 2023, for example, will track Nifty Bharat Bond Index, and this index will measure the performance of 13 government-owned entities which will have a credit rating of AAA, or the bonds issued by these entities have a credit rating of AAA. So these are some of the concepts related to idea of ETF, exchange traded fund. Now let's have a look at another type of ETF, gold ETF. Now generally when you invest in gold, when you invest in the market and purchase, let's say gold, either in the form of jewelry, purified gold, etc., there is one risk that is generally associated with your investment. That is, the market price of the gold is volatile. There is a volatility in the market price. And generally people invest, again under the term invest, generally people tend to invest in gold whenever they want to beat, let's say, the impact of inflation on their investments. Okay? So the argument here is to protect your investments from the impact of inflation, people tend to invest in the gold. Now, one of the ways of investment in the gold, but not literally in gold, is the concept of gold ETF. Okay, there are two more instruments. Now, one of the ways for you to beat the impact of inflation on your investment is the investment in the gold ETF. In addition to this, there is one more type of a gold investment. We'll have a discussion related to that later. But the idea of a gold ETF is basically, ETF is a type of a mutual fund itself. We've already established that. Okay, so gold ETF is a commodity type of a ETF. That's the first point. Second, rather than investing or paying money and purchasing the physical gold, wherein you have to pay taxes on that, you're concerned about purity of the gold, etc. Rather than doing that, you can invest and purchase these gold ETFs itself. In simple terms, you can simply say that gold ETF is nothing but dematerialized gold. Again, the term dematerialization is very common in case of the market as such, that is stock market, equity market, debt market, etc. Why? Earlier, whenever we traded, let's say bonds, the equity, etc., these particular instruments had a physical form. Imagine I sold a share of a company XYZ to you. You will purchase and give me the money. I used to literally give you a physical form, a piece of paper that was a share. But later, rather than having physical forms of these instruments, we have a dematerialized. That is, the digital representations are provided. The term that they use is a dematerialization. Okay, so rather than using the term dematerialization, in short, they will also use the term demat. Now, idea here is rather than investing and purchasing the physical gold, you can purchase the dematerialized form of gold, which is called as a gold ETF. These particular gold ETFs generally as an instrument of investment are recommended to those investors who wish to invest for a shorter duration. Because just like stocks, these particular gold ETFs are listed in the stock market. These are passive investments. Right? What do you mean by passive investments? There is no active involvement over the value of the asset as such. You simply purchase this particular ETF. The value of this particular ETF is dependent on the market price of the gold. Is it okay? This will basically track the market price of the gold. If the market price of the gold increases, your ETF value also increases. If the market price of the gold decreases, your ETF value will also decrease. Right? Hence, this is generally referred as a passive type of investment. So these particular ETFs are issued. One ETF is equal to 1 gram of gold. You can invest, hold it for any duration you want, and sell them in the market. Generally, these are used or these are recommended for those particular investors who want to invest in the gold for a shorter duration. And these are listed in the stock market. So the market price of the gold will dictate the price of the gold ETF in the market. After purchasing this particular gold ETF, the investors will be getting gold in the dematerialized form or an electronic form. Investors can buy and sell these particular gold ETFs because these are listed in the stock market just like the shares. Investors, after let's say the sales is done of these particular ETFs, investors will get cash equivalent to the market price of the gold, and investors are not given the equivalent grams of the gold. For example, let's say I've purchased 1 gram of gold, right, in the form of a gold ETF. That is one gold ETF I purchased, which is equivalent to 1 gram of gold. After selling this in the market, after let's say the unit time period is over, the returns are given in the form of market price of the gold and not in the physical form of a gold. Remember, this is the concept of a gold ETF. In addition to gold ETF, I mentioned that there is one more type of an instrument that is available for investors to beat inflation in the market when they want to invest in gold. That is the concept of sovereign gold bond or SGB. Now, the important context of SGB. These are issued by RBI. That's the first form. These are basically issued in the form of gold. That is, rather than purchasing, let's say, grams of gold in the market, you could purchase these particular SGBs. The smallest value of the smallest denomination or the smallest value of these particular sovereign gold bonds will be 1 gram of gold. And this can increase. And how much SGBs in terms of gold can you purchase varies from one type of an investor to another type of investor in the market. So these are important for a simple reason. Government says rather than investing in physical gold, being worried about paying taxes on this, being worried about the purity of this, right? Having to store this particular gold, worrying about the security of the gold, we can simply invest and purchase this particular sovereign gold bond, wherein you don't have to pay taxes. Right? Certain types of tax exemption is given on this particular sovereign gold bond. You don't have to be worried about the physical storage of the gold. You don't have to pay taxes when you purchase this. You don't have to be worried about the purity of the gold because the gold is not given in the physical form. Rather, it is given in the form of a bond. That is a sovereign gold bond. The bonds are sold through places, offices, or the branches of nationalized banks, scheduled private sector banks, scheduled foreign banks, designated post offices, etc. And on these particular bonds, there is a fixed coupon rate or fixed interest rate. Remember this, right? A fixed interest rate of 2.5% per annum is given, and the tenure of this sovereign gold bond is 8 years. Is okay? The tenure of these sovereign gold bonds is 8 years, but after the lock-in period of 5 years, you can simply liquidate, sell off this sovereign gold bond, but the taxation advantage that you would enjoy will not be provided to you. These securities are eligible to be used as a collateral for loans, financial institutions, and non-banking financial institutions or non-banking financial companies, etc. So these are some of the very, very important points with respect to sovereign gold bonds. Now, some of you will be basically confused, saying that sir, there is already a gold ETF. Then, right, what is the idea of a sovereign gold bond? Why two different types of instruments? What is the difference? Gold ETFs are issued by separate entities. Sovereign gold bonds are issued by RBI. That is one important difference. Second important difference is, in case of gold ETF, there is no returns in the form of a coupon rate, whereas in case of sovereign gold bonds, there is a fixed rate of interest of 2.5% that will be earning on this. Third very important difference is the gold ETF is generally for a short duration investment, and the sovereign gold bonds is for a longer duration investment. The gold ETFs can be purchased and sold right throughout the day in the market. Right? On real-time basis, you can purchase and sell them. Whereas in case of sovereign gold bonds, there is a lock-in period of 5 years. Right? The actual tenure is 8 years, but at least for 5 years, you will have to have a lock-in period in case of sovereign gold bonds. These are the important differences between the gold ETFs as well as sovereign gold bonds. Next concept within this is the idea of P-notes, participatory notes. Now, the basic concept here is P-notes stands for participatory notes. First point, these particular participatory notes are referred as P-notes, are PNs, are financial instruments which are required by the investors or hedge funds to invest in the Indian securities without having to register with the Securities Exchange Board of India. What is the meaning of this? Let's look at the picture, then we'll go back to the previous slide. Imagine here is a foreign institutional investor which is registered with the SEBI, Securities Exchange Board of India, and because it is registered, it has been given the approval. FII is allowed to invest in the Indian stock market. But in addition to this FII, there are foreign investors X, Y, Z. Okay, either this could be an institution, individual investors, companies, whatever it is. They want to invest in the Indian stock market, but their concern is they will have to be registered with the SEBI. The time taken for registration, right, is lengthy. The documentation requirement is a cumbersome process. So what they want to do is they want to invest in the Indian stock market. They want to purchase, let's say, shares of a particular company, but they do not want to go through the regular route of KYC norms under SEBI. It is a time-consuming process. It is a cumbersome process. Documentation requirement is long, etc. So for whatever reason, they do not want to go through the KYC norm, but they want to invest in the Indian stock market. For these types of investors, there is a route called as a P-note route or participatory note route. What happens in a participatory note? Here is a foreign financial institution. It will collect the investments. It will collect the money from these foreign investors, invest in the Indian stock market. But please understand, these particular foreign investors, when they will hand over the investment, when they will give the money to this particular foreign institution, they will be issued with an instrument. This instrument is called as participatory note. I will repeat the process here again, understand this very carefully. The foreign institution or foreign investor, foreign company, individual, etc. They want to invest in the Indian stock market, but without going through the KYC route of SEBI. For these types of investors, right, the foreign institutional investors which are already registered with SEBI, they will collect the investments from them and issue certain instrument. That instrument is called as a participatory note. That's the first point. Second point, all of this is happening outside India. Is okay. Here is a foreign investor and this is a foreign institution. So the transaction is happening outside India. So this will also be referred to as offshore instrument. Right now there are two terms here. One is called as offshore. Second one is called as onshore. What's the basic difference here? Whenever you use the term onshore, it simply means within the domestic market. Offshore means outside the domestic market. That is outside the territory. For example, if any transaction happens within the Indian territory, this becomes part of what? Onshore. And if it is a transaction which happens outside the Indian territory, for example, bonds are issued. Instruments are issued outside Indian territory. These are called as offshore issues, offshore instruments. So understand this, right? Because this is a foreign financial institution and this is a foreign investor, and the funds are transferred from the foreign investor to foreign financial institution. This is an offshore transaction. Hence, the instrument which is issued by the participating note is also an offshore instrument. Okay, so understand the concept here. Let's go back to the definition now. Right, what are participating notes? Participating notes are referred to as P notes or PNs. These are the financial instruments which are issued by the institutions to the foreign investors. And because these are issued outside India, these will also referred to as offshore instruments. Right now, with respect to P notes, over a period of time, lakhs and lakhs of crores of rupees have flown into India in the form of P notes. That is, without coming under the KYC norms, foreign investors have been able to make huge amount of investment in the Indian market. But over a period of time, there are certain concerns which have been raised with respect to, let's say, potential misuse of these P notes. Right, what is the potential misuse I'm referring to? Imagine here is an investor, XYZ, and he is a domestic investor. Okay, he is from India. Right, and let's say he has got a lot of black money. What do you mean black money? Black money refers to that amount, the source of which is unknown for the government and on which government has not collected any tax. Okay, that is the idea of black money. Now, he has got a lot of black money. If he makes a direct investment in the Indian stock market, one or the other day, he will be caught. He has to provide details of from where the money has originated. He has to provide the source of the funds. But rather than doing this, can he basically transfer this particular money through money laundering process to, let's say, his friend who is sitting in America? This particular friend, yes, he will purchase P notes and route the investments back into India. Is it possible? Yes, it is a possibility. Okay, understand the problem here. The problem which has been raised by various experts is that the money laundering process can be used. Money laundering essentially means it's a process which is used to convert black money into white money. So money laundering process can be used to rig the price of the shares. Okay, price rigging can be done. I'll explain this in a minute. Or black money can be routed back into India and investment can be done in the stock market. First thing, right, how issue of black money arises, we have explained this. What is the problem with respect to price rigging? What is price rigging and what is the problem? Let's try and understand this. Imagine there's a company, XYZ, and I'm the owner of the company. You and me are negotiating. You want to purchase, let's say, 20% of the shares of my company. What if to sell these particular shares at a much higher price? What if I do like this? I will take the investments, give it to my friend who's sitting in America. He will approach a foreign financial institution, hand over the investment to this FII. This FII in turn will start purchasing shares of the company XYZ. That is my company shares in the market. And when this particular company starts demanding and purchasing more and more shares of company XYZ, the market price of the shares will increase. When we started negotiating, let's assume the market price of share was 100 rupees. You wanted to purchase 20% of the shares. So based on the market price, you would arrive at a particular price or the final value. But what if by the time negotiations begin, because there's a high demand for the shares of the company XYZ, market price tend to rise up from 100, let's say, to 110 rupees. So I will basically tell you that if you want to purchase the shares now, you'll have to purchase at 110 rupees, not at 100 rupees. So the P note route can be used to rig the stock prices in the market. That is also potential for misuse of the P notes. And that is the precise reason, right? Over a period of time, there have been certain reforms which have been introduced, certain measures which have been taken in order to control the potential misuse of these P notes. For example, some of the recent guidelines are one, the transfers of the P notes can be done only after the approval of the issuer, only to those who are on the pre-approved list. This particular transfer can be done. The issuer must submit information regarding who controls the management of P note subscriber. What is the meaning of each of the three statements? Let's try and understand this. Here is a FII. Okay, it is under the SEBI KYC norm. So FII is issuing a P note. It is collecting investments or money from, let's say, person X. Now, if this particular person X wants to transfer, wants to give away this particular P note, sell it to someone else, then let's say, right, to why they want to transfer this particular P note, why has to be in the pre-approved list of this particular issuer of P note, right? And that is important. Why? Because FII is registered with SEBI. FII has given this particular data to SEBI. All the relevant information is there with the SEBI. So SEBI is trying to ensure that these particular P notes are not misused by the domestic investors themselves to route, let's say, black money. Right, so to whom the P note will be transferred, that particular person or entity should be there in the pre-approved list of FII. Second very important, right, guideline is the issuer, which is an FII now, will be submitting the information regarding who controls the management of P note subscriber. In this particular case, who is the P note subscriber? Yes. What if X is a company? Right, what if X is a company? Right, then who is right, controlling the management of this particular company? Is okay. Who is controlling the management of this particular company? This information has to be submitted by the FII to SEBI. So these are the recent guidelines which have been introduced by RBI, SEBI, government, etc., to control the potential misuse of the P notes. Then the next point of discussion in this particular module will be different types of bonds which are there in the current affairs. Let's have a discussion regarding some of these particular bonds. Now, let's discuss the first type of a bond, additional tier 1 bond, or in short, AT1 bond. Now, the concept of additional tier 1 bond, let's try to understand it under Basel guidelines. I hope you remember the concept of banking. Under banking, we discussed Basel 1, Basel 2, and Basel 3. And recently we have started implementing Basel 3 till 2023 is the deadline. In case of Basel 3, the banks are supposed to meet certain capital adequacy norms, which is called as capital adequacy ratio guideline. And under capital adequacy ratio, they're supposed to meet certain level of a tier 1 capital. This particular tier 1 capital is divided into common equity tier 1 as well as additional tier 1. Is okay, repeated. Under Basel guidelines, Basel 3 which is being implemented now, the banks are supposed to meet the capital adequacy norms. That is called as capital adequacy ratio or credit to risk weighted assets ratio. Okay. Now in this particular context, the tier 1 capital requirement is 9%. In case of under Basel guidelines, it is 8%. RBI has mandated it to be 9% for commercial banks. For public sector banks, it is 12%. Now within this tier 1 capital and there is tier 2 capital. Tier 1 capital is divided into two parts: one common equity tier 1 and additional tier 1. They are supposed to have certain common equity tier 1 capital as well as additional tier 1 capital. In order to allow the banks to meet the AT1 norm, additional tier 1 capital norm, RBI has allowed the banks to issue bonds which are referred to as additional tier 1 bonds, or in short, AT1 bonds. Now the special features of this particular AT1 bond. There's a particular reason why I picked up this particular AT1 bond. The AT1 bonds are perpetual bonds. Remember this. What do you know perpetual bonds? Generally, when we discuss bonds, we say that what is the maturity period or what is the time period or the tenure of the bonds is fixed. Before issuing the bonds, the government, right, banking sector, corporates, etc., they will tell you what is the tenure of this particular bond. Is it 5 years, 8 years, 14 years, 20 years, etc. What is the tenure of this particular bond is well known to you before investing. But in case of additional tier 1 bonds, there is no maturity period. These are issued by the banks, right? These are allowed by RBI, issued by the banks, and they will be present in the market as long as the issuer, that is the bank, repurchases them or recalls these particular bonds. Is okay? I'll repeat it. These particular bonds are issued by the banking sector and these will be present in the market as long as the issuer recalls these particular bonds. Is okay? Right? And there is no mandate on the issuer as to when they're supposed to recall these particular bonds. Generally, the tendency of the banks is that once every 5 years or 10 years, these particular bonds are recalled by the issuer, and it is not a compulsion. Remember this. It is not a compulsion on the issuer. After 5 years is over, they might feel that okay, we have sufficient amount of capital. Let's recall these particular bonds. After 10 years, they might do it, or after 15 years, they might do it. But generally, the convention is that after 5 years or 10 years of the issuance of the bonds, these are recalled. Even if they don't recall, you cannot force them to recall. You cannot sell it or give it back to the issuer like this. Then hence these are called as perpetual bonds. That's the first very important point. Second very important point is, in case of these particular bonds, the coupon rate is announced, but in certain cases, understand this, in certain extreme situations, for example, the bank is incurring a loss. In certain extreme situations, the coupon amount may not be paid. Remember this. The bank may simply skip paying this particular coupon rate to the investor. Okay, the bank may simply skip repaying right, or paying this particular coupon rate to the investor. And if the situation continues, the bank continues to incur losses like this. In much extreme situation, the bank will simply decide not to repay the principal amount itself. That is, let's take a simple example. I'm the bank. I've issued right, an additional tier 1 bond to you. You purchase this particular AT1 bond. I'm supposed to pay a certain coupon amount to you annually. If I'm incurring losses for a certain period of time, I may simply say this year I'm not going to give you the coupon amount. And in extreme situations, right, I may simply say the principal, that is 100 rupees that you have given to me, I will not give you the principal also back. Right? I will simply write off the value of the additional tier 1 bonds. Right? Is it okay? Right? This is called as the special features of additional tier 1 bonds. Now, some of you will be thinking, sir, if there's so much of a risk involved in investing in these particular AT1 bonds, right? Why are the people investing? Why are the institutions actually investing in these particular AT1 bonds? There's a catch here. Because there is a higher risk involved in case of these particular additional tier 1 bonds, the coupon rate announced will also be comparatively higher. Is okay? I'll repeat it. Because in case of these particular additional tier 1 bonds, the risk component is higher. The coupon rate that is announced or that is paid on this is generally higher. That will act as an attractive measure or attractive point for the investors to invest in additional tier 1 bonds. So this is one type of a bond. Okay, next concept is green bonds. In the recent times, the concept of green bonds is becoming very, very famous. To begin with, the idea of green bonds originated post 2007-8 in the global market. More and more international agencies, more and more banks or financial institutions are actually issuing the concept of green bonds. Now, what is the idea of a green bond here? Okay, whenever you issue these particular bonds or debt instruments in the market, you'll be able to collect a certain amount of money, and whoever has issued these particular bonds is going to guarantee that this particular amount or money that is collected will be used for environment-friendly projects. Is okay? I'll repeat it again. Right? The name itself will give it away. In concept of the green bonds, what actually happens is whenever these particular bonds are issued, the money is collected, and that particular money will have to be earmarked, will have to be used only for green projects or environment-friendly projects. For example, the wind energy projects, solar energy projects, etc. So that is the basic idea for green bonds. Right? And the funds raised to this are earmarked only for such projects. Although the green bonds is becoming very famous in the recent times, please understand there are certain issues. For example, generally the coupon rate on these particular green bonds is said to be higher, and that becomes a burden for the issuer of these particular green bonds. But however, in recent times, the demand for the green bonds is actually increasing. Issuance of the green bonds is actually increasing. Why? More and more countries are worried about the environmental impact of the growth. More and more companies are moving towards the concept of a corporate social responsibility. They want to improve their image by investing in environment-friendly projects. And in case of India itself, in the recent times, there has been revived emphasis or increased emphasis that has been given by the government of India to promote environment-friendly projects. For example, in case of renewable energy projects itself, government of India set up a target of having 175 gigawatts of production capacity in case of renewable energy. And by 2022, this is a target. And by 2030, we want to further more than double it to 450 gigawatts of production capacity. So obviously, more and more green financing is required. Infrastructure financing for green projects is required. So green bonds is going to become much more famous in the coming days. Okay. So this is a discussion with respect to green bonds. Next, masala bonds. And what is the idea of masala bonds? First and foremost, right? Understand this. Masala bonds are issued in the overseas market, in the outside market. So obviously, I use that offshore instrument. Second, right? These particular bonds are famous for a simple reason. These are issued and repaid in rupee terms. Okay. These are issued and repaid in rupee terms. What's the logic here? Imagine you're an investor sitting in US. I'm an Indian company. I will issue bonds to you in terms of dollars, pay the coupon in terms of dollars, repay the principal amount in terms of dollars. But whenever I borrow and I repay in terms of dollars, there is a risk, exchange rate risk that I have to pay. For example, imagine I simply borrowed $1 from you today. So today the exchange rate is $1 equal to 50 rupees. After 1 year, I'm supposed to repay this particular $1 to you. So at that particular point of time, what if the exchange rate is $1 equal to 60? So I have to pay up 60 rupees, get $1 and pay that particular $1 to you. But because of exchange rate volatility, I'm going to bear the burden of exchange rate risk. To overcome such issues, there are instruments which are referred to as masala bonds. And masala bonds are part of external commercial borrowings itself. So in case of masala bonds, what will happen is rather than issuing the bonds in terms of dollars, I will go to the overseas market, issue the bonds in terms of rupees only. That is, let's say I will sell the bonds for 100 rupees, and the investor will have to convert his currency into rupees, invest in these particular bonds, and the repayment, coupon payment, everything will be done in terms of rupees itself. As a result of this, in such cases, the investor will bear the burden of the exchange rate risk, not the issuer. Until these particular bonds are issued in a foreign currency, right? Let's say dollar or any other currency, the issuer will bear the burden of this. Whereas in case of rupee denominated bonds, that is masala bonds, the investor will bear the burden of the exchange rate risk, not the issuer. Now you will simply raise the question, so if the investor is bearing the burden of exchange rate risk, why will he invest in such bonds? That is right, for a simple reason, the coupon rate on these particular bonds is generally higher. And because the coupon rate is higher, for example, in case of the US market, generally the interest rates are in the range of 2% to 3%. So I'm going to enter into such market because generally the masala bonds are issued in developed economies, not in developing economies. Issuer is from, let's say, India, but he's going to issue these bonds in developed countries where the interest rates are lower. I'm going to enter into that market, offer an interest rate of, let's say, 7%, 8%, 9%, whereas the prevailing interest rates in that market is 2 to 3%. So the investor will be attracted by the higher coupon rate or higher interest rate. But there is one condition: the investor has to bear the burden of the exchange rate risk, not the issuer. Now, apart from this, why these are called as masala bonds? Why specifically these are called as masala bonds? Because the convention, right, the rule is that whichever country's currency, right, is the denomination. That is, the bonds are issued either in the form of a rupee, in the form of a yuan, in the form of a, let's say, any other currency. A feature of that particular country has to be used in the name itself. Is it okay? I'll repeat it. Issuing bonds which are issued in the form of a rupee, so I will have to use a feature of India to represent the name of these particular bonds. And in case of history, especially modern Indian history, you know this, right? The term masala is more associated with India. So the argument here is, if I'm issuing a bond in the US market in terms of a rupee, repayment is in terms of rupee, coupon payment is in terms of rupee, I'll call these bonds as masala bonds. I'll give you another example. Right? There are bonds called as baklava bonds. Baklava is a delicacy in Turkey. So obviously, when the companies from Turkey issue these particular bonds in developed economies, they're issuing it in domestic currencies. Hence, usage of the name baklava. Right? There are some bonds. Okay, samurai bonds. Samurai is a sport that is associated with Japan. Right? So whenever these bonds are issued, these will be issued in terms of yen. Right? So there are dim sum bonds. Dim sum is a delicacy, food that is eaten in case of China. Right? So when these dim sum bonds are issued, these are issued in terms of yuan. Right? So a particular characteristic or feature of a country is used to represent in the name. And looking at the name itself, you will realize, okay, these are the bonds which are denominated in rupees, yuan, yen, etc. And in addition to this, RBI mandates that the original maturity period is 3 years. Right? In case these bonds are issued is of up to 50 million, and right over and above that, the maturity period will be 5 years. Okay, so these are some of the very, very important points in the context of masala bonds. Now let's have a discussion related to corporate bonds. Now before discussing what are the reforms taken by both RBI as well as government of India, let's try and understand what are the issues in the corporate bond market. What are the very important issues? Please be very, very careful with respect to this. Why? Why the corporate bond market is very important. Generally, it has been seen that for the corporates, for the companies in simple terms, they need long-term loans. Why do they need long-term loans? For shorter duration, let's say below 1 year, they have different instruments using which they can borrow. They can go to a bank, borrow for working capital. They can issue commercial papers. They can borrow for working capital. But beyond this, they also need long-term credit, long-term loans, and the requirement of long-term loans is very, very important, especially in infrastructure development. Or these particular corporates, let's say, if they want to purchase another company, acquire another company, expand the operations, purchase a lot of machineries from the market, for whatever reason, they would also want to borrow for a longer duration. And there are different routes which can be used, right, for different borrowers for long duration in the market. Earlier, in case of India, there were institutions which were referred to as DFI, Development Finance Institutions. For example, ICICI, which is a commercial bank today, earlier was set up as a development financial institution itself. There was a IFCI, IDBI, etc., which used to provide long-term loans in the market. And these long-term loans are very, very important, especially, like I said, in case of infrastructure development. And these institutions used to provide the long-term loans to these borrowers. And over a period of time, this kind of lending has come down in case of India. And that's the precise reason very recently government of India has proposed National Bank for Financing Infrastructure Development, NABFI, which we'll discuss later under infrastructure. So long-term financing, earlier we had DFIs, right? We have a bond market, but there are issues in the bond market. What are those issues? We'll discuss, just give me some time. Now, because there is no DFI or sufficient financing is not available through DFI now, bond market, there are issues. These particular borrowers who want to borrow for a longer duration tend to borrow from banking sector. And the issue with respect to borrowing long duration loans or for longer duration from banking sector is that banking sector is not well equipped to provide these kinds of loans. And for example, they would want to borrow huge value of a loan. Single bank doesn't want to do that because the risk will be very, very high. There are certain limitations with respect to lending which is imposed by RBI. So generally what happens is the banks will go for consortium lending. That is one issue. Okay. Second issue here is the banks, whatever money they lend for, let's say, long-term duration, they would have collected the deposits and they will use these deposits to lend for long duration. Okay, so bank doesn't use its own money. Bank has collected deposits from me, you, all of us, and will use these deposits, give loans for long duration. But the problem here is, when I keep a deposit in a bank, you keep a deposit in a bank, generally it is for a short duration or a medium duration. Generally, the maturity period of these particular deposits is said to be around 2 to 3 years. But for infrastructure development, they give long-term loans, 10 years, 15 years, 20 years, etc. So that creates asset and liability mismatch in case of the banking sector. Because after 2 years, they're supposed to pay the deposits back, but they have not collected the money from infrastructure development. That will create financial pressure on this particular banking sector, right? And that is basically captured in the concept called as asset liability mismatch. Now the question is, what are the issues in the bond sector? Why these particular developers, or let's say the corporates who want to take a long-term loan, are opting for a bank? Why not at the bond segment? These are some of the very important issues. First, most of the bond market is basically captured by government bonds. That is, most of the bonds which are sold, purchased, or traded in the market are government bonds. So let's look at this particular table here related to corporate bonds. Now, one statement that generally says the penetration of corporate bond market in case of India is very, very poor. What is the meaning of this? Let's have a look at the table here. In case of a developed economy such as USA, although the data is given here, please do not mug up this particular data. Understand the concept here. In case of a developed country such as USA, for every $100 worth of GDP, the bonds issued by the government, that is the treasury, which is issued by the government, are worth of $83. Is okay? Are worth $83. Whereas on the other hand, the corporate bonds, this stands for government bonds, this stands for corporate bonds. The corporate bonds issued stand at $123. What is the meaning of this? There's a huge amount of money or borrowing that is done by the corporate market in case of USA, and this is considered to be a good feature in the context of a developed country for a simple reason. Whenever the corporates borrow heavily from the market, it is an indicator that they are going to produce more, they are going to sell more, they are going to create more employment, and all of this is going to add to economic activity leading to higher GDP. So in a developed country, generally what you see is the corporate bond market is a favored route of borrowing for the corporate sector. Whereas if you see a country such as India, what you see is majority of the issuance in the bond market is because of the government bonds itself. In context of this particular table, for every 100 rupee worth of GDP in case of India, the government bonds issued stand at 41 rupee and the corporate bonds issued stand at 21 rupee, which essentially translates to what? The government bonds issued are almost twice the value of corporate bonds issued in the domestic market. Hence, we simply use the statement saying that penetration of the bond market in case of India is very, very poor. And which bond market are we referring to? Corporate bond market. So what are the issues in the corporate bond market? Well, most of the bonds issued are of government bonds itself. Government securities are very, very high. Second issue here is the long-term investors such as pension funds, insurance funds, etc. These generally invest in the bonds which have very high credit rating. Is it okay? They're mandated to invest in those particular bonds which carry very, very high credit rating such as a AAA, AA, etc. And most of these particular bonds which are issued in the domestic market do not carry this particular high credit rating. Thereby, these particular long-term investors who invest huge amount of money in the debt market do not invest in these particular corporate bonds. Rather, they invest only in those corporate bonds which have a very, very good credit rating. So the amount of investment, right, in all the other bonds from these types of institutions is very low. Third issue here is what are the retail investors? Even in case of the retail investors, as you and me, the retail investor participation in the debt market is very, very low. Right? When you compare it to other countries, developed economies, retail investor participation or the retail investor base in the debt market is very, very low, especially in case of the corporate bonds. That is another issue. Fourth issue with respect to this is even those particular bonds which are traded in the market are those particular bonds which carry a very good credit rating. I understand this. Even in the market, the trading happens for the bonds, buying and selling of the bonds takes place. Those particular bonds, especially from the corporate segment, which carry a very good credit rating, these are the favored bonds which are traded in the market. So the demand for the low credit rated bonds or the trading of such bonds is very poor or very low in case of India. Fifth, even those particular pension and insurance funds, right, which have invested, they'll simply hold on to these particular bonds till maturity. These are long-term investors, right? So they will purchase these particular very good credit rated bonds and they'll simply hold these particular bonds till they attain maturity. So the corporate bond market development is also very poor. So these are some of the issues. In addition to this, another very important issue is in case of repo operations, corporate bonds are not used. Is it okay? Corporate bonds are not recognized under the repo operations. So these are some of the issues which is plaguing the growth or the development of corporate bond market in case of India. And as we discussed earlier, you need to develop this particular corporate bond market. You need to have a very well developed or matured or a deep enough corporate bond market in case of a developing economy such as India. So in this particular context, what kind of reforms have been taken? Right? Both by government of India as well as RBI. Government of India actually has promoted development of many of these particular platforms using which the companies are being asked to issue bonds in the market, right? Are being asked to trade bonds in the market, etc. In addition to this, right, RBI has been promoting novel types or newer types of bonds in the market. For example, masala bonds, right, 81 bonds, right, green bonds, etc. And another important reform that has been taken by RBI very recently is the concept of targeted long-term repo operations. TLTRO. Now, what is a targeted long-term repo operations? Understand the concept here. Generally, when you talk about repo operations, okay, when you talk about repo operations conducted by RBI, you talk in the context of short duration. But RBI is also using these particular repo operations to promote transactions, right, for a longer duration, to allow the banks to borrow from RBI for a longer duration. And one such route or one such window that has been opened up by RBI to promote long-term lending to banking sector, which will aid the development of corporate bond market in India, is the tool that is a TLTRO, targeted long-term repo operation. What happens in a targeted long-term repo operations for this year? Under this particular window, banks are allowed to borrow from RBI. Is okay? Banks are allowed to borrow from RBI at a repo rate, not for short duration, but for long duration, 3 years. First point. Second point, any amount that has been borrowed by a bank under this particular route or under this particular window of TLTRO, the bank has to use this particular money to purchase or to invest in corporate bonds. Right? Essentially, the bank has to purchase the corporate bonds in the market using this particular money which they borrow from RBI. That's a condition that has been imposed by RBI. Now, can they purchase any type of a bond from the corporate bond market? No. RBI mandates that only those particular bonds which will have an investment grade, only those particular bonds can be purchased by the banks from the money that they borrowed from RBI under TLTRO. And what's the advantage of this? The advantage of this is in recent times there has been a lot of pressure in the corporate segment because of the pandemic. Right? The government finances are under pressure. Corporate finances, right? It's nothing different. They're also under a lot of pressure. And you want to promote the growth in the corporate segment. You want to ensure that the companies will be able to borrow from the market. They'll be able to sell the bonds in the market, collect the money, and invest. Right? In this particular scenario, if there is a continued pressure on these particular finances of the corporate, that might lead to certain unsavory situations. To provide certain liquidity in the corporate bond market, to increase the demand for the corporate bonds in the market, RBI has introduced this particular window of TLTRO. Right? So these are some of the very recent reforms that have been taken by the government as well as RBI to promote the corporate bond market in India. Now, in addition to this, another very important concept, right? Committee recommendations in the context of the financial market is a Sri Krishna Committee report, or famously referred to as the Financial Sector Legislative Reforms Commission. Now, understand the background here. The FSLC Commission or FSLC was established or set up by the government back in the year 2010 and 2011. This was announced in the year of 2010 and 11. And the objective was to basically rewrite the whole guidelines or whole structure of the financial system in India. Because it was found that at many places there was a conflict between different financial regulatory agencies or financial regulatory institutions, and there were certain loopholes in the system. There were certain gaps in the regulation system. Right? To address these issues of overlap of regulatory function or gaps in the regulatory function, government basically set up this particular committee, which is known as FSLC or Justice Sri Krishna Committee. Now, what are the recommendations given by this particular committee? Right? Apart from this, a resolution notifying FSLC was issued in 2011. The FSLC was given a duration of 2 years. It has given huge number of recommendations, right, to basically restructure the whole financial system in India. These are certain factual information points. What are the recommendations? What recommendations have been provided by FSLC? Let's have a look at it. Some of the very important recommendations are: one, the committee recommended that RBI should be allowed to continue with the regulatory functions over the banking sector. Okay, the monetary policy committee or monetary policy function, the regulation of the banking sector, etc. The powers should be continued with RBI. That's the first recommendation. Second, there are multiple regulatory agencies. Okay, there are multiple regulatory agencies such as SEBI, FMC, IRDA, and PFRDA. SEBI stands for Securities Exchange Board of India. FMC stands for Forward Markets Commission. IRDA, Insurance Regulatory Development Authority. PFRDA, Pension Fund Regulatory Development Authority. Rather than having multiple regulatory agencies like this, why don't we merge all of them? Have only one agency, unified financial agency. And what's the advantage here? Rather than having multiple agencies, if you have only one agency, there is no gaps in the regulation or there is no overlap in the regulation. Right? So only one agency. That was the recommendation. Now, although I mentioned FMC as a separate entity or regulatory agency, please remember this: FMC is already merged with SEBI. Next one, Securities Appellate Tribunal. Right? F side. Right? Rather than having a simple Securities Appellate Tribunal, you must have a Financial Securities Appellate Tribunal, which will hear appeals against, let's say, Reserve Bank of India, Unified Financial Agency, as well as a Financial Redressal Agency. Now, question is, what is a financial redressal agency? Right? There are insurance companies, pension companies, stock brokerages, etc. With respect to their functioning, there will be certain consumer grievances, consumer complaints. So there has to be someone who will handle the consumer grievances or consumer complaints. In such situation, it recommended FRA, Financial Redressal Agency, which will handle the consumer complaints against these particular institutions or agencies. Now, if there is a further requirement, right, if the order has been issued by this particular FRA, it has to be reviewed. For this, it recommended FSI, Financial Securities Appellate Tribunal. Okay. Next up, it recommended Resolution Corporation. What is the Resolution Corporation? Right, under IBC, we are handling the insolvency resolution of corporate entities. Right, we are having a retail borrower default insolvency resolution. Very recently, we added financial service providers. But the argument here is you must have a unified framework with respect to handling insolvency resolution, even for financial institutions. As of now, what happens? If there is issue in the banking sector, RBI handles it. If there is issue in case of, let's say, insurance company, IRDAI is there. Right? Although we have introduced an amendment under IBC and we are covering those particular financial institutions with assets of 500 crore rupees are covered under this. Although we have covered the financial service providers who have asset sizes of over 500 crore rupees, and these have been ranked under IBC, are covered under IBC. Now, this committee recommends that there has to be a unified framework, unified resolution, right, for all of these financial institutions, like we have under IBC. That's the recommendation. And for this is recommended Resolution Corporation. And next up, right, there is a council called the Financial Stability and Development Council, which has been set up because of Raghuram Rajan Committee recommendation back in the 2008. It was set up in 2010. This is headed by Finance Minister, and this has all the regulatory agencies of the financial system as its members. The role of FSCC is to promote financial inclusion, to take care of the risk associated with the financial market, etc. This committee recommended that the statutory status should be given to FSCC, and the powers or the role of FSCC must be enhanced. And finally, with respect to debt management, an independent debt management agency has to be set up. So these are the recommendations of FSLC or Shri Krishna Committee with respect to restructuring or reforming the financial market in case of India. So these are the various issues that are of importance within the financial market. That's the end of the discussion of the financial market module. Next article is with respect to zero coupon bonds. Now, this article basically discusses certain concerns which have been raised by the central bank, that is RBI, with respect to the zero coupon bonds which have been issued by Government of India. Now, let's discuss certain very important points, then take up the article. First and foremost, what are zero coupon bonds? Understand the concept here. In case of a zero coupon bond, generally, underline the term generally, what happens is these particular bonds are issued at a discount and are redeemed at a face value. What do you mean by this? Let's take a very simple example. In case of a bond, if the face value is 100 rupees, if I'm issuing this particular bond to you people at 100 rupees, and if I guarantee 10% returns on this, so after 1 year, let's say, I will not only give you back the face value of 100, but I will also give you a return of 10 rupees. So you will receive how much? 110 rupees. So this is a concept wherein bond has been issued at a face value and are redeemed at the amount. But in case of a zero coupon bond, what happens is, in case of a zero coupon bond, these are not issued at a face value, rather they are discounted. Means the face value is 100, I might sell the bond to you people at 90 rupees. So you have given me how much? 90 rupees. After 1 year, I will give back the face value to you. What's the face value of the bond? 100 rupees. So for you, the return of 10 rupees is earned. And this is a basic idea of a zero coupon bond. So in essence, coupon rate is zero, but that doesn't mean that you will not earn any interest. Generally, in case of a zero coupon bonds, these are issued at a deep discounts and are redeemed at the face value. This is a basic idea of zero coupon bonds. That's the first very important point here. Second very important point, government, in order to provide capital to public sector banks, introduced the concept of recapitalization bonds. Under this particular concept of recapitalization bonds, what government earlier used to do is issue bonds to public sector banks, collect the money, and use this particular money to provide capital to public sector banks. In essence, what will happen in case of PSBs is now they're having a bond, let's say, worth the value 100 rupees. In addition to this, they will also have a 100 rupee infusion of capital from Government of India. And in return, PSBs would be providing equity to Government of India. So this was the basic practice of recapitalization bonds which are used by Government of India to infuse capital in the banking sector. Now, this particular practice of issuing recapitalization bonds started in the year 2017 and 2018. And since this recapitalization bonds carried certain coupon rates or interest rates, the amount of interest which was paid by Government of India to the banking sector started increasing, and this started becoming a burden for Government of India. To address this particular issue, Government of India introduced a concept of a zero coupon bonds, which they started issuing to the public sector banks. Very recently, these particular bonds worth 5,500 crores were issued in case of Punjab and Sindh Bank. Now, what is the issue here? Please understand, unlike the earlier zero coupon bonds, these particular zero coupon bonds which have been issued by Government of India have been issued at par to the banks, and there is no interest which would be paid by government in case of these particular bonds. Not only this, these particular zero coupon bonds are not tradable. These are not tradable. The banks will not be able to trade or sell these particular bonds in the market. So I guess this particular issue of Government of India issuing the zero coupon bonds to recapitalize the banking sector, RBI has raised a concern. The concern of RBI basically is with respect to present value of these particular bonds. Now, this idea, the bank which has a subscriber for these particular zero coupon bonds will be receiving face value, let's say, of 100 rupees, just hypothetical number, from Government of India, let's say after 10 years. So the bank will be receiving this 100 rupees, let's say, after 10 years. In addition to this, Government of India, what does it do? Collect, let's say, amount from this particular bank by selling the bond and infuse the capital into the bank. So, as per Government of India, it has infused the capital worth 100 rupees into the bank. But RBI basically says, since these particular bonds are valued in the future, that is basically the bank will be receiving this 100 rupees in the future, there is no guarantee with respect to how much is the actual infusion of the capital in the banking sector by Government of India. So there has been this particular concern which has been raised by RBI, both the Government of Indian officials as well as RBI are working to address this particular issue. Another very important point mentioned in the article is, for this particular fiscal, Parliament has approved recapitalization worth 20,000 crore rupees of this. Government of India basically issued recapitalization bonds worth 5,500 crore rupees. And so far, Government of India in the last 3 years has infused recapitalization of worth 2.5 trillion into the banking sector. So these are certain points with respect to zero coupon bonds given in this particular article. Now, based on this discussion, given question here, consider the following statements regarding zero coupon bonds. Are issued only by the government? No. Can be issued even by the companies also. These are issued at a discount and are redeemed at face value. Generally, yes, this particular statement is true. Hence, the option B is the right option. The most important article which basically grabbed eyeballs in the is basically Sensex crossing 50,000 points. Now, why this is important? We have a discussion related to this particular article, please do not be worried about the graphical representation which is given in every newspaper. First and foremost, what do you mean by Sensex? Sensex basically stands for sensitive index. Now you'll ask me, sir, what do you mean by sensitive index? Now please understand this. Just like in most of the economies, even in case of India, we have something called as stock market. In case of India, the two very important stock markets are one, BSE, Bombay Stock Exchange, and the second one is NSE, National Stock Exchange. In case of BSE, the sensitivity index in short form is referred to as Sensex, whereas in case of the NSE, it is referred to as Nifty. Now, let's focus on the first one that is very important for us. In case of the Sensex, what we basically do is we calculate the market capitalization of the 30 companies. I repeat, in case of the BSE Sensex, we calculate market capitalization of the top 30 companies. Now, when I say top 30 companies, not based on any indices or any parameters, basically there is a committee set up. This particular committee will choose the 30 companies which are traded for the most period of time in terms of the shares in the last 1 year. So do not worry about how those are chosen. What you need to understand simply is this. Market capitalization is calculated by taking into consideration how many shares of a particular company are there and what is the market price of this particular share. Now, again, I know some of you people will say, sir, there's a concept of a floating share, right? Total share. Do not worry about all of it. Basically, idea is the shares which are issued by a particular company, some of these particular shares, that is basically the idea of equity, is owned by government when government is acting as a promoter, or if these are promoters, different promoters, private company promoters, if they are owning the shares, it is called as a promoter's equity. Or if there is investment by FDI, it's not considered. In a sense, whenever a company issues shares in the market, all the shares are not tradable in the market. Some of the shares are out of the stock market, which is not accessible to you or me for trading purposes. So that is the basic idea. So we exclude those particular shares. Other shares are called the floating shares. So we take into consideration those particular shares which are available in the market. What is the market price of this particular share? Multiply both of them, you get the market capitalization. So take the market capitalization of 30 companies. What is the market capitalization of today? Let's say exactly at this particular point of time. Compare that with market capitalization in the base year. And for the calculation of Sensex, remember the base year is 1978 and 79. So for 1978, 79, whatever is the market capitalization of 30 companies, we'll take it pegging at 100 units and compare that with what is the market capitalization of these 30 companies today. Exactly right now. And as you know, the market prices of the shares of these particular companies will keep on fluctuating in the market, either increase or decrease. Whenever the prices will fluctuate, market capitalization will fluctuate. And when market capitalization will fluctuate, obviously the Sensex, as a sensitive index, will also keep on fluctuating. So this is basically how the Sensex is calculated. Now coming to the most important point. Why there was a break of this particular record level of 50,000 points in the Sensex very recently. Here are some of the very important reasons. For easy understanding, I've divided these particular points into domestic reasons or domestic causes and international causes. What are international reasons? What led to this particular hike or jump in the Sensex with relation to what happened in the international market? First and foremost, please understand this. There's a lot of liquidity in the international market. Many of these particular central banks are pushing a lot of money into their systems, and whenever there's a push of liquidity in the market, interest rates will start reducing. Now, how this is connected with the Sensex in India? Understand the logic here. There are investors who are referred as EFPIs, foreign portfolio investors. What these particular EFPIs basically do at this particular point of time is they will look at their market, the interest rates are coming down. They want to invest in the market, but the interest rates are lesser. Hence, they will take the investment, invest in emerging economies or developing economies such as India, where interest rates comparatively are higher. Or in simple terms, these EFPIs are in search of better returns, and in search of their better returns, they will simply take their investments, fly out from other countries, and fly into emerging economies such as India. And when they come into India, essentially, what will happen? They will invest in the stock market, start purchasing more and more shares. The value or the market price of the shares in India will keep on increasing. The Sensex will also start picking up. This is one very important reason. Second very important reason, there was a peaceful transition in the USA. Now, please understand how it is connected with India. Now, in case of the global markets, there's always a concept of a globalization. That is, what happens in one economy will definitely have an impact on other economies. For example, back in the year 2008, there was a crisis in USA. And when there was a crisis in USA, even the markets, other markets such as European market, Indian market, Chinese markets were affected by this particular global financial crisis. That is basically the idea of a spillover effect. Spillover effect basically means there are two different events which looks unrelated. I can understand that. There are two different events which are taking place. For us, they look unrelated, but because of the integration in the market, there is an impact of one event on the other event. This is the basic idea of a spillover effect. Now, because of this particular spillover effect, that is, there is a peaceful transition in USA, and the new government in USA is more oriented towards developing the global trade. Because of this, there was a lift in the investor sentiment, and this particular increase or improvement in the investor sentiment was exhibited in the way that there was more purchase of shares in the domestic market in India, and the prices started increasing. This is the second very important reason. Third very important reason, in the global market, there is a recovering demand. And as a statement here, in the global market, the demand is recovering. Now, this is exhibited by the fact that very recently, the prices of transportation, that is the cost of transportation, has started escalating, has started increasing, because the containers which are available for international transportation of goods or raw materials are not sufficient, and when these are not sufficient for basically transporting the raw materials, the demand is increasing, the cost or the prices of the transportation will start increasing, and this basically indicates that there is a revival of demand in the international market, and revival of demand in the international market essentially means there is a recovery in the global trade, and when there is a recovery, obviously we expect the economy to perform better. There is a higher demand for the shares of these particular companies in the market. So these are the reasons, that is specifically international reasons, that has basically lifted the stock market in India. What about the domestic reasons then? There has to be certain reason which has happened or which have taken place in the domestic market, as a result of which the stock market reached this particular 50,000 points. First very important reason, vaccination. In the last couple of days, I'm pretty sure all of you have read related to government of India's drive related to vaccination. Now, how vaccination is connected with the stock market? When there's vaccination for COVID, what is the expectation? The economy will start recovering. In the first quarter as well as the second quarter in the current fiscal, there's a contraction in the economy. Now, with vaccination, what do we expect? The economy to recover. When the economy recovers, GDP growth rate will start inching towards a positive territory. Obviously, this is a very good indicator for Indian economy. So this has boosted investor confidence in the market. That's the first very important reason. Second, the budget is going to be announced in the next couple of days. And when there's a budget announcement, what investors are expecting is government will provide huge amount of fiscal stimulus for economic recovery to take place. And this particular expectation of the investors basically is exhibited by higher demand for the shares in the market. Third very important reason, for the second quarter which has ended and the third quarter, the profitability of many of the companies, such as the software companies, has increased. Some of the companies have reported very good numbers. Not only this, some of the companies which are involved in the consumption or consumer goods. They also have reported that there is uptick, there is a higher demand for their goods and services in the market. All of this basically indicates that there is economic recovery that has been happening. And the next very important reason is basically the idea of momentum trading. Now, what is this idea of momentum trading? Understand the logic here. Generally, what we say in the stock market is buy low and sell high. That is, you should purchase the shares when the market prices of the shares are lesser, and you should sell the shares when the market prices of the shares are higher, so that you will make profits out of these particular fluctuation in the market prices. But against this, or contrary to this, there is a concept of a momentum trading. What it says is, when the market prices of the shares are increasing like this, the share prices are increasing. So you purchase the share at a particular price, and you sell this particular share when the prices are basically stabilizing. Let me give you a simple example. Imagine there's a particular company, the shares are being traded in the market prices are increasing. So when the market prices are increasing, you will purchase the share. Let's say hypothetically the share price is 400. When the market prices will keep on increasing, it will hit, let's say, 600 rupees. Again, just hypothetical number. It will hit 600 and it will start stabilizing at this particular number. Now, the momentum trading says sell it when it hits a stable price of 600. So basically, when the stock market is picking up like this in case of India, there are certain investors who are looking at the concept of momentum trading. They do not want to miss out on the profits there. Hence, they also jumped into the freight forum and started purchasing more and more shares, which essentially increases the prices of these shares. So these are the domestic reasons and these are the international reasons which have basically led to this particular Sensex crossing a very important threshold mark of 50,000 points. Now, is it more important? Is it so important that everybody's focused on this? Please understand this. Yes, Sensex is referred as a barometer of the economy, but please understand, this is basically, that is the 50,000 points which has been breached. Most of the reasons are speculative in nature. For example, I said that there is an expectation from the investors that government of India will provide a boost in the form of fiscal stimulus. Now, it is going to be shown in the budget whether the fiscal stimulus which is provided by the government, if at all it is provided, will it satisfy the investors or not. If it satisfies the investors, then maybe there is an uptick in the stock market. But if government of India provides very little stimulus because of the fiscal pressures that it is facing, or doesn't provide any kind of stimulus that is expected by the investors, then you might suddenly see there is a downward trend in the stock market. So most of the reasons are speculative in nature. That is the reason various experts have also raised certain concerns related to this particular stock market index number. What are the concerns? First, very recently there is a discussion related to another strain of a COVID. Now you do not know what is going to be the impact of this particular strain. Will it again spread like the COVID-19 and again have havoc on the Indian economy and other economies along with it? You do not know. You have to wait and see. You do not know what will be the stance of RBI, Reserve Bank of India, along with all the other central banks in the coming days. Because earlier I basically said there's a lot of liquidity in the market, but there are certain concerns related to this liquidity also. For example, in case of India, yes, RBI as well as government of India have taken many measures to increase the liquidity in the market, but there is only up to a certain limit that RBI can provide liquidity. Why? Because please understand this: when RBI promotes huge amount of liquidity in the market, money supply in the market will increase, and whenever there is a huge amount of money supply in the market, there are concerns of inflation. So this is another concern. So RBI might basically pull out the liquidity or stop providing liquidity, and investors might feel a negative approach related to this, and they might start withdrawing the funds from the market. There is also concern with respect to other aggregates in the economy or other aggregates. For example, exports. India's exports have not been very good. Our performance of it, India's exports has not been very good in the last couple of months, and this might basically throw the water on this particular news of the Sensex breaching 50,000 points. Or what about IIP, index of industrial production, index of 8 core industries, which have not been very fruitful for Indian economy. So basically, there are certain concerns which have been raised with respect to this particular Sensex number also. And finally, one very important concern. Please understand this. One of the reasons that Sensex breached this particular 50,000 marks on intraday trading was a huge amount of FPIs. But RBI has very recently stated that even this particular huge amount of FPI inflow that is happening is dangerous for India's exports. Now, these are connected. Understand the logic here. When the dollars are going to flow into India, can you invest the dollars in the stock market? No. You need to convert the dollars into rupees. Very simple. When you convert the dollars into rupees, basically supply of dollars in the market will increase, and the demand for rupees will also increase. So when this will happen, rupees will start getting appreciated. So when rupees starts getting appreciated, this will basically dent the competitiveness of India's exports in the international market. So these are some of the concerns related to this news of Sensex hitting 50,000 point mark. Now, based on this, I give a question here. Consider the following statements. To calculate BSE Sensex, the market value of shares of all the listed companies are considered. This statement is wrong. I've already mentioned 30 companies. Second statement. For the calculation of BSE Sensex and NSE Nifty, the base year of 1995 is used. Even this statement is wrong because in case of BSE Sensex, it is 78 and 79, 1978, 79. In case of NSE 50, it is 1995. And another point related to NSE Nifty, in case of NSE Nifty, they take market capitalization of 50 companies against the 30 companies in case of BSE Sensex. Based on this, option D, both are false, is the right option. Now, let's go to the last article of this particular week's discussion, that is related to LIBOR. First and foremost, what is the idea of LIBOR? To understand the concept of LIBOR, let me introduce another important concept to you. Concept of a MIBOR. Again, don't get confused, I have not made a spelling mistake here. There is really another concept called as a MIBOR. MIBOR stands for Mumbai Interbank Offered Rate. Now, how it is calculated? Not important. What is important is this: when one bank will lend it to another bank for a shorter duration. Understand the concept here. When one bank in India will lend to another bank for a shorter duration, these are unsecured loans. This particular bank will have to impose a certain rate of interest. That is, bank 1 is lending to bank 2 for a shorter duration, and these are unsecured loans. And since the first bank is giving a loan to the second bank, it has to impose a certain rate of interest. This kind of interbank lending generally will take place in a market called as a call money market. And this particular rate of interest which is imposed is basically dependent on or is calculated based on a concept called as a MIBOR. And MIBOR stands for Mumbai Interbank Offered Rate. Now, in the same way, in the international market also, one bank will lend to another bank. And basically, interbank lending and borrowing will take place. So, in the international market, what rate of interest will be determining this particular interbank lending and borrowing? That concept which affects the interest rates or lending rates in the international market, that is basically interbank lending, that concept is called as a LIBOR. LIBOR basically stands for London Interbank Offered Rate. And please understand, this concept of a LIBOR was very important until very recently. But there have been certain issues which are plaguing the concept of a LIBOR. That is basically, post 2008 global financial crisis, the transactions which are basically using LIBOR as a base for deciding the interest rates, these kind of transactions have started steadily reducing. And not only this, many of the banks have started introducing newer concept or newer interest rates to decide the lending rates, and the importance of LIBOR has been declining. And the biggest blow to the concept of LIBOR was the crisis in 2012. That was a scam in 2012, where it was seen that some of the participants who were submitting the data for the calculation of LIBOR were submitting false data, or they were rigging this particular LIBOR. And all of these particular points have basically led to a reduction in the importance of LIBOR. And finally, very recently it was announced that after 2021, the concept of LIBOR will be scrapped. So this particular article discusses what will be the impact of this. Now, please understand, even in case of India, some of the borrowings which are done from the international market, such as ECB, external commercial borrowing, or for that matter, FCNR deposits, which are linked to flexible or floating exchange rates or floating interest rates, these kind of borrowings, the rate of interest on this is affected or linked to the concept of LIBOR. And when LIBOR will be scrapped, it is said that we have to introduce a new concept, and RBI is in the process of determining a new concept which will affect these kind of lending between the banks or these kind of borrowings in the international market. So these are certain points which have been discussed in this particular article. Now, based on this, I've given certain the points or questions here. Consider the following statements. LIBOR used as a reference rate for unsecured short-term interbank lending. This statement is true. LIBOR is computed for only 3 currencies. This statement is wrong. It's a factual statement. It is calculated for 5 currencies. Please make a note of this. It's calculated for 5 currencies. Swiss franc, yes, it is there. Pound sterling, yes. Euro, USA, dollar is also there. So totally there are 5 currencies for which it is calculated. So second statement is wrong. First statement is true. Right option is only one is true. Second question, the terms SONIA and SOFR often appearing in the newspapers are related to. Now, please understand, these are related to new methodologies or newer concepts which have been introduced by various central banks to calculate the interbank exchange rate. Just on the lines of LIBOR. Just like LIBOR, these are alternatives to LIBOR. For example, SOFIA basically stands for sterling overnight index average. And SOFR basically stands for secured financing. Secured overnight financing rate. So these are the two alternatives which have been discussed, which would be replacing LIBOR in the coming days. So right option will be these are related to interbank lending rates. So these are some of the questions related to these articles. Next article is with respect to concept of green bonds. First and foremost, what is the idea of a green bond? We'll understand that, then we'll come to the points given in the article. The concept of a green bond is this. These are debt instrument. Now you'll ask me, sir, what do you mean by debt instrument? Understand this. Debt in simple terms means liability. That is, in case of a bond, what generally happens? Imagine I'm a company, you're an investor in the market. I will issue a bond to you, I will sell the bond to you and collect 100 rupees from you. So when I collect 100 rupees, I'm in a liability, I'm under liability to repay not only 100, also the coupon or interest rate to you after the maturity period. So the bonds are nothing but debt instruments. So green bonds are again a concept of a debt instrument itself. But why are you referring to these as green bonds then? Why not just corporate bonds or normal bonds? So understand this. These are referred to as a green bonds for a simple reason. Any money that is collected by issuing these particular debt instruments in the market is reserved, is earmarked for environment friendly projects. Now what do you mean by environment friendly projects? I'll give examples. Solar energy project, wind energy project, low transmission or low emission transportation project or logistics project. So all these types of projects are referred as environment friendly projects or green projects. So whatever money is raised by issuing these particular green bonds in the market, this particular money has to be earmarked, has to be used for financing these types of projects only. Can I divert them to finance any other project which is not a green project? That will not be allowed. This is a very, very important point. Next important point. Green bonds for the first time were introduced, were issued in the year 2007, and post that the popularity of these particular bonds or these types of bonds only has increased. In case of India, for the first time the green bonds were issued in the year 2013, and after that again the popularity has kept on increasing. Now coming to what is given in the article. Understand this. Very recently, Government of India announced a union budget or proposed the union budget for the financial year 2022. Under this particular financial year 22 budget, Government of India allocated more than 34 lakh crore worth of expenditure. Out of this particular 34.8 lakh crore rupees, more than 5 lakh crore rupees has been allocated under the capital expenditure head, which essentially means Government of India's expenditure under the infrastructure head is going to increase in the upcoming financial year. Which also means that there is an impetus promotion of infrastructure development which will be done in the coming financial year. So taking a cue from this particular number, there is a very high demand for these kind of bonds which are associated with infrastructure development in the global market. The article basically says one company, Continuum Wind Energy. Again, you don't have to remember the name of the company, not important. So there is a company by the name Continuum Wind Energy which issued or which proposed to sell bonds worth 560 million very recently. And this was proposed after the announcement of government budget or union budget. And it was seen that immediately after this particular proposal was put forward on the same day itself, there was a huge demand for these types of green bonds which were proposed or which were sold by this particular company. The article basically says because of government announcement of this higher expenditure under the capital head, there is a very high demand for these particular bonds which will finance infrastructure in the Indian market. That's the first point. Second very important point to note is this. These particular bonds were given with a credit rating. And how much was the credit rating? As per Moody's, these particular bonds were credit rated at BA2. And as per Fitch, it was given, or these particular bonds were given with a credit rating of the BB+. Now understand the concept here. Whenever debt instruments are sold in the market, these are provided with certain credit rating. What is the meaning of credit rating? Generally, when the debt instruments are issued like this, we try to provide the quality of the asset. We try to denote quality of the asset, quality of the debt instrument in the form of alphanumeric representation. Generally, these credit ratings are provided either in the form of alphabets or in the form of a combination of alphanumeric representation. These represent how credible is the borrower in the market. Generally, the credit ratings are divided under two heads. Some of the credit ratings are referred to as investment grade ratings, and the remaining credit ratings are called as junk or speculative grade. And for your information, BB+ as well as BA2 are basically part of junk grade investment rating or credit rating. And generally, what happens is whenever these are referred or these are classified under junk or speculative, it simply means that these are risky in nature. Risk is higher in case of these types of investments. So despite the risk being higher, the article says that there is a very high demand for such bonds which will provide infrastructure financing in India. So these are the two very important points which are discussed in the article in the context of green bonds. Next point, concept of a P note. What is the idea of a P note? Understand the concept here very carefully. Much of information which is given in the article is not important, but what is important is the concept of a P note. Very important for UPSC prelims. Generally, if a foreign institutional investor wishes to invest in the stock market in India, is okay. Whenever a foreign institutional investor wishes to invest in Indian stock market, he has to be registered under SEBI. He has to follow the KYC norms. He has to provide all the relevant data which has been sought by SEBI, market regulator here. But there are certain investors who wish to invest in Indian stock market. They want to invest in Indian stock market, but they do not want to be registered and come under the KYC norms of SEBI. So what these investors specifically do is they will approach these particular foreign institutional investors, provide them money, or basically hand over their investments, and on the behalf of these investors, these FIIs will invest in the Indian stock market. Is okay? Investors will give their investment to FII. FII will invest this money in the Indian stock market. And since these investors are not registered with SEBI, who are these investors whose investment is coming into the stock market? That information is not available. Is okay? Now, when these investors have handed over their money to FII, FII in return will provide a certain security. Is okay? That is nothing but instrument. So look at this. FII, imagine I'm the FII, you're the foreign investor, you have given me 100 crore rupees. Just a hypothetical situation. You have given 100 crore rupees to me, and I've taken this 100 crore, invested in the Indian stock market. And since I've collected 100 crores, I'll have to give certain receipt to you. I'll have to hand over certain instrument to you. So this instrument, which will be issued by FII to an investor like this, is called as participatory note. P note, in short, participatory note in the long form message. And these particular participatory notes are being used worldwide in many of these particular stock markets. India is not an exception here. Now, what is being discussed in the article? over a period of time, there have been certain concerns which have been raised with respect to P-notes generally. For example, since these are issued for these particular investors or out of India, foreign investors, SEBI does not have any information related to who are these particular investors. Right? It doesn't get access to the information related to these particular investors. That is one problem. Second very important problem is there is a concern that this could be used for money laundering process. What is the basic idea of money laundering? Money laundering. Look at the term laundering. That laundering means cleaning up. So black money could be converted or could be made white money using these particular P-notes. Again, there is a process which is used, not important here. So there is a concern that this particular P-notes route can be used for money laundering process. Third very important concern. These particular P-notes could be used for price rigging of the stocks in India. What do you mean by this? Imagine I'm one of the promoters in a particular company, and this particular company is listed in the stock market. I've got a lot of black money. I will route it into the P-notes back into India. I'll ask the FII to keep on purchasing shares of the company in which I'm the promoter. And since this particular FII is infusing a lot of money, purchasing a lot of shares of my own company, what will happen to market prices of this particular share? Market prices will start increasing. This is simple terms about price rigging. So there's a concern that the P-notes could be used for price rigging in the domestic market, in the stock market. So against this, SEBI over a period of time has taken certain regulatory measures. But again, this particular article says that in the recent times, how much P-notes are flowing into India in terms of value, the value is increasing. For example, in the month of December, the overall investment under P-notes was to the tune of around 87,000 crore rupees, which is a 31-month high as such. And not only this, a huge amount of investment has actually flown into India under the concept of FPI itself. That is, under the FPI route, over $35 billion has flown into India, which is the highest even in case of India, and which is the highest amongst all of these developing countries. But the SEBI chairman basically says there is no need for concern about these P-notes. We have a regulatory process in place. So this is basically the discussion related to this particular article. Hello students, welcome to Byju's IAS. In today's live session, we'll discuss certain very important economic related articles which have appeared in various newspapers in the duration between 13th to 19th of March 2021. Let's start with the most important article that was in the discussion related to AT1 bonds. Let's basically understand this. SEBI, which is the primary regulator of the market, came out with certain regulations or certain guidance with respect to valuation of AT1 bonds, and there was a lot of discussion with respect to these particular regulations. Now, before I take up the regulations and what is the crux of the discussion, let me tell you certain basics in the first place. Understand this under the concept of Basel guidelines. In case of India, we are now implementing Basel III guidelines. Under Basel III guidelines, the banks in India are supposed to maintain Tier 1 capital as well as Tier 2 capital. That is basically there is a concept of capital adequacy ratio. That is the amount of capital that the bank must maintain in order to absorb certain losses in the market. So under this particular capital adequacy ratio, they are supposed to maintain capital which is divided into Tier 1 and Tier 2. I'll focus on Tier 1. As per the Basel guidelines, Tier 1 is again divided into two parts. That is common equity Tier 1, CET1, common equity Tier 1, and additional Tier 1. Now, under the concept of a common equity Tier 1, generally the banks will be issuing equity or the shares in the market collecting the capital. On the other hand, under the concept of additional Tier 1, the banks are issuing debt instruments which are bonds. Now, come to the crux of the discussion here. Some of the banks in the earlier months had to write off their additional Tier 1 bonds, and which basically had a huge impact on the investors of these particular additional Tier 1 bonds. That is basically, here is one bank, Yes Bank. This particular bank had issued additional Tier 1 bonds in the market. There were a lot of financial pressures on this particular bank. On the direction of the RBI, this particular bank simply wrote off the additional Tier 1 bonds. Now, what were the investors who had invested in these additional Tier 1 bonds? Their investments was reduced to 0 rupees. Now, in order to protect these kind of investors, specifically in this particular case, mutual funds, because please understand this, mutual funds have invested huge amount of money in these kind of bonds, that is additional Tier 1 bonds as well as Tier 2 bonds. It is said that a total investment of more than 90,000 crore rupees in case of Indian banking sector has been in the form of the mutual funds purchasing these particular Tier bonds. Out of these particular 90,000 crore rupees, around 35,000 crore rupees of additional Tier 1 bonds are being held by the mutual funds. So these particular mutual funds who are investors of these particular additional Tier 1 bonds had to face the brunt of the RBI decision to write off these particular AT1 bonds recently. Now, in order to protect the interest of the investors, such as mutual fund investors, very recently SEBI has come out with certain guidelines. Now, what are the guidelines? Follow this very, very carefully, and the first one is the most important and the most controversial guideline. Generally, when the AT1 bonds are issued, these are referred as perpetual bonds. I'll give the statement. These are referred as perpetual bonds. When these are referred as perpetual bonds, they do not have any kind of a maturity period, or there is no tenure provided with respect to these particular bonds. Imagine I'm a bank and you are the investor. I will issue additional Tier 1 bond to you, but there is no maturity or the tenure for this particular bond. You have to purchase it, hold on to this particular AT1 bond, and generally related to these particular AT1 bonds, there is a concept called as call option. That is, as and when the bank will purchase these particular bonds back from you, they will exercise this particular option, which is referred as a call option. Generally, in case of India, the banks exercise the call option every 5 years, or once they are issued after 5 years, they exercise this particular call option. But please understand, there is no compulsion on the banks per se. They can recall them or they can buy them back after 10 years also. That is left to the banks. That is the reason these are referred as perpetual bonds. Now, in addition to this, another very important feature related to AT1 bonds is generally they will offer, or AT1 bonds will offer higher interest rate or higher coupon rate, because these are bonds, and in case of bonds, we use the coupon rate. A normal bond, with respect to the coupon rate, a normal bond, if it offers, let's say, 5% coupon rate, generally the additional Tier 1 bond would offer somewhere in the range of 50 to 75 basis points above and over this particular coupon rate. For simple reason, the risk of investing in the AT1 bonds is generally higher compared to a normal bond, because in case of a normal bond, there is a maturity period, there is guaranteed payment of the coupon rate annually. But in case of AT1 bonds, if the bank is under a lot of financial pressure in certain situations, it can simply deny payment of the coupon rate. That's the first one. And in extreme situations, RBI can allow the banks to simply write off these particular AT1 bonds. So obviously risk is higher, so the coupon rates are generally higher, and this particular higher coupon rate generally attracts a lot of investors in this particular concept of AT1 bonds. Now, what SEBI basically said was, these particular AT1 bonds, when these are purchased by the mutual funds, they will have to consider the tenure of these particular mutual funds. They will have to consider the tenure of AT1 bonds at 100 years. I'll repeat the statement. This is very, very important. The SEBI basically ruled that, or issued a guidance saying that when mutual funds will purchase these particular bonds, they will have to value these particular bonds, assuming that the tenure of these particular bonds is 100 years. Right now, what is the practice? Right now, the practice is generally the mutual funds will purchase them, and they will basically value them based on assuming the tenure that it is worth of 5 years, or they will have a maturity period of 5 years. Because I said earlier that the banks in India generally exercise the call option, that is, they purchase back these particular, or they recall these particular bonds generally after 5 years of issuance. So, what is the impact of this? The impact of this is when the maturity period of these particular bonds will be extended like this. When the maturity period will increase like this, the yield rate should also increase. For a simple reason, higher the maturity period, higher will be the risk associated with it. And when the risk increases, obviously the return should increase, and the return would be the yield rate in this particular context. So yield rate should start increasing, but these particular bonds are already on the balance sheet of the mutual funds. Understand this? When the yield rate increases like this, and follow this very carefully, when the yield rate increases like this and they're unable to get the appropriate yield rate, the valuation of these particular bonds will start coming down. And there's a technical term in the discussion called as NAV, net asset value. What is the net asset value? Imagine I'm a mutual fund company. I've issued certain mutual fund units to you and I've collected money from you. Imagine I've sold 2 units to you and I've collected 500 rupees from you. I've used this particular 500 rupees to purchase certain shares of companies in the market, and if it is a debt mutual fund, I'll purchase certain the bonds of various companies or the government from the market. So what is the market price of all of these particular instruments? What is the market price? Right? Imagine today the market price of the shares that I purchased becomes 600 rupees. This 600 rupees, that is the value of the securities held by the mutual fund, is referred as a net asset value. So when the market prices of these securities will change, the net asset value of the mutual fund will also change. So when these are using the money which has been given by the investors to them and they purchase these particular AT1 bonds, suddenly the tenure is increased to 100 years, the value of these particular instruments will come down, and when the value will come down, their net asset value will also come down. And second very important point here, the NAV will dictate how much will be the returns earned by the investors. Is it okay? How much returns is earned by the investors or the holders of the mutual fund is dictated, basically associated with the net asset value of the mutual fund. So when they invest in AT1 bond and the maturity increases, value of these particular bonds will be reduced. The NAV of this particular mutual fund will come down. What will happen to the investors? Now the investors might enter into panic because the NAV is coming down, their investment value is coming down, their returns will also take hit. So what might happen is these investors might start running to mutual fund, sell the mutual fund to the company, ask for the money back, which is called as a redemption. Is it okay? These particular investors will go back or will go to the mutual fund company. They simply say, take back your mutual fund units, please give us our money back. Now this will put a pressure on the mutual fund company because the mutual fund company has to take back the units and pay the money to the investors. For that, they will have to sell these particular bonds in the market and get the money. And in the market, generally what happens is when the tenure is so long, nobody wishes to hold them for a shorter duration. As a result of this, there is a concern that the value of all of these particular AT1 bonds might simply be written down to 0 rupees. The value of all of these particular AT1 bonds will simply be reduced to 0 rupees because there is nobody who is willing to purchase these particular AT1 bonds in the market. So that is the precise reason the finance ministry, specifically under the finance ministry, DFS, Department of Financial Services, has asked SEBI to basically look into this particular guideline. And they are saying that the SEBI might withdraw this particular guideline or put it on hold for a longer duration because the guideline is supposed to come from or come into force from 1st April. Right? That is basically from the next month itself. So SEBI might postpone the implementation or give certain exemptions to the mutual fund units so that they will not be affected by this. But beyond this particular technical concept, what will the impact of this particular guideline? The impact will be understood very carefully. Now, right now, banks are under a lot of financial pressure, and upon that, they're supposed to meet the basic guidelines. In order to meet the basic guidelines, one of the favorite routes for them is issuing these kind of bonds in the market. Now, because of SEBI, if there is no buyer for these bonds in the market, can I simply say that banks will find it very difficult to raise capital, and when they find it very difficult to raise capital, they'll find it very difficult to meet the basic guidelines also. So it will definitely have an impact on the finances of the banking sector. Now, when the finances of the banking sector will become poor or they are unable to meet the capital guidelines, the pressure on the government of India will start increasing because who owns these particular PSPs? Government of India. By virtue of being the owner of these particular PSPs, now it becomes duty of government of India to infuse capital into the banks. And as already government of India is infusing so much of money, now because of a SEBI guideline, the money that has to be infused by the government of India in the form of recapitalization might increase. Now, as a result of this, understand the next story. As a result of this, what will happen to the government? Government finances are already under a lot of pressure. I'm pretty sure all of you are reading about this in the newspapers, and in the recently concluded budget, that was very much evident. The finances of government are already under a lot of pressure. So do you think government of India at this particular point of time will have sufficient amount of money to infuse capital into the banking sector because of the SEBI guideline? So there are so many effects or there are so many outcomes because of just this particular guideline. Now, what is the other side of the story? SEBI says, I'm introducing this particular guideline along with many other guidelines just to protect the investments which are done by the mutual funds. Because in the earlier situation, where the mutual funds had invested heavy amount of money in case of Yes Bank AT1 bonds as well as LBB, Lakshmi Vilas Bank bonds as such, RBI basically wrote them off from the balance sheet of these particular banks. And the investments done by the mutual funds were affected at that particular point of time. And please make a note of this, even the mutual fund companies are supporting the new guidelines which have been issued by the SEBI here. Now, this is one very important guideline, and this has led to a lot of discussion. Right? What is the guideline? Henceforth, from 1st April, whenever the mutual fund has these particular AT1 bonds, they'll have to assume that the tenure of these particular AT1 bonds will be 100 years. That is one very important guideline. Second very important guideline, imagine I'm owning a mutual fund company, I'm running a mutual fund company, and I've collected certain funds from the investors. Now, whatever funds I'm using, follow this very carefully, whatever funds I'm using to purchase the AT1 bonds in the market, there are guidelines with respect to this also which have been announced by SEBI. For example, individual scheme. For example, there is an equity mutual fund, there is a debt mutual fund, there is a hybrid mutual funds. Individually in these particular schemes, I should not be holding AT1 bonds that is more than 5% of AT1 bonds which are issued by a single issuer. That is in simple terms. Imagine there is an equity mutual fund here worth 100 crore rupees. These 100 crore rupees I'll be using it to purchase certain instruments in the market. Assuming this is a debt mutual fund. So understand this. Rather than equity, let's assume this is a debt mutual fund. So out of these 100 crore rupees, how much of these 100 crore rupees can I use to purchase the AT1 bonds in the market which are issued by a single bank? Not more than 5% of this. That is 5 crores. Not more than 5 crores can I use it to purchase the bonds issued by a single issuer. That is the second very important guideline here. Third very important guideline, whatever be the total value of the assets here, the total value of the AT1 bonds cannot cross more than 10% of these particular assets held by the mutual fund. So these are certain very important points related to the concept of the AT1 bonds as well as the recent SEBI guidelines related to this. Now, based on this, given questions here, consider the following statements. AT1 bonds are subordinated to debt instruments and senior to common equity. Very technical question, but you basically can use these kind of statements in the prelims. What's the meaning of the statement? Whenever a particular company has issued bonds in the market and the company has to shut down, between bondholders and shareholders, who will be given a preference with respect to returning the money? It is always the bondholders who are given a preference over the shareholders. In the same way, whenever these particular bonds or these particular banks have to return back the money, first preference is given to bondholders, then preference is given to additional tier 1 bondholders, then it is given to shareholders. So what we'll say is additional tier 1 bonds is subordinated to debt instruments and senior to the equity instruments. So AT1 will basically fall between the bond as well as the shares as such, and that is also one of the reasons why these are called as quasi-debt instruments. These carry certain features of the shares as well as the bonds, and these are called as quasi-debt instruments. Is okay? So the first statement is true. Second one, it is compulsory, underline the compulsory here, for the issuer of AT1 bonds to recall these particular bonds after 5 years. This particular statement is wrong. It is optional. Right? They can exercise the call option after 5 years or even after that. So the second statement is wrong. The right option is option A, only one is true. Again, another question here. Consider the following statements. NAV is the market value of all the securities held under a scheme. Definitely correct. I'll give you an example also. Imagine here is a debt scheme. Here is an equity mutual fund. So basically, when it is equity mutual fund, the fund manager will issue the mutual funds, collect the money, and purchase shares in the market. So whatever is the market price of these particular shares is basically the value of this particular equity mutual fund here, and this is called as the NAV, net asset value. And same can be said even with respect to mutual funds also. So NAV is the market value of all the securities held under the scheme. Correct. NAV of the mutual fund scheme will change on day-to-day basis. Yes. As the market price of either the shares held under the scheme will change, or the debt instruments or the bonds which are held under the scheme changes, the NAV of the scheme will also keep on changing. In fact, as per SEBI guidance, at the end of the trading or at the end of the trading day, the respective mutual fund companies will have to publish what is the net asset value of all of these particular or all of their particular schemes like this. So both the statements are true. The right option is option C, both 1 and 2. Next, very very important article which will led to a lot of discussion in the last 1 week. The concept of a small savings. Now understand the basic idea here. Small savings are the basic type of schemes or the instruments which have been issued by the central government. Is okay? First point. These have been issued by the central government and they target small savers in the economy. Under this, 12 type of schemes have been announced by the government. 12 different types of schemes have been announced by the government. Example, there is a PPF, Public Provident Fund. There is a Kisan Vikas Patra, Sukanya Samruddhi Yojana is there. So 12 different types of these schemes have been announced by the government to mobilize the savings from the small savers assets. And that is the precise reason these are called as small savings schemes. Yes, yes, yes. Third, generally on this, follow this very carefully. Generally the government collects the money. These schemes are implemented by, let's say, the banks, post offices. But please remember, who is liable for the repayment? Who is accountable for this particular money? Government of India, right? He is liable or is accountable for the repayment. And any amount that is collected through small savings schemes generally is put into a fund called as National Small Savings Fund. NSSF, National Small Savings Fund. Now, if you're giving money to the government, either under PPF, Kisan Vikas Patra, whatever it is, if you're giving money and government is borrowing like this, government has to pay interest rate. Is okay? Government has to pay interest rate. And this is where the discussion has been happening in the last 1 week. Government generally announces or adjusts the interest rate once every quarter. Is okay? Once every quarter, that is generally in the beginning of the quarter, government will announce new interest rates. They could increase the interest rates, they could decrease the interest rates. Okay? And how do they announce the interest rates? On what basis they are going to announce the interest rates? That is an interesting concept here. From 1st April 2016, what government of India did was, based on recommendation of Shyamala Gopinathan committee, they linked, remember the statement here, they linked interest rates on these particular, yes, to the yield rate on government bonds. I will repeat the statement here. Government of India has a link to the interest rates on these particular triple years to the yield rates on the government bonds. And one more point here, when we are linking, the tenure should be same. That is, if one of the triple years, let's say is of tenure 5 years, then I'm going to link the interest rate of this to the government bonds whose tenure is also 5 years. Is okay? Same tenure instruments will be linked like this. And when they are linked, generally what government says, between 25 to 100 basis points, whatever is the yield rate on government bonds, above that, I'm going to provide 25 to 100 basis points in the form of interest on these particular schemes. What do you mean by this? Let's take a very simple example here. 5-year time deposit in the post office. So look at this. Imagine 5-year government bonds. The yield rate right now is, let's take an arbitrary number here, 5.5%. Is okay? 5.5%. So government will simply say, okay, on 5-year government bonds, the yield rate is 5.5%. I will add 50 basis points to this, and I will give 6% rate of interest to this particular 5-year time deposit in case of post office deposits. This is generally how the government of India will adjust the interest rates on these kinds of small savings schemes. Next important point. In the last 1 year itself, that is for the duration April to June, this particular quarter, in the last year, government of India reduced the interest rates on this. Is okay? April, June quarter last year, government of India cut the interest rates on these particular triple years. And very recently, government of India proposed that they will be cutting the interest rates further. But within 12 hours, this particular order of the government was revised. And they said this is an oversight, so we will not be implementing this particular order right now. Whatever is the interest rate for the previous quarter, will continue with the same interest rate. Should you mark the interest rates which are present here? No, please do not do that. Interest rates are not imported here. Now there was a huge criticism, there was a backlash against this, and finally government of India came in and said, okay, we are not going to do this, we are going to continue with the same interest rates. But please understand, this has led to a very interesting discussion. Should government of India have cut the interest rate, or should government of India have continued with the same interest rates? That is, there is a pro as well as a con related to this. And this is where the UPSC will test you. Okay, so what is the argument here? Let's look at both the sides of the argument. First, I said that whatever is the borrowing under this, how much ever is the amount invested under this, who is responsible? Who ultimately bears the responsibility of repayment? Government of India. So it becomes borrowings of government of India. It becomes borrowings of government of India. So in the present financial year, government of India wants to borrow a huge amount of money from different sources. So whenever the interest rates will come down, who's going to get the benefit? Government of India. So looking at the present economic scenario, there is a recession, we are moving away from recession, recovery from recession. So don't you think the government of India should be able to borrow at lesser rates of interest from the market? Definitely yes. And that is where there is a discussion here. Government of India should have cut it. It would have become easier for government of India to borrow at a lesser rate of interest. First point. Second point, please understand this. As an investor in the market, now you have two choices. One, you can take your money, put it in a fixed deposit in a bank, or you can take the money, put it in, let's say, PPF, or you can put it in a Kisan Vikas Patra, or you can put it in these particular deposits in the post offices. And like I've said earlier, government of India generally provided higher interest on these kinds of schemes. As an investor, obviously at the end of the day, you would want to earn a higher interest rate. So what do? You take a lot of your savings and put them under these particular small savings schemes. Although some of the savings schemes have a limit as to how much you are allowed to invest. Okay, but understand this. You have taken a lot of your savings, you have put it under these particular schemes. Now, as a result of this, how much of your savings will go to banks will come down. Is it okay? How much of the savings you could put in a bank will come down. Now, the bank wants to attract your savings. So the problem for the banks is they cannot provide lower interest rates on the fixed deposits. They will have to offer higher interest rates so that you, rather than investing here, will start investing in the bank deposits. So problem for the bank is they'll have to keep the rate of interest on fixed deposits higher. Now you'll say, so what is the problem here? Problem for the bank is, have a look at this. On one hand, RBI is reducing the interest rates. Is okay? RBI is reducing the interest rates, and the bank is supposed to transfer the benefit to borrowers in the system. But if they do that, the amount of revenue they are going to earn to interest will suddenly come down, and as such, they are already under a lot of financial pressure. Is very, very high. So if they increase the fixed deposit rate, they will not be able to provide the monetary deposit transmission efficiency like this. They will not be able to transfer the full benefit of a rate reduction to the borrowers in the market. And if they do that, another way of generating revenue is decrease the interest rates on fixed deposit. But if they decrease the interest rates on fixed deposit, you as an investor will invest more in small savings schemes rather than investing in fixed deposit. So this is a dilemma that was troubling for the banking sector, and that was the reason why government of India, rather than regulating the deposit interest rates or regulating the interest rates on savings schemes, will link it to the yield rates. But anyways, what are the reasons why we should the government of India's decision to basically withdraw the order was correct? We have to look at the other side of the discussion now. Why this was correct decision of the government to withdraw the order? First, inflation rate is high. Follow this very carefully. Inflation rate right now is high, more than 5%. And as per RBI report, in the present financial year, for the first half, it will remain more than 5%. So if the inflation rate is more than 5%, and the interest rates on these will come down like this, what do you think? The real rate of returns, the real interest rate or the real rate of returns for the savers and investors, it will also suddenly shrink like this. So what is the reason or what is the incentive for these particular people to invest in the small savings? This will create a disincentive for these particular small savings. Okay, and that has been the most important talking point. Okay, so this is a discussion related to small savings. Please be very, very careful. Expect a question on this in the prelims or means. So based on this question, consider the following statements regarding CSS. Government linked the interest rates on it should be SSS, small savings schemes, SSS, with the yields on the G security with the same tenure from 1st April 2020. It is from 1st April 2020. No, this is from 1st April 2016. So statement is wrong. The linking to yields of G securities was recommended by Ujjit Patel committee, wrong. Shamla Gopinath committee. Okay, so both the statements are wrong. The right option will be option D, neither one nor. Next important article, right? Again very technical also. NPS reforms, which was mentioned or which was discussed in the Hindu newspaper, right? Sunday's Hindu newspaper. Now before I understand what is given here, let's understand certain basics here. Now whenever you talk about formal employment, that is basically there is a job security provided and there is a contract between the employer as well as the employee. We refer to this as a formal employment. Under this particular formal employment, understand this, there is a provision of providing pension. Is okay? There is already a provision of providing pensions, which is provided under the concept of EPFO. EPFO will collect a certain amount of contribution from both employer as well as employer and will provide a pension to the employer. Now have a look at this. But the number of formal jobs in case of India is very less. Or the total number of formal jobs is very less, just fractional. So what about all those other jobs? Which should not be covered under EPFO. For this only, Government of India launched a new pension scheme. Okay, for this only, to cover these kinds of employments, Government of India 2004 launched the concept of a new pension scheme, and which is regulated or which is implemented by Pension Fund and Regulatory Development Authority (PFRDA). Now understand this: whenever any employee contributes under NPS here, have a look at this. Remember these terms. Whenever any employee contributes to the funds under NPS after the retirement, once you hit 60 years of age, 60% of this, right, you will be allowed to withdraw. Is okay? 60% of these particular funds can be withdrawn by this particular beneficiary or the pension holder. And remaining 40%, this particular pensioner has to choose one of the funds. And this particular 40% of the funds will be invested in this particular fund. And what is the benefit of this? The benefit is when you invest the remaining 40% in an annual fund like this, you will receive the pensions. Is okay? You will receive the pensions because of this investment that you have done. And this particular process is called as annuitization. Is okay? This particular process is called as annuitization. But understand this very carefully. If the total amount of corpus, the amount of investment that you have under this particular NPS is up to 2 lakh rupees. If it is up to just 2 lakh rupees, then you will be exempted from this particular process. That is, you will be exempted from the concept of annuitization. Now, very recently, citing some of the concerns which have been raised by the pensioners, the head of the PFRD has basically proposed this. One, the head basically says we will increase this particular limit from 2 lakh rupees to 5 lakh rupees. Is okay? The exemption that is provided will be increased from 2 lakh rupees to 5 lakh rupees. That is, if your total corpus which is present in the NPS is up to 5 lakh rupees, then you do not have to go to annuitization. That is the first very important point being discussed here. Second very important point is, rather than asking the beneficiary or the pensioner to choose another fund and transfer these particular funds from PFRDA or the managers under PFRDA to another fund like this, why don't we continue to retain this particular 40% within PFRDA itself? Is okay? Second very important point, I'll repeat it. Generally what happens? Remaining 40%, 60% you can withdraw. Remaining 40% you have to invest in a particular fund. Okay, and which is not under PFRDA. There's another fund manager, you'll have to transfer it. And you will get the returns based on this particular investments. Now rather than doing this, why don't we simply retain even this particular 40% within the fund managers which are working under PFRDA? Why this has been proposed? Follow this very carefully. Whenever this particular 40% is invested, the investors or the pension holders will be provided returns on this. But these particular pensioners again and again have been raising concerns with respect to the low returns that they are earning from this particular investment. Generally, when these kinds of investments are done on the returns, they will have to pay taxes. And in addition to this, there is also concern of inflation. And when there is inflation, your real rate of returns will come down. And when you are supposed to pay taxes also, how much you actually going to earn will be further reduced. And the article basically says because of the taxation rate as well as the inflation rate, especially in the recent times, in the last couple of years, the actual real rate of returns for these particular investors have become negative, have turned negative. And because the returns are negative, these particular investors or pensioners are raising concerns, are filing complaint to PFRDA, saying that they are not happy with these kinds of the options that they are providing to us. So that is the reason these two changes have been proposed by the head of the PFRDA. So this is the gist of the article which has been provided here. The last article, right, is related to concept of infrastructure investment trust. Now please understand, in recent times, this particular concept has been in the newspaper in the context of Power Grid. Power Grid has become the first publicly owned, that is a government-owned entity, CPSE, to go for IPO of infrastructure investment trust. Okay, first and foremost, what do you mean by IPO? IPO stands for initial public offering. Okay, IPO stands for initial public offering, where the units are sold to the investors in the market directly by the company like this. But what do you mean by the concept of infrastructure investment trust? These are some very, very important points for the discussion here. Now, before discussing infrastructure investment trust, I hope you know the concept of a mutual fund. Because generally, when you talk about infrastructure investment trust, they will try to connect that with the idea of mutual fund itself. Now, what do you mean by mutual fund? Have a look at this. Mutual funds are nothing but a concept of a pooled investments. Okay, concept of a pooled investment. Now, you simply raise a question: what is a pooled investment? Basically, in case of mutual funds, here is a company which will collect the funds from investors. Is okay? It will collect the funds from investors, and using these funds, they will invest in financial instruments in the market. Is okay? The mutual fund manager will issue units, mutual fund units to the investors, collects some money, and uses this particular money to invest in the financial instruments. They can invest in a debt market, they can invest in equity market, they can have a mix of both of them. But argument is simply this: the company or the mutual fund company issues the money, issues the instruments, collects the money, and invests in the financial market. Or they will have certain financial instruments like this. I'll use the same concept, but a slight difference. Here also, infrastructure investment trust is nothing but a concept of a company which is setting up this particular trust. Have a look at this: a company which is setting up this particular trust. But in this particular trust, what they will have is infrastructure assets, and the investors would be providing money to this particular, or would be investing money into these particular which are issued by the company. Is it okay? Imagine I'm one of the companies. I have certain infrastructure assets such as, let's say, roadways, infrastructure related to power sector, railways, etc. I'm just giving examples here. So I have these particular assets. Is it okay? I have these particular assets. So these particular assets will function and generate certain money to the company. Is it okay? I want these particular assets. These assets are supposed to perform and give me certain cash flows. But today, I do not have sufficient amount of money to invest in these kinds of assets or other types of assets. So what I'll do, I'll basically pull these particular assets into this particular trust. That is, I will connect the performance of these particular assets with this particular trust, and based on the performance of these particular assets, I will collect the money from the investors. Investors will give money to the trust, but their returns are connected with respect to performance of these particular assets. I understand the logic here. In case of mutual funds, investors will give the money to the company will invest in the financial instruments, and the returns that is given is generally associated with how these instruments are performing in the market. In the same way, in case of infrastructure investment trust, the company will issue these particular units, collect the money, generally called the concept of a trust here. Okay, so company will issue these particular instruments, collect the money, and the returns that are given to these particular investors are attached to these kinds of assets, these kinds of infrastructure in the market. The advantage for investors is they are going to earn the returns because these particular infrastructure is expected to perform in the coming days. The advantage for the company is able to generate the money on the basis of these particular assets in the market. So it's a win-win situation for the investors also, it's a win-win situation for the companies also. And very recently, this particular power grid company has issued or has proposed the IPO for this particular concept of infrastructure investment trust itself. Next important point, whenever these infrastructure investment trusts are supposed to be set up, these will come under the regulation of SEBI. Remember this. These will come under the regulation of SEBI. Okay. So these are some of the very important points with respect to the concept of the infrastructure investment trust, which is in the discussion in the recent times. So these are the various articles as well as the questions related to these particular articles for this particular time period of 24th to 30th of April 2021. If you like our initiative, please hit the like button and provide your inputs in the form of comments in the section below. And if you have not subscribed to our channel, please subscribe to our channel. Thank you. Have a good day.
Alternative investment funds. AIF basically stands for alternative investment fund. Now, first and foremost, what do you mean by alternative investment funds? Now, if you're an investor, you can invest in the market either in the form of equity, that is basically purchasing shares, or you can invest in the form of debt instruments also, that is you can purchase bonds, so on and so forth. So these are generally considered to be traditional investment. But over a period of time, what has happened is there are certain group of investors who are having huge amount of money to invest in the market, but generally they're not happy with the amount of returns that they're going to get from traditional investments. Is okay. These are high net worth individuals or foreign investors who wish to invest, take a higher risk, because obviously if you take a gamble, there's a very high expectation that you will earn higher returns. So they're not happy with these kinds of traditional investments because they are getting moderate returns or lower returns. They want to take a higher risk, they want to invest a higher amount, they want to earn higher returns. For those kinds of investors, there's a new model of investment, that is alternative investment funds, AIFs. Now understand this, in addition to this, there's another reason also. For example, if you want to invest in a hedge fund, you want to invest in a venture capital fund, and different types of instruments in the market or asset classes in the market, generally SEBI does not allow you. For example, if you want to invest in an unlisted startup, you want to invest in a company which is not listed but growing at a very fast pace, generally there are certain regulations. But a new class of asset investment type has been introduced, AIF, by SEBI in 2012. Now, why this particular article becomes important for your UPSC exams? Please connect the dots here. Alternative investment funds, in case of Indian economy, in the last 5 years have actually boomed. The amount of investment through AIFs has kept on increasing. If there's a trend type of proportion, please remember this. You can see this particular graph here. The total amount of investment, there are 3 categories. I'll go to that. The total amount of investment under AIF in the last 5 years has actually increased in the Indian market. Now, in the year 2020 as well as 2021 also, it has been seen that the total amount of investment through AIF has actually increased. Now, this is important for a simple reason. 2020 and 2021 are not normal years. By any stretch of imagination, these are not normal years. Generally, we have seen such a high amount of volatility in the overall market in terms of, let's say, GDP growth rate, capital formation, consumer confidence, so on and so forth. Even inflation for that matter. There's been a huge amount of volatility in the market. But what has been certain during this period of time is, both in the year 2020 as well as 2021, the amount of investment has flown into the market through AIFs, alternative investment funds, has increased. And that is a very important point you need to remember. Now, beyond this, what is the idea for AIF? Let's take a basic point first here. The AIF are basically nothing but private investments. Is okay? Private investment which are pooled, and these are used to invest in the market as per the policy. For example, imagine all of your millionaires. Just imagine this. All of your millionaires, all of a huge amount of money to invest, right? And just to put a cherry on the cake, imagine your millionaires in terms of a dollar currency, not rupees, dollars. So you have huge amount to invest. But in a recent what has happened in the global market is the interest rates have kept on declining. All of you know this. The interest rates have declined, and there's a very simple reason for that. In most of the economies, there's volatility. In order to revive the economic growth, the central bankers are basically going for a quantitative easing monetary policy, and the interest rates are actually on the lower side. But you as an investor, you want to invest in the market, take a risk, but earn huge amount of return. So what you will do, you will take your money and come to India and make an investment for a simple reason. Understand this: India has a huge amount of growth potential. That is one attractive point for you. Second, in case of India, it is having one of the highest startup ecosystem in the world, and startups generally get huge amount of funds. And in case of India, this particular economy, since it is having high potential to move from a developing economy to, let's say, developed country, or to become a $5 trillion economy by 2024-25, the idea is the requirement of investment demand for money will be very, very high. So citing all of these particular factors, you can just understand why this amount of investment is actually flowing into India. Now, although I'm using the example that you're a foreign investor, it doesn't mean that only foreign investors will invest in AIF. Please remember this. AIF can pull in the investment from the foreign investors also, from the domestic market also. Now, let's go beyond this. These particular AIFs are basically categorized into 3. Category 1, Category 2, and Category 3. Now, as per SEBI guidelines, understand, as per SEBI guidelines, in case of a Category 1, generally we expect huge amount of a spillover effect on the economy. Any amount of investment that will come through Category 1, we expect a spillover effect, right? What do you mean by spillover effect? For example, investment in startups, investment in, let's say, infrastructure development. You generally see there's a spillover effect, which essentially means employment generation, capital formation happening, so on and so forth. That is the precise reason in Category 1, basically government will try to promote these kinds of investments by giving, let's say, tax breaks, right? For example, the infrastructure funds, venture capital funds, the SME small and medium enterprises, or even angel funds are kept under Category 1. In case of a category, I'll go to Category 3, I'll skip Category That is there's a particular reason for that. Give me a minute. In case of category 3, generally SEBI says these kinds of investors are expecting short-term returns. They want to invest, and within short term they want to get returns. For example, hedge funds. And because these are mainly focused on returns and these do not have any kind of a spillover effect, Government of India does not provide any kind of incentive for these kinds of investment. Now those kinds of AIFs are the investment pools which will not fall under category 1 as well as category 3 will basically be kept under category 2. Now you understand why I skipped 2. Those which will not fall under 1 as well as 3 will be kept under category 2. For example, private equity funds, debt funds, etc. are kept under category 2. And again, even in case of category 2, government doesn't provide any kind of incentive. Now out of the total investment within the AIF which has flown into India, majority of the investment has actually come from the category 2 itself. That is 66% of the total investments that have flown or that have been invested in the Indian market are from the category 2. Category 1 accounts for 10% and category 3 accounts for 24% of the total AIF funds here. Now how much is the total investment under AIF? The article in the first paragraph itself will tell you this particular information. The total amount of the alternative investment funds, that is the investment under AIF, has very recently crossed more than 2 lakh crore mark. Right? In the fourth quarter of the last financial year, it has crossed more than 2 lakh crore mark. And this is important for a simple reason. In the last financial year, that is the financial year 20 which ended, it was a 1.5 lakh crore rupees. So in one financial year, it has increased by more than 30%, which essentially means a lot of funds have been invested in the market to the concept of AIF itself. So these are certain points with respect to the alternative investment funds which have seen a surge in case of Indian economy in the last 1 year. Now, beyond this, what is given in the article, there are two very important points you need to remember with respect to AIFs. One is with respect to concept of pass-through status. Remember this, pass-through status. Now, pass-through status essentially means whenever income is generated from AIF, understand this very carefully, whenever income is generated through AIF, the tax on that will not be collected at the point of generation. Rather, the tax will be collected when the income will be transferred to the investors. I will give you an example to make it clear. Imagine all of you have given money to me. Okay, I'm running an AIF, alternative investment fund. All of you have given money to me. So when the profits are generated, should the tax be collected here, that is at AIF, or I will transfer the part of profits to all of you because you're investors, and the tax will be collected from your hands. If the tax is collected to a latter route, that is the second route, I will transfer the profits to you because you've invested, and the government will impose tax in the hands of the investors. That mechanism is called the pass-through status. Now, what is the advantage here? Understand this very carefully. Earlier, I basically stated that in case of AIFs, domestic investors have also invested, foreign investors also have invested. Now, imagine you're a foreign investor where the income tax rate is 10%. I'm just throwing an arbitrary number here, where the income tax rate is 10%. And in case of India, let's put an arbitrary number here, income tax rate is 30%. So, would you want to be imposed an income tax at a rate of 10% or 30% if you're a foreign investor? And if the government of India says, I will impose income tax of 30% at the point of profit generation, then the AIF itself, you'll be losing a lot of income tax here, or you'll be paying a lot of income tax. In essence, you'll be earning a lot of profit. But rather than that, what if I say, as a government, what if I say, you generate profit, you invest in the AIF, you take the profit, and whatever is the income tax rate in your country, you pay the income tax there. So obviously, you will enjoy a huge amount of profits because you're paying a lower income tax. This is one whereby pass-through status is very, very important. Understand this very carefully. For category 1 and category 2, government has announced the pass-through status. In the budget of 2015, Finance Minister Arun Jaitley basically announced that pass-through status will be given for the category 1 as well as category 2 investments. But for category 3, even today, pass-through status is not given. For category 3, pass-through status is not given. And 2016 set up one committee which was headed by Mr. Narayan Murthy panel. And this particular Narayan Murthy panel basically recommended that even for category 3, pass-through status must be provided. And what is the advantage here? You have hedge funds, you have a type of funds that is private investment in public equity. You have a lot of these kinds of investment tools under the category 3. And if you provide pass-through status, the foreign investors will be attracted to invest in these kinds of funds in India. That is the advantage of providing a pass-through status even for category 3. This is one more point. And the second important point, in addition to what we discussed, is here is an AIF. Let's assume XYZ is an alternative investment fund. It is controlled and owned by a resident of India. That is basically management is with Indian only. Even if the foreign investment is within this particular AIF, follow this very carefully. Here is an XYZ alternative investment fund which is managed and controlled by an Indian. Even if there is a foreign investment within this particular AIF, the FDI restrictions will not be applicable on this particular foreign investment. Now, what do you mean by FDI restrictions? Whenever FDI has to come into India, there are sectoral restrictions. For example, in this particular sector, you are allowed to invest only 50% or up to 49%. In this sector, up to 74%, 76%. In this sector, up to 26%. These kind of sectoral restrictions are not applicable on this kind of foreign investment which is coming into the AIF, which is controlled by Indian. And even with respect to FEMA rules, whenever foreign investment or foreign currency has come into India, there are certain guidelines or provisions which will become applicable on this particular investment because of FEMA. Right? So even under FEMA, these particular provisions will not be applicable for these foreign investments which are coming into this particular AIF. So these are certain very important points you need to understand with respect to alternative investment funds. Now, based on this particular discussion, I've given a question here. Consider the following statements regarding alternative investment funds. All the foreign investments into AIFs is subject to FDI sector caps. Wrong. This is a wrong statement. Because I've said that if there is an AIF which is managed and controlled by an Indian, and if there is a foreign investment coming into this particular AIF, the FDI sector caps are not applicable on this. Second, pass-through status is available for all the three categories of AIFs. Again, the statement is wrong. Category 1, category 2 it is applicable. Category 3, no, it is not applicable. So the right option will be option D, neither 1 nor 2. Next article, pension funds and IPO. Very recently, the head or the chairman of a PFRDA, Pension Fund Regulatory Development Authority, has stated that in the coming time or in the coming next few days, they are going to allow the pension funds. These are nothing but financial institutions. They are going to allow pension funds to invest in the IPO. Now, there are two important points here. One, what are these pension funds and what is the side of an IPO? And please be very careful with respect to UPSC exam. For a simple reason, in the last 1 or 2 months, if you have been reading the newspaper, there's a lot of discussion that is happening with respect to the concept of IPO itself. Now, starting with the basic idea, pension funds. These are the financial institutions which are basically selling the pension-related products in the market, and they're gathering these particular or collecting money from the investors, and they're investing in different instruments in the market. Now, as of the present guidelines, are they allowed to invest in the stock market? Yes, they're allowed to invest in the stock market, but there is one condition, right? If it is a pension fund, it's a financial institution such as a pension fund. If they want to invest in a scrips or in a stock market, they are bound by one condition. That is, they're allowed to invest in the scrips of only those particular companies whose shares are part of a EF and O, and which will have a market cap of at least 5,000 crore rupees. Now, again, two technical terms have been introduced. What is F&O? F&O stands for futures and options. And what's the market capitalization? Market capitalization basically is what is the total market value of the shares which are issued by a particular listed company. Any listed company whose shares are available in the stock market, right? So these particular shares and their present market value will give you the concept of a market capitalization. So right now, pension funds are allowed to invest in the scrip of only those particular companies which will satisfy this particular condition. But if you've seen in the last 1 year itself, and especially in the first 6 months of the current calendar year, that is 2021, there are around 22 companies in case of India which have gone for IPO. Now you have this kind of a question. So you're again and again using the acronym IPO. What do you mean by IPO? IPO stands for Initial Public Offering. IPO stands for Initial Public Offering. Means what? Until now, a particular company, which was let's say a private company, will list its shares, will sell its ownership in the form of a shares in the stock market, and it will become a publicly traded company. Such a process is called as an initial public offering. For example, any company whose shares are available in a Bombay Stock Exchange is nothing but a publicly traded company, and it can get its stocks listed or shares listed only when it goes through a process which is called as initial public offering. Like I've already mentioned, in the first half of 2021 itself, there are more than 20 companies in India which have gone for IPO. The latest and the most famous being Zomato itself. And all of these companies put together have been able to raise more than 27,000 crore rupees as of now. So please be very careful with respect to IPO. Questions can be asked. I'll come back to this. I'll give you certain important points. Now, what is the basic idea here? Why is PFRDA chairman saying that we are going to allow the pension funds to invest in IPO henceforth? Now, the basic idea is recent times, more and more companies are going for an IPO, and based on the performance of these particular companies, the market price of the shares are increasing. So the idea is pension funds will be allowed to invest in the IPO and subscribe and purchase the shares of these particular companies. And when these get listed and the performance of these particular companies will improve, market price of the shares will improve, the earnings of these particular pension funds obviously will start improving. In simple terms, in the market, many of these particular investors are gaining because of IPOs and the performance of these particular companies when the share gets listed in the stock market. So PFRDA also wants to allow the pension funds to start making gains from this particular process. Now, go to this particular term, IPO, initial public offering. Let me give you certain very, very important ideas within this particular IPO. Whenever IPO is done, it essentially means what? A particular company, which was earlier a private company, will start trading its, will basically sell its ownership through shares in the market, and these particular shares will get listed in the stock market. But please understand, in recent times, if you have been following the discussion related to Zomato, they basically stated oversubscription, undersubscription, these kinds of terms, share allotment, so on and so forth. Always remember this, whenever there's an IPO conducted, there are three types of investors. This is where I'm expecting a question from UPSC in the prelims. So whenever an IPO is conducted, there are three types of investors who will invest and try to purchase the shares in an IPO. One is called as a QIB, qualified institutional buyers. It's okay. It is referred as qualified institutional buyers. And second one is a non-institutional investors. What are non-institutional investors? Best example, high net worth individuals. HNI, high net worth individuals. And the third, where all of us right will basically fall, is retail investors. Is okay? Retail investors. Now look at this. Whenever an IPO is done, can a particular company sell any amount of shares to anyone of these particular investors? No. Please understand this. SEBI guidance mandate that there are two situations. Follow this very carefully. First one, if a particular company which wants to go for an IPO has enjoyed profits in the last 3 consecutive years, is okay? I'll repeat it. Important. If there is any company which is getting listed, that is IPO is being done in the last 3 consecutive years, if it has enjoyed profits, then whatever is the number of shares that they want to issue, they will have to allocate these particular shares in this particular proportion. 50% will have to be allocated to QIBs, 15% will have to be allocated to non-institutional investors, and the remaining 35% will have to be allocated to these particular retail investors. Is okay? These kind of restrictions are imposed. And let me give you another statement also. If you're a retail investor and you have subscribed for a certain number of a lot of shares, what do you mean a lot of shares? Individual shares are not sold like this. There's always a group of shares. It is called as a lot of shares. Okay. So whenever you subscribe for a lot of shares. So whenever you subscribe, is it guaranteed that you are going to get that amount of a lot of a share? Please remember the statement. No, there is no guarantee, because there are 2 more technical terms which are referred as oversubscription, undersubscription. Oversubscription means, imagine here is a company which wants to sell, let's say 10,000 lots, each lot containing let's say 10 shares. Now if 10,000 lots are being sold by the company in the form of let's say IPO, but the demand because of the subscription is let's say for 13,000 lots, obviously everybody may not be allocated the lots of shares that you subscribe for. So you can subscribe, right, but there is no guarantee, right? If there's oversubscription, there is no guarantee. So all these terms are very, very important. Please be very, very careful with respect to these kinds of questions, which will be asked in the UPSC exam based on one, PFRDA, and the second one, the concept of an IPO. The article is related to concept of the curbs or restrictions which have been imposed in the bond market by various regulators. Let's understand the basics here so that we can connect it to what is given in the article. Now, in case of India, there's a lot of demand for investment in the infrastructure project. In a sense, Government of India, for example, has proposed NIP, National Infrastructure Pipeline. Under NIP, we want to invest more than 100 lakh crore rupees in development of many of these infrastructure projects. But out of all these investment, a substantial amount of the investment has to come from the private sector. Now, one way of investing on these infrastructure projects is basically go to a bank, take a loan. But the problem with respect to these kinds of loans is the banking sector generally has a deposit which has a medium term or a short term maturity, whereas the infrastructure developers want to borrow for a longer tenure or longer term loans as such. That is the precise reason generally you come across one problem in the banking sector, which is referred as asset liability mismatch. Now, one way that we can address this particular problem is ensure that the corporate bond market, as in a sense, the overall bond market in case of India is very, very developed. Or else I simply use the term, the bond market is mature enough so that these particular developers can simply go to the bond market, issue the bonds, and take the loans, or basically raise the money in the form of capital for investing in the infrastructure project. Now, all of this looks very rosy or very nice on the paper. There are a lot of issues with respect to corporate bond market in case of India, and this particular article touches one of these particular issues. Now, what are the issues? Let's look at overall issues. We'll connect it to article here. In case of India, please understand this: the government issues the bonds in the market. Corporate sector or private sector also issues the bonds in the market. We generally use the term penetration. Basically, it measures how much is the total value of the bonds issued by the government sector compared to the value of the bonds issued by the private sector. Generally, in a developed economy such as USA, what you see is when you make a comparison between value of G securities and value of the private sector, that is the bonds here, the bond values issued by the private sector are generally around 1.5 times the value of the bonds issued by the government itself. Right? For example, generally come across these particular numbers. The value of the bonds to GDP ratio in case of the government, let's say in case of USA, generally is more than 80%. Whereas in case of India, it is somewhere around 41 to 42%. Again, the bonds issued by the government in India divided by GDP value of India. But when you compare this with respect to private sector, in case of USA, this particular ratio is more than 120% when you take the value of the bonds issued by the private sector. And in case of India, it is somewhere around 21%. Which essentially means what? In these particular developed economies, the private sector, they are issuing a lot of these particular bonds. More value of the bonds are compared to even government. And that is a very good indicator for a simple reason. Government might issue these particular bonds for various reasons. Government in case of India might issue these particular bonds to bridge the deficit, to ensure that there is sufficient amount of money for welfare schemes and to invest in, let's say, infrastructure projects also. But when you talk about the private sector issuing bonds and raising money, please understand, they want to raise the money so that they can invest, they can produce more, they can create more employment, etc. That is the importance of looking at the penetration ratio. Right? Generally, they will say in case of USA penetration is around 1.5 times, 150%, and in case of India it is around 50%, which essentially means most of the bonds issued in case of Indian market, that is within the bond market or the debt market, most of these debt instruments issued are from the government itself, both the central government as well as the state government. In addition to this, there are more issues in the bond market. For example, experts will tell you that we do not have sufficient number of diversity of bonds in India. Different types of bonds are not sold in India compared to, let's say, Western markets. However, in recent times, yes, we have started issuing newer bonds such as masala bonds. Although I'm using masala bonds here, please understand, masala bonds are issued in the offshore market, not in the Indian market. We also have green bonds in India. We have additional tier 1 bonds. So newer types of bonds, yes, right, they are being issued in the recent times only. In addition to this, whenever government borrowing increases, there will definitely be an impact, which has been proven by various surveys, on the bonds which are issued by the private sector. What is the basic idea here? When government debt increases, generally government borrows heavily from the bond market, and when government borrows heavily from the bond market, the issue of the bonds increases, the coupon rate will get affected. Interest rates in the market will start rising upwards because government is borrowing heavily from the market. And this will basically crowd out the private sector borrowings which they can do in the form of a bond. So there are many issues. In addition to this, the one issue which is discussed in this article is the imposition or the restrictions which are imposed by the regulators themselves in terms of investing in the corporate bond market. For example, there are pension fund companies in India. Okay, there are insurance funds, there are pension funds. The regulator for pension funds is a PFRDA, Pension Fund Regulatory Development Authority. Now imagine you're running a pension fund company. You have collected a lot of money. I'll call this as a corpus. You are not allowed to invest more than 5% of this corpus in a bond market. That is corporate bond market. This is a restriction which has been imposed right, by this authority right, in this particular scenario. And when I say corporate bond market, I'm specifically referring to the concept of infrastructure investment trust here. And not just this, the PFRDA says that this particular infrastructure investment trust should have a very good credit rating. The sponsors of this particular infrastructure investment trust should have a very good credit rating. Generally, they will say that it should have a credit rating of AA or AA+. But various experts will tell you that, or even in the article it is mentioned that whenever these kinds of trusts are set up in the initial phase, where they actually require money, the rating will not be anywhere above AA. And I just hope that you know the concept of a credit rating. AAA will be the highest, and it will keep on declining like this. AA, A, BBB, B like this. So these particular infrastructure investment trusts which are set up initially in the initial phases, where they actually require funding, these will not have a very good credit rating, nothing more than AA. Now, how can we increase this credit rating? There is a possibility. There is a concept called as partial credit enhancement, PCE. Right? There's a scheme even introduced by the government also. RBI also allows partial credit enhancement. Now, what do you mean by partial credit enhancement? Imagine I'm one of the companies which is issuing a bond in the market. It's like a debt instrument in the market. Now, when I'm issuing a debt instrument in the market, I'll have to guarantee the coupon rate or the interest rate to the investor, assuming you're the investor. Now, what if I incur a loss? I'm unable to repay or pay back the principal or the coupon rate. In such scenarios, generally under partial credit enhancement, 20% of the losses in these particular debt instruments will be covered by the bank which is providing this particular facility. I repeat, in partial credit enhancement, the restriction for a bank is 20%. 20% of the losses because of these particular debt instruments can be satisfied, can be paid up by these particular banks. So this is called as a partial credit enhancement. Now, the argument is whenever partial credit enhancement increases, basically somebody else guarantees your money. In that particular scenario, credit rating will increase. But the argument put forward by various experts is you want to increase the credit rating, let's say from BB to AA+, so that these particular pension funds will invest in this. For that to happen, you should have a partial credit enhancement of 50%, against 50%. But what is the limit? Per bank, how much they can provide the PCE? Only 20% as per the regulation of RBI. So the experts say that if you want to have 50% partial credit enhancement, then there should be 3 banks which will provide this particular PCE to, right, this particular debt instrument. And it's very difficult to get 3 banks to provide partial credit enhancement to only one debt instrument. That is another issue. Right? Next issue, please understand this. Whenever we talk about liquidity adjustment facility within the banking sector, it is one of the measures which is used by RBI to adjust the liquidity in the banking sector. The tools which are used are repo, reverse repo, MSF, etc. But whenever you talk about repo, reverse repo for that matter, the G securities which are issued, which are issued by the government, can be used as a collateral, can be used as a security to pledge, or can be used basically to enter into repo operations. But this one article says that there's a problem with respect to corporate bond here also. That is, if there is a corporate bond which is owned by, let's say, someone else in the market, and they want to enter into a repo transaction. Now here is the point. Repo is a very common term. Please do not misunderstand the concept of a repo, assuming that is only applicable to RBI and bank. Repo is a very common concept. Wherever agreements are entered into two parties related to assets, there's a concept of a repo there. So please do not understand that repo is only right, in regards to RBI and banking sector. No. So idea is within this repo transactions, corporate bonds cannot be used right for entering into these kinds of agreements. So there is a problem with respect to corporate bond market. We need to promote corporate bond market, and this article says that government of India as well as RBI should look into this. Now, what can be done in order to promote these corporate bond markets? One, we will have to ensure that more and more diversified instruments are issued in case of India, so that the corporates or the developers will go to the bond market, issue these particular bonds, borrow for a longer duration. The pressure on the banking sector to lend for these particular projects will come down. First, second one, RBI can look into enhancing this particular partial credit enhancement, can promote it much further, so that the credit rating will improve. Third one, understand this, in terms of basically promoting these corporate bonds, what government of India has already done is has basically promoted setting up of multiple platforms. And one initiative that was actually announced by the government of India, which has not taken off, is the concept of Credit Guarantee Enhancement Corporation, CGEC, Credit Guarantee Enhancement Corporation. Now, what is the concept here? This was announced in 2018 and 2019 budget. Government of India basically stated, we are going to set up a corporation, and this particular authority will help in promoting or improving the credit rating of the borrowers, especially corporate bond issuers in the market. But this particular authority so far has not been set up by Government of India. Again, Government of India can look into setting up this particular authority. So these are some of the very, very important points in relation to this particular article. Again, in article, all of this information is not provided, but from the UPSC exam's perspective, corporate bond market is important. You are expected to know these particular points. Done. Now, based on this, I have a question here. Consider the following statements. Increased debt of government may crowd out, underline the term may here, may crowd out private sector borrowings using bonds. Statement is true. Again, I have underlined the term may here. Yes, when government borrows heavily by issuing bonds, it will definitely have an upward push in the interest rates in the market. The private sector will not be happy with that. They may simply move away from this particular market. This is called as a crowding out effect. Second, the first issue of masala bonds was done by Yes Bank. Please understand, statement is a false. It's a factual based statement. The first issue of masala bonds was done by IFC, International Finance Corporation, which is one of the arm of the World Bank. With respect to Yes Bank, right, in what context it is known? Again, connecting to bonds. Earlier I used the term green bonds. The first tranche of green bonds in case of India were issued by Yes Bank as well as Exim Bank. Remember that particular piece of negative. So based on this particular analysis, option A, only first statement is true, is the right option. Let's go to the next article, SEBI and IPO. Very recently, SEBI has proposed two very important changes. Let's understand these two changes. Apart from that, nothing else is important from the article. What are the two important changes? Whenever initial public offering is done or IPO is conducted for any company, there are two processes which can be followed. Right? Obviously, one of them has to be used. That is when the shares are issued, the company can go for a book building process, or the company can go for the concept of a fixed issue. What's the basic difference here? In case of a fixed issue, in the offer document, the company says exactly at what price the shares are sold. Is okay? Under fixed issue methodology, the company in the offer document says exactly what price, at what price the shares will be issued. Whereas in case of a book building process, the company doesn't decide the price of the share. It will provide a band for the share. That is, the price band will be decided. Let's say hypothetically, a particular company wants to issue the shares in the market. It has decided the lowest price at which the share would be issued will be 100. But in addition to this, it will also decide what should the maximum price, that is the band of it, within which these particular two extremes of the prices, the shares shall be issued in the market. Let's say hypothetically, the lowest band is 100, highest band will be 110. Is okay? Lowest band price is 100 and the highest band price is 110. And within these two extremes, will be used, and the subscription will be obtained by the investors in the market, and the allocation of the shares will be done. Now, I will teach you all of this in the current affairs. It is important. Why? First, SEBI basically has a guideline which says that lowest price band, right, imagine it is 100, and the highest price at which the shares would be issued should not be more than 20% of this particular lowest price band. What's the meaning of this? If the lowest price at which you want to issue under IPO methodology is 100, then the highest price at which you want to issue should not be more than 120 rupees. So within these two extremes, will have to decide. That is, will have to obtain the subscription from the investors. Right? So only understand this. The SEBI has basically stated the highest should not be more than 20% of this particular lowest price band. Right? The difference should not be more than 20%. Now what has happened is very recently SEBI has found that there are certain companies which are going for IPO. They are selling these particular shares under book building process. They are issuing the shares under book building process. But the difference between the lowest band and the highest band of the share prices is either 1 rupee or 2 rupee or 3 rupee, which essentially means if the lowest price at which you want to sell in the market, the shares of your company is 100, then the highest band or the highest price you have decided, it will be 101 or 102 rupees or 103 rupees. Because they are basically saying, RBI says it should not be more than 20% difference. The difference between the lowest band and the highest price should not be more than 20%. The SEBI has not decided the lowest band. That is, how much should be the minimum gap between this has not been decided. But the highest difference between the highest price and the lowest price, that is the band of these particular share prices, should not be more than 20%. That is what has been decided by SEBI. That is the precise reason these are selling in a difference of the prices of 1 rupee, 2 rupee, 3 rupee like this. And what's the concern here? The concern SEBI says the conditions that the issuer, that the company which is issuing the shares, in case of a book building process, the conditions are different. And in case of a fixed issue price, the conditions are different. And these particular companies, by basically having a very minor or marginal differences between the lowest band price and the highest band price, are camouflaging, are basically conducting a type of fixed price issue, but they are camouflaging that as a concept of a book building process. Because if you imagine a situation, a particular company wants to sell the shares through book building process, but the highest and the lowest price within the band are decided, highest will be 101 rupee and the lowest will be 100 rupee. So hardly how much is the difference? 1 rupee. So can I simply say it is as good as a fixed price issue itself? Right? So the conditions which are applicable for the issuer under fixed price issue is different, and conditions under the book building issue are different. So these particular issuers are camouflaging a fixed price issue in the form of a book building process itself. And that is the precise reason SEBI has proposed two very important changes. One is more appropriate with respect to this particular practice. SEBI says right now the difference between the highest price and the lowest price, that is the band, should not be more than 20%. Now we are going to decide what should be the minimum difference between the highest as well as the lowest. For example, they are proposing 5% difference between the highest as well as the lowest. Means what? If a particular company wants to issue the shares under the book building process and the lowest price of 100 rupee, then the highest price should be at least 5% higher than this. Is okay? Lowest price is 100, then the highest should be at least 5% higher than this. Then the company shall decide the highest price to be at least 105 rupees. So earlier the maximum difference was defined. Now the SEBI wants to define what should be the minimum difference between the lowest price as well as the highest price within this particular book building process. That's the first thing. Second thing, generally when you talk about IPO, you can divide these particular investors within IPO under three groups. Okay, you can divide the investors under three groups. One, the qualified financial institutions, non-institutional investors, as well as retail investors. Now within the non-institutional investors, SEBI wants to divide these particular NIIs. They want to have two categories within this particular NIIs, so that more and more investments can be obtained, can be attracted through these particular NIIs. So these are the two very important changes that have been proposed by SEBI under the concept of IPO. SEBI banning agriculture derivatives. Now, what is this particular article and what is the relevance of this article for UPSC? Understand that more than sufficient. Now, first and foremost, what do you mean by derivatives here? Again, this is a very, very technical concept. Let me try to simplify. Derivatives are nothing but financial instruments. I'm pretty sure all of you have heard of shares, bonds, etc. All of these are nothing but instruments only. So, in the same way, there's one more class of instruments in the market called as a derivative. What do you mean by derivative here? A derivative basically is an instrument which will derive its value from an underlying asset. So, what do you mean by the statement? I did not understand anything. Perfectly, all right, nothing wrong with that. Let me give a very simple example. Imagine you have 1 kg of gold. Again, imagine you have 1 kg of gold. You will keep that particular 1 kg of gold with me, and in return, I will issue a receipt to you saying that the receipt value is equal to the 1 kg of gold that you have given to me. Now, the gold prices are going to change on day-to-day basis. And when the gold prices will keep on changing, whatever gold you have kept with me, that is 1 kg market value of the gold will change. And as a result of this, the receipt that I have issued to you, which will derive the value because of the gold that I have kept with me, that receipt value will also keep on changing. So, I will look at this. One very important point: the receipt that I have actually issued to you has derived its value. It doesn't have any independent value. It is deriving its value because you have kept the gold with me. And when the market price of the gold will change, the value of the receipt will also keep on changing. That is in a nutshell the idea of a derivative. Again, just to make you understand, I've just given an example. Derivatives in the market generally have 4 types. One, you have a derivative called as futures, you have options, you have swaps, and you also have forward. These are the 4 types of derivative contracts that you can generally enter into. Right now, focus on the futures here because that is the newspaper. The rest of the things are not important currently. Now, as a future, right, what do you mean by future derivative? In case of futures, please understand, give you a very, very simplified example here. Imagine I've got share of a particular company. Any company which is listed in the stock market. I've got a share of a particular company. I will enter into a contract with you saying that after 1 month, I will sell this particular share at a certain price. Is it okay? I will sell this particular share at a certain price to you. So here are 2 parties which are involved in the futures contracts. One is going to purchase the share and the other one who is going to sell this particular share. On what date it will be sold, it will be decided. Generally, it is that is the futures are settled on the last Thursday in a particular month. So on what date the settlement will happen? Yes, it is given. At what price the settlement will happen? Yes, it is given. So whatever is the market price of this particular share, it doesn't matter. Basically, on that particular settlement date, right, whatever price has been pre-decided, right, when we enter the contract today, whatever price we have decided, at that particular price, the trade or the contract between both of us will be settled. And generally, in case of futures, please understand this, the stock market on which we are going to trade this, for example, there is a MCS, right, which basically deals with the commodity futures, and there is a NCDEX, which is another very, very important future or derivative market in case of India. So these are the markets which will basically mediate, which will basically ensure that the contracts are settled between both of the parties. That is the basic idea of futures. Now, what is the advantage here? Right, the 2 parties are expecting something different to happen in the market. That is, I might be expecting that the stock market will come down. So in the future, I just want to protect myself, right, from this particular decline in the prices of the stock. So I will enter into a contract with you saying that I will sell it at this particular price. But you feel that the market prices could be much, much higher, and just to basically earn certain profit, you will enter into a contract with me saying you will purchase at this price, sell it in the market at a much higher price, thereby making profits or gaining profits. So generally, in the context of the futures, 2 parties are involved. One who are basically speculating. Speculating essentially means what? You are taking a guess. Right, based on certain information or just the sixth sense, you are taking a guess. So generally, there are speculators in the market, and there are the people who are hedging in the market. And the concept of hedging is nothing but protecting yourself from the losses. So generally, these are certain important points related to the concept of futures. Now, if you have not understood this, also nothing wrong with this. Generally, UPSC doesn't go to this technical concept of the futures, the forwards, options, and swaps, etc. But the idea here is the derivatives. One more point here: the derivatives as a concept or as an instrument will be there for currencies. Derivatives are there for stocks or the shares in the market. Derivatives are there for commodities such as metals, such as agriculture commodities, etc. Now, in the current affairs, why this has been discussed? That is a very, very important point here. Generally, understand this: we have derivatives, that is basically future contracts in the context of agriculture commodities. Is okay? We have future contracts in case of agriculture commodities, where 2 traders, or let's say traders and let's say the other party are entering into future contracts with respect to some of the agriculture commodities. Best example: the 7 agriculture commodities on which the government or SEBI has imposed a ban. Basically, future contracts cannot be entered into in these particular 7 commodities for the next 1 year. Now, the argument that has been put forward, that is very important for you now. The argument which has been put forward by SEBI as well as government of India is that because there is a futures contracts related to these agriculture commodities, if the market, in the market, the price of the expectation or expected price of these commodities is going to increase. Again, expected price. How do I come to know what is expected price? Look at what is happening in the futures. If the futures are getting into, or basically people are entering into future contracts, and the prices at which they are entering into contracts is actually increasing, it essentially means what? The traders in the market are expecting the prices of the commodities to increase in the coming days. And generally, this kind of upward trend in the future contracts will basically signal to the market that in the coming days, the market is expecting that the commodity prices will increase. And the government says when this kind of a signal is emitted from the future contracts, there will be certain people in the system, such as the traders in the system, such as let's say suppliers or distributors of agricultural commodities in the system, who will start holding a lot of these particular commodities. Right? I can understand this. As there is upward trend in the future contracts, the market, the price at which the contracts are entered is actually increasing. It sends a signal to the market that in the coming days, there is going to be a mismatch between supply and demand for the agriculture commodities, hence the prices are increasing. And looking at this, right, what might happen is some of the middlemen in the market might start holding agriculture commodities. And when they start holding agriculture commodities, the supply of these particular commodities to the market will come down and the market prices will start rising upwards. And this is a problem. Why this is a problem? Last week we discussed the WPI inflation as well as CPI inflation. And for the month of November, the WPI inflation was around 14% and the CPI inflation was around 4.9%. And both the WPI and CPI have been showing a trend of rising levels as such. So government of India is concerned that these particular inflation levels are very high and need to bring the inflation under control. And as a result of this, yes, they have already taken various measures to bring inflation under control. For example, the taxes which are imposed by the central government and many of the states who impose the taxes on the fuels have been cut. The import duties on edible oils have been cut. And all these measures are expected to yield or expected to result in declining inflation rate. But in addition to this, the correlation that I have just now given to you, that is, if the future contract prices start increasing, hoarding might happen, and that might result in a decrease of supply, which will again contribute to higher inflation rate. So, government of India expects that this might again lead to inflationary trend in the market. So, looking at this particular situation, SEBI has basically stated that in the next 1 year, no contracts or future contracts can be entered into for 7 agriculture commodities. Please remember those particular 7 agriculture commodities. UPSC might ask you a question on that also. Done? Right? With this particular ban on the future contracts, what are we expecting? We are expecting that this kind of a future price trend will not send any kind of a signal. So the supply to the market will increase, hoarding will not take place, market prices will come down, inflation will cool down. This is what is expected. Having said so, understand this, having said so, is it always true that when the future contracts prices start rising upwards, or there's an upward trend in the future market related to commodities, does it always translate to inflation trend in the market? Please remember this particular name of the committee. In 2007, there was one committee which was set up by the government, Abhijit Sen committee. And the Abhijit Sen committee was basically asked the same question. They were asked to find out if there is any kind of a correlation like this. And the committee stated that there is absolutely no conclusive evidence for this. There is no evidence to show that the trading in agriculture commodity futures actually contribute to inflation trend in India. There is no proof of that. First thing. And after some years, even RBI came up with the same conclusion. And one more very important point, this is not the first time that the banning the futures in agriculture commodities have been banned by SEBI. Earlier also we have banned. 2006 7 we have banned. Right? In the last 1 year, we have banned some of the agriculture commodity futures. So basically, this is not anything new. But in the current situation, why this has been done by the government? Because government is concerned about the WPI as well as CPI trend levels. Done? So these are some of the very, very important points. Now, are there any concerns related to this? Are there any issues? First one, generally experts say that even if you ban, right, inflation in the market, it might increase. How so? Inflation can happen because of supply side factors, demand side factors. Right? So you might take care of the supply side factors, but if the demand in the market rises up, then naturally inflation can take place. Second point, right? As already mentioned, Abhijit Sen committee says, RBI also says that there is no correlation between the future trading of agriculture commodities and the inflation rate in India. So even if you impose a ban, it might not attain the inflation rate in the market. Third, in the recent times, one of the reasons that there is a tendency of inflation is there has been unexpected rainfall that we have kept on receiving. And basically, the monsoon rainfall that we have received was not a normal type of rainfall, right? So unseasonal rainfalls have destroyed some of the crops, and which has created scarcity of supply of these particular crops in the market, which has contributed to inflation trend. And the next very important point here is generally traders import some of the agriculture commodities such as edible oils or vegetable oils, and they're concerned about the market prices of these particular oils. And as a result of this, they generally enter into future contracts because they want to hedge, they want to protect right from the revenue losses. Now, if this kind of a ban is imposed by the government, or let's say SEBI, right, to be more precise, then this route of protecting the losses is a loss for them. So traders might stop or might reduce the imports of vegetable oils into India. And that is the reason experts keep on saying that rather than creating stability or rather than basically controlling inflation, right, this kind of a decision taken by the SEBI might actually lead to volatility in the market. Done? So these are some of the very important points with respect to SEBI's decision to basically impose curbs or ban the future trading of agriculture commodities for next 1 year. I've given an MCQ here. Consider the following statements. All the types of derivatives are traded in the stock exchanges. Right? For many of the students who do not have a finance background, I know this is a very, very difficult statement. Earlier I gave you a statement saying that derivatives are 4 types: futures, options, forwards, and swaps. Only the futures and options, F and O, are traded in the stock market. Right? For example, forwards are not traded in the stock market. Forwards are essentially the concept of an OTC, over the counter. OTC, over the counter, that is basically the issuer will basically sell these particular instruments in the market. So remember this, F and O are traded in the stock market, not all the derivatives. Statement is wrong. Derivatives can be of stocks, commodities, currencies, etc. Straightforward statement. Right? Yes, it is true. So right option will be option B, only 2 is correct. Electronic gold receipts, EGR, electronic gold receipts. Now, the concept of electronic gold receipts has been there in the discussion because this was announced in the budget. Now, to understand the concept of EGR, let me give a very simple example. All of us can trade in the stock market, for example, Bombay Stock Exchange. Right? Can I participate and trade in the BSE? Yes. Can you participate? Trade in the BSE? Yes. We can purchase shares, we can sell shares, right? And we can basically, after selling the shares, right, once the settlement is done, we will receive the payment. So, in simple terms, the securities or the instruments which are traded in the stock market, right, these can be traded, settlement can happen, and the investor or the holder of these particular stocks who has sold them can receive the payment, right, from the investor or the buyer. Now, apply the same logic to certain instruments which are called as the electronic gold receipts, which have been classified as securities now under Securities Contract Regulation Act of 1956. Remember this, right? If you want any securities or instruments available for trading purposes in the market, for example, derivatives, right, such as futures and options, stocks, government securities, all of these are essentially classified as securities under the Securities Contract Regulation Act of 1956. That's the first point. Second, what do we mean by electronic gold receipts here? Understand the background here. India is one of the largest consumer of gold in the international market, not just the consumer as well as importer. Having been one of the biggest consumers, would you believe if I say that there is no way we are actually the price setters in the market? That is, we are not determining the price in the international market. Rather, we are basically price takers. That is, in case of Indian market, the gold prices which are determined on day-to-day basis is not, because there is a system which we are following. We are not determining the price like this. In fact, there is an association called as Indian Bullion and Jewelry Association (IBJA), which based on factors such as exchange rate, profitability, right, international prices of the gold, etc., will decide and publish rate of gold on day-to-day basis. And whatever gold price or whatever gold you're going to purchase, let's say today, tomorrow, day after tomorrow, from any of the jewelry in the market, it basically is determined based on, right, the prices which are set up by or which are determined by IBJA. Now, Government of India says we want to set up a spot market. Understand the technical term here. We want to set up a spot market where gold can be traded. Now, some of you might be thinking, sir, what do you mean a spot market? You threw one more technical term at us. Generally, in the market, understand this, you can divide the market into spot market and a futures market. Last week, we discussed the concept of futures and options, where the delivery is taken on a future date, not today. Contracts are entered today, but the delivery of the securities, right, whatever it is taken in the future date. Whereas in the spot market, the trading happens, the delivery of the assets will take place in the same market, right, on the same spot. That is the reason this is called as a spot market. So, Government of India says we want to set up gold exchanges, which will basically act as a spot market, wherein the price of the gold can be determined. I can understand what is the price of the gold in India now can be determined through this particular gold exchanges, which is nothing but a spot market itself. And for this, understand this, SEBI, Securities Exchange Board of India, has been set up or has been given the regulatory authority. SEBI will be regulating the gold exchanges in India. That's the first point. Second, now coming to the idea of electronic gold receipts. Imagine there's an import of a gold, there's imported gold, or there is a refinery, a particular company which is refining gold in India. So they want to find out what is the market price of this particular gold in India. So what they'll do, they basically take, right, either the imported gold or refined gold, right, go to a depository. I understand this, I'm using the term depository. Some of the books will use the term vault. They will go to a depository or a vault, submit this particular gold. Physical gold will be submitted. Now this particular depository or vault will basically create an electronic paper. I understand. They'll basically prepare an instrument in the electronic format or a DMAT format, right? Either electronic or DMAT format, and this instrument is called as electronic gold receipts. And these electronic gold receipts, right, can be traded in the market. I'll repeat the statement. These EGRs can be traded in the market. Now imagine I have some gold. I will approach this particular gold, submit the gold, physical gold I'll submit, and they will create an EGR. They will give it to me. I will go to this right, trading market or exchange market, which can be set up, let's say by BSE, which is already doing it now, and I can trade these particular EGRs, electronic gold receipts. Imagine I will sell it to, I will get a certain price, and you will hold this particular EGR. If you want, you will basically approach the vault, submit the EGR, and whatever was the gold, right, which was kept and EGR was issued, that particular gold will be given to you. Or else you don't want to get the gold, you want to get the market price. So what do? You simply sell this particular EGR to someone else in the market. So remember, the EGRs are tradable, and there is no validity period for these particular EGRs. Is it okay? The electronic gold receipts are tradable, no validity period is there. Now, what's the advantage of this? One, it will help us in determining what is the market price of the gold. Based on the supply and demand in the market, we'll be able to have a price discovery of gold. That's the first one. Second one, people rather than hoarding gold. I can understand most of us do that. People or households rather than hoarding gold now can basically trade this particular gold in the market. And that hoarding, right, will also become lower and lower if we can provide a market for selling and purchasing this particular gold, but in electronic form. So with these particular objectives, Government of India has basically proposed the concept of electronic gold receipts. And as already mentioned, like SEBI will be the regulatory body. SEBI will basically give a license to these particular depositories or vault holders. SEBI will also give license to these particular the platforms, or let's say Bombay Stock Exchange, etc., to set up an additional platform or a new platform where the EGRs can be traded in the market. So these are certain important points related to EGRs. Now, give me a question here. Consider the following statements regarding electronic gold receipts. It will be having a maturity period of 10 years. Absolutely wrong. No maturity, perpetuity. Right? These will not have any maturity. These will be present in the market till perpetuity. These are issued by Union Government. Again, wrong. Right? These are basically issued either by depositories or they will use under term vault holders. Annually, 2.5% rate of interest is paid to the holder of these receipts. Again, this particular statement is wrong. Which of the above statement or statements is or are incorrect? All the three are incorrect. Right option will be option D here. Inflation indexed annuities. Although there is nothing given in the article, there was one term that was used which piqued my interest. That is in the article discussing concept of inflation indexed annuities. What is given in the article? Let me give you a basic idea first. You will subscribe, right, to various pension products. Is okay? You will subscribe to various pension products, and the authority that is basically dealing with this is PFRDA. Okay, PFRDA, Pension Fund Regulatory Development Authority. Now, once the retirement happens, we will have to choose annuity, and this annuity product will provide certain amount of returns to us throughout our lifetime. Is okay? I'll repeat the process again. We will subscribe to the pension product, and the pension products are basically coming under the regulation of PFRDA. Once we retire, we will have to choose an annuity plan, and this annuity plan will give us certain amount of returns, which is generally fixed for most of the pensioners. Right? So the amount of returns that we are going to earn is remaining to be or is going to remain fixed throughout our lifetime. Now here comes the problem. Inflation in the Indian economy has been increasing. Right? In the last 2 or 3 months, we have discussed the issue of inflation. There has been inflation in the Indian economy, not just month to month inflation, year to year inflation has been there. In addition to that, these particular right people, or let's say the pensioners, are also supposed to pay certain taxes. So have a look at this. If you start accounting for the inflation as well as the tax that is given by these particular people out of the returns that they are earning, which is for most of them a fixed amount of returns, the actual returns will be very, very less. So the returns are getting affected. And on the other hand, the inflation rate is increasing, tax is becoming a burden for these particular taxpayers. So in order to address this, right, very recently there has been a discussion between PFRDA as well as IRDA. Is okay? PFRDA, Pension Fund Regulatory Development Authority, IRDA, Insurance Regulatory Development Authority. And they're basically saying that we might come out with new types of annuity products which are basically indexed to inflation. I'll repeat it. We might come out with new annuity products which these particular investors will be able to choose. And these annuity products will give you returns which are indexed to inflation. What do you mean by this? As the inflation rate will move from one level to another level, there is an inflation rate in the market from 1 year to next year, the returns that you're going to earn from these particular annuity products will also get adjusted, will also be indexed to the inflation rate. That is the gist of the article provided here. Now, earlier, please understand, sir, this kind of a question we asked in UPSC. Very valid question. Right? Earlier, Government of India has actually tried out a concept of inflation indexed to bonds. Is okay? Inflation indexed to bonds. Right? Not having been very successful. That is the reason today, or currently, we do not have the idea of the concept of inflation indexed bonds. There also the concept is very simple. Whatever return you are going to earn, we are going to index that to the inflation rate. If the inflation rate changes, right, the inflation index will change, and the principal amount will also keep on changing. The returns will also keep on changing. That is the basic idea of inflation index bonds. So this is in just related to this article. I have a question here. Which of the following groups are negatively impacted under the negatively impacted during the periods of high inflation? Generally, these kind of questions are asking UPSC prelims. Have a look at this. First one, households with the savings, pensioners with the fixed returns, debtors, workers with the fixed wages. Whenever there is a high rate of inflation in a particular economy and you are earning a fixed amount of income or returns, inflation will always keep on eating part of your returns. So the purchasing power will always keep on reducing. So straightforward there itself. Second one, yes, will have the impact. Fourth one, yes, they will have an impact. Okay, so the first one, households with savings. Right, these particular savings, whatever savings are done by the households, please understand, the amount of goods or services that they can purchase using these particular savings will keep on reducing with a higher rate of inflation. Is okay? With higher rate of inflation, what quantity of goods or services you can purchase with these particular savings will always keep on coming down. So first one, yes, they will also be affected. One is correct, two is correct, three is correct. What about fourth? Debtor, essentially, remember this is right representing borrowers in the market. Right, there are creditors, there are debtors. Creditors are lenders, debtors are borrowers. Whenever there is inflation rate in the market, the borrowers benefit from this. I will repeat the statement. Borrowers benefit from this, or debtors benefit from this. Why? They are basically taken money from you when the purchasing power of money is higher, and they will give you back when the purchasing power of money is lower. In a sense, if I give you a very simple example, imagine I've taken 100 rupee money from you, loan from you, right? And today, with that 100 rupee, imagine you can purchase 100 units of chocolates in the market. After 1 year, those particular 100 chocolates will cost you 120 rupees. So I will give you back the 100. Don't worry about interest here. I will give you back the 100. Can you purchase the same 100 units of chocolates today? Absolutely no. Right? So that is the impact of inflation on the borrower as well as the lender. So borrowers benefit from inflation, lenders are affected by inflation. So third one, no. Right? So 1, 2, and 4. Right option will be C here. New IPO norms. Very, very important. SEBI has come out with the new IPO norms. What are the important points here? Let's try and understand this. Imagine, right? Understand this. Imagine here's a company which is conducting an IPO, initial public offering. It is selling its shares, instruments for the first time to the public in the market. So SEBI, what it does is, it will divide the investors in the IPO into 3 groups. One is called as a qualified institutional investors. Some will say buyers, don't worry. Qualified institutional investors. Second one is non-institutional investors, and the third one is retail investors. Now, within this qualified institutional investors, there are certain investors who will subscribe for share value about 10 crore rupees. Who will subscribe for share value of about 10 crore rupees, and these investors are called as anchor investors. Okay, these are referred to as anchor investors. And why these are referred to as anchor investors? Right, as per based on whether they are going through a book building process, or let's say a floating method process, right, or the fixed price issue process, certain large amount of shares will be allocated to qualified institutional investors. And please remember this, as per SEBI norms, even one day before the IPO is conducted, right, the shares will be allocated to these anchor investors. And right, as per the present norms, these particular anchor investors cannot sell 50% of the shares which are allocated to them before the end of 30 days from the date of IPO. Is okay, repeat it. These anchor investors are allocated shares one day before the IPO is conducted, and these particular anchor investors are not allowed to sell 50% of, or right, below 50%, they cannot hold it before 30 days. Meaning what? They are not allowed to sell more than 50% of the allocation that is done to them, right, 30 days from the date of allocation, from the date of IPO as such. Now, in the recent times, a lot of IPOs have been conducted. And one such IPO which created a huge, right, let's say, fervor in the market, expectation in the market was the Paytm IPO. And one day after the Paytm IPO, that is basically once the IPO was conducted, shares got listed, the shares actually tanked in the market. The market price of the shares actually fell down. And after the 30-day norm was over, the anchor investors further sold the shares in the market, which again dragged down the market price of the shares of the company. So looking at all of this, SEBI basically said, okay, let me introduce certain very stringent norms, more guidelines with respect to IPO, where I'm going to protect the interest of the retail investors. Now what SEBI says, right, these people, the anchor investors are allocated shares, 50% of the shares, these anchor investors now will have to hold for at least 90 days. Is okay? They will have to hold 50% of the shares at least 90 days, earlier 30, now it has been 90. So that the volatility in the market will be reduced. Second, right, have a look at the second very important change that they have introduced is with respect to book building process. Okay, with respect to book building process, right, generally the merchant bankers will give you 2 prices. One is called the floor price, and another one is called the ceiling price, and there is a price discovery for the shares. That is, you have to subscribe for the shares, lot of shares between these 2 prices itself. And earlier it has been found that to basically obfuscate, basically escape from the guidelines related to book building process, many companies conducted book building process on paper, but in reality, the difference between the ceiling price as well as the floor price was very, very small. Now, SEBI simply says, right, if your floor price is let's say 100 rupees, if the floor price is let's say 100 rupees, your ceiling price should not be below 105 rupees. That is, the ceiling should not be below 105% of the floor price. Right, you will have to give, right, the ceiling as well as the floor above 100, that is basically 100, and above 105, let's say 106 rupees. That will help in better price discovery for these particular shares to be issued in the market. So these are some of the very, very important reforms, or let's say measures which have been announced by SEBI in terms of the initial public offering now. Done. Based on this given question, consider the following statements regarding anchor investors. These are allocated the shares before the IPO is conducted. Yes. All the NIs, right, non-institutional investors are considered to be anchor investors. No. Right, within qualified institutional investors or qualified institutional buyers, there are anchor investors, not non-institutional investors. So second one is wrong, first one is correct. Right one will be option A here. Silver ETF. The first silver ETF has already been launched in India. Okay, basically the new fund offer of silver ETF has already been launched by ICICI Pru company. Now, what is the silver ETF here? First and foremost, what is an ETF? ETF stands for exchange traded funds. I will repeat. ETF stands for exchange traded fund. Now, what do you mean by exchange traded fund? Exchange traded funds are basically tracking either an index in the market, or a particular group of stocks in the market, particular group of bonds in the market, or commodities in the market. Let me give a very simple example. There is gold ETF. There is a product called as gold ETF. It's a commodity ETF. Then there is a CPSE ETF, which has been launched by Government of India. Then there is a Bharat 22 ETF. Then there is a Bharat Bond ETF. So have a look at this. In the market, you can find commodity ETFs such as gold ETF and now silver ETF. You can find stock ETFs or equity ETFs such as CPSE and Bharat ETF. You can even find a debt ETFs, that is Bharat Bond ETF. Essentially, these ETFs, exchange traded funds, are nothing but the group of the stocks or group of the bonds, or basically are tracking commodities in the market. For example, what is a silver ETF? Let's try and understand. There itself we will also understand the concept of ETF here. In case of silver ETF, here is the company, let's say ICICI, which will issue ETFs to me. I will purchase this ETF. ICICI will get money. They will purchase silver in the market. Is okay? They will purchase silver in the market. Right now, please understand this. As per SEBI guidelines, 95 of the funds which are collected by the issue of ETF like this, that is commodity ETF, they will have to use it to purchase either physical silver or any securities which are backed by silver. For example, silver ETFs in the market, or silver futures, or silver forwards in the market. Done. So have a look at this. 95% they will have to purchase, let's say, silver, physical silver. Now they will purchase the physical silver, keep it with the custodian. And what is the advantage here? Silver market prices will keep on fluctuating. So you have purchased an ETF, and this ETF fund has been used to purchase silver. So as the silver market prices will change, your ETF investment value will also keep on changing. So your ETF is basically tracking the market price of the silver. Let me give you another example. Imagine you purchased a Bharat 22 ETF equity instrument. Equity. Equity means what? It is a tracking shares. So there are 22 companies whose shares have been combined in the form of ETF, and you purchased one of these particular ETF. So your value of ETF portfolio will simply track what is the market price of this particular index. As this particular 22, the equity or 22 shares of these particular companies, as the market prices will keep on fluctuating, your ETF value will also keep on fluctuating, which is nothing but a concept of index only. So have a look at this. Earlier in the Indian market, only gold ETFs were actually allowed. And now, SEBI has even allowed silver ETF. ICICI has announced this. Nippon is about to announce a silver ETF, and large number of mutual fund companies are expected to announce their silver ETFs in the coming days. Now, some of you might be thinking, sir, for UPSC, what is the importance? We are not going to invest in the stock market, but what is the importance of this? Please understand this. Silver ETF for the first time has been launched in India. This was a long-standing demand of the companies or financial institutions. So SEBI has allowed issuing of this. First time it has been issued. That is important. Second, in case of silver ETF, the investors will have to have a demat account. Is okay? Silver ETF or for that matter, any ETF, the investors will have to have a demat account. Who can purchase this particular ETFs? If you do not have a demat account, don't worry. These particular fund houses or these ETFs are going to start something called as a fund of funds, where you can invest, and these particular companies or institutions are going to use this on your behalf to invest in the silver ETFs. Then, third very important point, importance of silver. Generally, investors invest in the silver or for that matter gold to hedge the risk of inflation, to escape right from inflation rate, because inflation will keep on reducing your real rate of returns. To escape or to hedge this particular risk of inflation, people tend to invest in silver. Apart from this, one potential area which would be asked in UPSC is, please remember this: gold prices, right, and silver prices. If you compare both of them, silver prices are much more volatile. I'll repeat the statement. If you compare gold prices and silver prices are much more volatile. Second point, more than 50% of the silver which is available in the market is actually used in the industries. Is okay? More than 50% of the silver which is there in the market is used by industries as against gold. Gold is not used majorly by industries. Majorly it is used in the general market. Okay. And in addition to that, a lot of gold which is mined out, which is introduced into the market, is held by institutions such as central banks, governments, pension funds, etc. But whereas in case of silver, more than 50% of the silver which is available in the market is actually used in industries. So if industrial performance increases like this, the market price of the silver will also start increasing. Remember this. If the industrial performance increases or the recovery in the market, right, increases the pace, then the silver prices in the market will also increase. For a very simple reason, silver is used in nuclear energy. Silver is used in the healthcare sector. Is used in electronics. The mobile that you're using right now, or the laptop that you're using, or tablet that you're using, could have a silver component in it. And that is the precise reason with economic recovery gaining pace, the market price of the silver will also keep on increasing. Done? So these are some of the important points related to this. Please be very, very careful. Let's have a look at the question here. Consider the following statements. Commodity ETFs are passively managed funds. Now, very, very tricky. Right? For those who have a background, it is very easy statement. But for those students who do not have any background related to this, very, very difficult statement. Generally, in case of investments, there are two terms: actively managed funds and passively managed funds. In the context of actively managed funds, it essentially means the manager who is basically investing in the market can move his funds. Is okay? Can move his funds from one instrument to another instrument. Right? If he feels like investing in this instrument, he will invest. Right? If he feels the risk is very high, he can withdraw the investment, invest in bonds. Those are actively managed funds. What about passively managed funds? In the context of silver ETF, whatever ETF you're purchasing, it will basically track the market price of the silver. Again, it will basically track the market price of silver. Manager is not doing anything here. It is basically tracking what is the market price of silver. For example, even in the context of let's say gold ETF, it is a passively managed funds. So commodity ETFs are passively managed funds. Yes, true. In case of silver ETF, the issuer can use the funds for investing in gold, silver, other equity instruments in the market. Statement is wrong as per SEBI guidance. In the context of silver ETF, 95% of the funds that they have collected, they will have to invest either in purchasing physical silver or any instruments which is backed by silver as a security. And remaining 5% they can invest in money market instruments or debt instruments. These are the conditions imposed by SEBI. So second statement is wrong. Right option will be option A. Only one is correct. No defaulters platform. This is the latest article. This was not in the newspaper, but this was published in the digital platform, right, of a Financial Express website as such. That is the reason there is no article picture here. Now have a look at this. What do you mean by no defaulters platform? This is a platform which has been set up by one of the groups which represents the MSMEs in India. Is okay? Right? There is a group called as CIEMSME. Is okay? And this particular entity has set up a new platform by the name of No Defaulters. And what is the objective here? In this particular platform, the MSMEs will have to report if any of their buyers means what? Imagine here is a company, MSME A, and it has sold certain raw materials, or let's say intermediate goods, either to a public sector company or to a private sector company. They are supposed to make the payment to this particular MSME unit within 45 days from the date of invoice printing as such. That is when the bill is printed. From that particular date, in the next 45 days, they are supposed to make the payment. Now, if these particular buyers do not make a payment, then basically these particular MSMEs can report these particular defaults on this particular platform. And that is the reason the name of the platform is No Defaulters. Some of you might be thinking, sir, what is the advantage here? Advantage is very simple. Right? Imagine all the MSMEs, although all of these MSMEs are not registered, imagine all these particular MSMEs or substantial number of MSMEs will start reporting this particular data on this particular platform. If I'm running one of these MSME units and one company which has defaulted on the payment to this company A comes to me and says, sell me raw material today, I will make the payment after 45 days. Now, having known that this particular company is a defaulter, I will be very careful to sell the raw material to this company. Again, this will provide more information. We will start holding these particular companies more and more accountable. Now, some of you basically say, so wait a minute, isn't there a platform by the name of EMSME Savadhan which has been set up by the government of India already? Yes. Now, some of you will say, so is there a platform already? Yes. And remaining, you will basically say, sir, what is MSME Savadhan? MSME Savadhan is a platform which has been set up by the government precisely for the same objective. That is to track the payments of the MSMEs. But the difference between the new platform as well as the platform set up by the government is, in the new platform, remember this, how much is the amount that the buyers need to pay, that is mentioned. Is okay? How much is the amount that the buyers need to pay, that is mentioned. And in MSME Savadhan, there is no mention of how much is the amount that the buyers already owe to the sellers as such. That is the important difference. In addition to this, under No Defaulters platform, right, this organization says that we will try to negotiate with the buyers and try to ensure that within a certain number of days, the buyers will be making payment to the MSME unit. We'll try to negotiate and we'll try to come to a conclusion how many days are required to make the payment so that the realization of value will increase for the MSME unit. Next important point. Over a period of time, this No Defaulters platform will also be used just like CIBIL score, right, is used for the borrowers in the market. That is, they're proposing, they're not started, they propose that we will develop a new system, we will start rating these particular buyers in the market. Just like the borrowers in the market, such as retail borrowers, have a CIBIL score, right? What do you mean by CIBIL score? If you go to a bank, apply for a loan, the bank manager will basically ask you, sir, what is your CIBIL score? higher the CIBIL score, it represents that you borrowed in the past and you have repaid promptly. I can understand this. When you borrowed and repaid the amount very promptly, your CIBIL score is very, very high. And as a borrower, you'll be considered as a credit-worthy borrower in the market. In the same way, this platform will develop a new rating system for the buyers in the market, which can be used right by the banking sector to look into these types of companies and find out what is the creditworthiness in the market. So these are some of the very important points which have been mentioned right with respect to the new platform by the name of no defaulters. I'll give a descriptive question also here. The MSMEs face an issue of liquidity and credit. Discuss the reforms undertaken by the government to address such issues. Let's say in 250 words. And just for your information, I've already given some of the very important reforms that have been taken by the government, such as credit platform, right, such as MSME Samadhan, private sector lending, credit guarantee trust for micro and small enterprises, right, the loans, right, PSB loans of 59 minutes in 59minutes.com, that's a 59-minute loan portal, Mudra Yojana, etc. All of these particular reforms will basically try to address the credit related issues as well as liquidity related issues for the MSMEs. Done? You can write, right, let's say 3 lines for all of them. You'll definitely hit 250 words. SEBI and stock manipulators. Now, before discussing what is given in the article, let me start with a very basic idea. There is a term called as friend running. Is okay? There is a term called as friend running. What do you mean by friend running? Imagine, right? Imagine, I'll not do that, but imagine. Today I will tell you that tomorrow in the stock market, purchase the shares of the company XYZ. As per my analysis, the shares of XYZ market prices will increase, performance will improve. So you purchase tomorrow, in the future you can sell it. Right? By looking at me, and you know that I'm economics faculty, you feel that okay, this fellow could be talking correctly. So let me make gains in the market. So tomorrow when the market opens, you will run to the market, although not literally, and basically you will demand for the shares of the company XYZ in the market. And all of you, when you start demanding thousands of investors, when you start demanding for the shares of company XYZ in the market, I simply say that the market prices of the shares XYZ will start increasing. Now this is the first step. Second step, today, before I come to the class and tell you to purchase the shares of XYZ, what I would have done is, I would have already purchased certain shares of the company XYZ, that these are my shares now. So imagine I purchase the shares of company XYZ at 150 rupees a piece. So tomorrow you will demand for the shares of XYZ, the overall demand in the market starts rising up, and right, have a look at this, the market price for the shares of company XYZ might hit, let's say 170 rupees a piece. So what I'll do, today I purchase the shares of company XYZ at 150, tomorrow you will demand for the shares, market price increases, I will sell the shares of the same company XYZ at 170 tomorrow. So by telling you to purchase the shares of the company XYZ, I have made a profit of 20 rupees a piece, right, in a span of a day itself. This particular process is called as front running. Again, right, I'm not telling you to do this. This is called as front running. What do you mean by front running? The investor in the market has already taken a position. Position means what? Imagine he has purchased the shares because he is already privy to certain information related to the movement of asset prices. Is okay? Right? The investor has knowledge as to how the asset prices in the market are going to change in the coming days. And based on that, he is taking a position in the market. For example, in this particular situation, I have taken a position where I purchase shares, I am sitting quietly, I am telling you to purchase. Tomorrow, when you start demanding market prices will increase, I will sell the shares tomorrow at a higher price. This is called as front running. There's one more technical term for this. Such schemes are also referred as pump and a dump. Is okay? Pump and a dump schemes. Now, what's the connection of all of this with respect to article given here? SEBI has found that there are certain investors in the market who are actually practicing front running. And they're not supposed to do that. I can understand. They're actually practicing front running. How so? Right? Certain Telegram channel names are given, not relevant for UPSC. Right? Certain investors have opened Telegram channels, have asked people to subscribe to these Telegram channels, saying that they will provide valuable inputs related to stock purchases, stock sales in the market. And what they've done is basically, right, practice front running. They have purchased shares of the company, told to the subscribers in the Telegram channel, tomorrow you purchase these particular shares, these subscribers will purchase the shares from the market prices will increase. These investors who already have taken a position by buying the shares earlier now will start selling the shares in the market. Then is it possible? Definitely yes. Definitely yes. Whenever the companies are small cap companies, there's a technical term called as a small cap, right? Mid cap, small cap, large cap companies based on market capitalization. So basically, in case of small cap companies where the market capitalization is very low, up to 5,000 crore rupees, it is very easy to manipulate the market shares and front run and make gains. And SEBI says, I will not allow you to do this. It is illegal. I will not allow you to do this. Right? That is the reason SEBI has started cracking down on these kinds of a closed loop or closed investor groups as such. And because as per SEBI guidelines, if you have a closed group, you cannot give investment advice unless you are registered with the SEBI. Is okay? You are registered as an investment advisor with the SEBI. Unless you have that particular registration in a closed group, you cannot give the advice for the investors in the market. Right? So SEBI has started cracking down on these particular WhatsApp channels, closed group channels, etc. And that is the gist of the article. Will UPSC ask you about the Telegram channel? Absolutely no. He might ask you about this particular term. What do you mean by front running? Government to own stake in Vodafone India or Vodafone Idea. Now in this article, in the last couple of years, there has been a lot of turmoil in the telecom sector. Right? Over a period of time, a lot of these particular companies have been merged with other companies or have been forced to shut down because of the losses, etc. And over a period of time, there was a concern that even if a company such as Vodafone Idea or V, even if this particular company shuts down, then there will be right, duopoly in the market. What do you mean by duopoly? Generally, you come across the term monopoly and a duopoly. Monopoly essentially means single supplier. Duopoly means right, two suppliers. Right now, the major suppliers of telecom services in India are Airtel, Reliance Jio, and Vodafone Idea or V. Even if you shut down this particular company, only two companies will be left out. Some of you might be thinking, sir, what about BSNL and MTNL? Are they not the players in the market? Yes, they are also players, but they are struggling with their own issues as such. The issues are to such an extent that Government of India, couple of years, has infused a lot of money into BSNL, and BSNL still requires a lot of money from the government. So have a look at this. There are three major players in the telecom sector in India, and if one of them shuts down or closes, only two companies will be left out. And when only two companies are left out, what do you think will happen to competition? What do you think will happen to services which are provided by these particular companies? What about the quality of the value-added services that you will be able to enjoy when there is a very higher competition? All of these will move in a negative direction, and that is the precise reason various experts were basically arguing that Government of India needs to step in, provide certain reforms, and relief to these particular companies. And what is the reform and relief I'm talking of? Last year, Government of India came up with a telecom sector package wherein they basically stated that whatever dues that these particular telecom companies have towards Government of India, and what is the due I'm talking of? They're supposed to pay adjusted gross revenues, interest plus penalty. Is okay? AGR, interest plus penalty to the Government of India. So whatever dues that these particular companies have towards Government of India, there's one option given by the government. These particular companies can convert these particular dues into equity. That is basically shares and sell it to the government. Is okay? I'm using the term equity very loosely here because generally in the idea of equity there are multiple types of shares in the market. In UPSC, more than sufficient focus on two types of shares. One is called as equity shares, and the second one is called as preference shares. Is okay? One is called as equity shares and the second one is called as a preference share. What is the basic difference between both of them? If I'm an equity shareholder, I have a voting right. The dividend that is announced by the company to me will vary from 1 year to another year. Whereas if I'm a preference shareholder, a fixed amount of a dividend is declared by the government, and I will not be having any voting right in the company's decision-making assets. So these are the two types more than sufficient for UPSC. So government basically say whatever dues you owe to us, you can pay the dues, take some time, pay the dues. Or else what you can do is you can convert this amount of a due into shares and give it to us. And that is exactly what has been proposed by Vodafone Idea now. As per the decisions that has been taken by board of directors of V company, they have basically stated that we owe over 16,000 crore rupees. You don't have to mug up this particular number. They owe a large amount of a sum to government of India. Rather than paying money now, they will convert this particular money into stake or ownership or shares which will be given to government of India. And what will happen to existing ownership? Because we are giving shares to government of India now, the existing ownership will automatically come down. Is okay, remember this. Because we are creating shares, giving it to government, like 35.8% will now be owned by the government. The existing ownership, which is basically between the Aditya Birla company, the Vodafone International, etc., the ownership will automatically come down. And now government of India will become the majority stakeholder, majority owner in this particular Vodafone company. Now let's critically evaluate this particular article. Right? That is more important for your UPSC exams. What are the advantages? What are the benefits that we can expect? One, we have basically ensured that this particular company will not close down now. Is okay? Basically postponed, assuming it will work very efficiently now, we are basically postponed or prohibited closure of one more companies and reducing the telecom to duopoly. That's the first benefit. Second benefit is this particular company doesn't have to pay money to the government now. I can understand this. There is no debt which is basically lying on this particular company's head. It has already paid this particular debt in the form of equity to the government. So there is no debt liability on the government. That is a company here, and this will help the company to raise the funds, especially from the external market. And the third, now when this particular company is, that is the third company, we will start working now, borrow from the market, invest in 4G infrastructure, 5G infrastructure, start providing better telecom services. The competition in the market will start blooming or increasing, and we as customers will start benefiting from this particular competition. So these are some of the advantages that are associated with this particular article. Having said so, are there any concerns? Are there any problems related to this? Yes. First and foremost, what will be the role of the government now? Because now government will own 35% or more than 35% in this company. What is the role of the government? Government of India has clearly given a notification stating that government will not become the owner or majority owner in this particular company. It will not even take a place in the board in the company as such. Right? Essentially, government will have this ownership, and at appropriate time, government will